Hi all, welcome to the BCCA CMA Final DT Marathon. This is Manideep, faculty for direct taxation and indirect taxation at final level. So many of you already know, you have watched my IDT Superthon and all. You know how I usually analyze and I pick the questions and do the marathon or the Superthons. Okay, so I need not to tell that you go and watch the IDT Superthon, you yourself will understand. The same kind of exercise I did even for DT. Okay, but since I don't have much time, I have covered now only in relation to the double taxation avoidance and transfer pricing. So this video covers only the double taxation avoidance and transfer pricing. But these two chapters alone has the capacity of asking 5 7 marks question. Question number 6, question number 7 and 8B. 5 7 marks question. That means 35 marks. Even in a rarest case also there will be 4 7 marks questions and 2 MCQs. That means minimum of 32 marks, maximum of 39 marks. That is being covered here within 5 hours. Okay, and you need not to worry about which question to solve, which source has to be solved. And many students think like DTA slide I know and all, transfer pricing also many students feel like, oh, I know transfer pricing and all, but you'll be facing the problem in solving the questions, right? Like the logic you'll not understand properly. That also I have addressed. I've said properly, given the explanation and all. I have checked the past examination papers, like almost like 5 attempts, mock test papers I have referred, workbook I have referred. So from there, whichever is the relevant question, whichever is needed, those questions only has been picked and discussed to you. So this is purely targeted for you to clear the exams. Okay, so if I hope you love this approach or love this marathon, if you love this marathon or if you like the explanations and all, do support this one with your like, comment and share with your friends, because at this last minute, this 30 marks are there in your pocket, then your duty paper you can clear in flying colors. Okay, this material, sir, which I used for this particular explanation and all, this is little bit clumsy, I think, but please accept that, because in this last minute of time, if at all I ask my team to again copy paste these questions and all, because these were past examination questions and all, so I need to again refer back whether any mistakes are there and all. So that's why I have taken the screenshot and I solved somewhere, and if the answer remains intact, then I have let it keep the screenshot as it is. That's why. And there to summarize the provisions and all, I have handwritten also somewhere. So it is something like more or less like your class notes only. Okay, so which would be much more easy for you to refer there. The material description is given, the material link is given within the description. You can download from there. Okay, so let's not waste the time. We'll go into the revision series. So quickly, okay, without wasting our time, we'll go into the basics actually. Sir, I'll be keeping the timestamps there. If at all you know this basics part like tax rates and all, you already did like surcharges and all, and then the basic rebate part and all. Then if you know then you can skip directly to this point of time. Okay, I'll be keeping there where I'll be discussing like 115 BSE related, like old versus new regime. So new regime, so what we are following or what deductions allowed, what are not allowed. So that also certain points are needed. Okay, to the limited extent only I have covered, sir. I am not covered full-fledgedly going in depth into the salaries chapter also. All those I didn't did, which are relevant for our problems, that I have discussed here. So I'll put a timestamp here. Once if you are clear with the tax rates and such as rates, directly jump there. Okay, then if you know that one also, then I'll be referring to the deductions also, few deductions. So if you are clear with the deductions then you could even skip with the deductions part and directly you can go into the DTA part. Okay, so now coming to the basics here, the tax rates. So how do we calculate tax? Sir, here company related again I'm not covering now. Okay, because the majorly with respect to double taxation avoidance agreements, whatever the method we are solving, so they are not majorly, the questions are not related to corporates and all, so they are related to individuals are only there. So that's why companies related taxation part I didn't discuss here. Okay, so if I cover the math calculation like the PGBP related questions and all, so there I'll be covering that. So, okay, now I'm focusing like what is relevant for these questions. Okay, I'm not choosing like only this area concept I'll tell. For solving this question, if you need concepts from 3-4 chapters, I'll bring there and I'll help you in a way that you answer question number 6 and then question number 7. So that's my target here. Okay, so now how do we calculate income tax liability? First we'll take old tax rates. How do we calculate income tax, sir? There are like two regimes now, old regime, new regime. The new regime has become the default one now. Okay, Whereas there are certain incomes which are chargeable to tax at special rates, like capital gains, these betting, gambling, lottery incomes. So those are chargeable to tax at special rates, and they have to be taxable at special rates only. So once we calculate the income tax, on this we need to levy what? Surcharge. Surcharge has to be levied on what? Tax. Then we need to calculate what? Once we calculate surcharge, we do a subtotal called tax plus surcharge. On that we'll be levying the health and education cess. Then we'll be getting the total tax. Okay. Now, for individual HUF, AOP, BOA, AJP, the tax rates, or usually we'll call them as like what? Slab rates. So these slab rates we are having under the default regime. Default regime is nothing but what? New regime currently. And there are even the old regime also we'll be discussing. So under the default regime, we need not to bother about whether SSC is resident or non-resident. The same rates, whether he is senior citizen or not, super senior citizen or not, there is no difference irrespective of your age, irrespective of your residential status. The same set of slab rates are applicable. What are those? 0 to 3 lakhs, nil. 0 to 3 lakhs, what? Nil. Okay, then 3 lakhs to 7 lakhs, 5%. 7 lakhs to 10 lakhs, 10%. 10 to 12 lakhs, 15%. 12 to 15 lakhs, 20%. Above 15 lakhs, it is 30%. One point which I want you to understand here is like 3 lakhs to 7 lakhs, na, in between there will be 4 lakhs, right? On the 20,000. On this 7 lakhs to 10 lakhs, 3 lakhs, right? Into 10%, 30,000. On this 10 lakhs to 12 lakhs, 2 lakhs, right? Into 15%, 30,000. 12 lakhs to 15 lakhs again. 20%. That means how much? 60,000. So if you add all these, you're getting how much? 1.4 lakhs. So I mean, up to 15 lakhs, if you calculate tax liability, your tax is how much? 1 lakh 40. So this thing you should remember. Under the default regime, on first 15 lakhs, the tax would be 1.4 lakhs. Why? This would help you in solving the problems in a quicker way. Let's say 25 lakhs is there in the question. First 15 lakhs, 1.4 lakhs. On the balance 10 lakhs, you'll be applying 30% for that reason. Then the normal rates are the old regime. So under old regime, the tax rates dependent on whether individual is based on individual age and all. And even though there is age, okay, again it is like resident or non-resident also determines the factor. Okay, individual is resident or non-resident, HUF, AOP, BOA or AJP. Then what are the tax rates? 0 to 2.5 lakhs, nil. 2.5 to 5 lakhs, 5%. That means here how much will be the tax? 2.5 to 5 lakhs, 5%, not 12,500. Then 5 lakhs to 10 lakhs, 20%. I mean, in between this 5 lakhs will be there, na? Multiplied with 20%. You'll get 1 lakh. About 10 lakhs, 30%. So here also, quickly, on first 10 lakhs, what would be your tax? 1,12,500. Then individual whose age is greater than or equal to 60, but less than or equal to 80 are called as senior citizens. If he is a senior citizen and he is resident, then the basic exemption limit will be 3 lakhs instead of 2.5 lakhs. So what if senior citizen is non-resident, then the above said slab rates only applicable, 0 to 2.5 lakhs only, that basic one only, okay? So senior citizen and resident individual, then what are the slab rates? 0 to 3 lakhs, nil. 3 lakhs to 5 lakhs, 5%. 5 lakhs to 10 lakhs, 20%. Above 10 lakhs, 30%. So here also, for a senior citizen, under the old regime or the normal taxes, on first 10 lakhs, it would be 1 lakh 10,000. Then resident individual whose age is greater than or equal to 8 years, he is called as super senior citizen. For super senior citizens, what are the tax rates applicable? 0 to 5 lakhs. It is like what? Nil. Above 5 lakhs to 10 lakhs, 20%. Above 10 lakhs, it is what? 30%. For super senior citizens who is a resident, on first 10 lakhs, the tax would be 1 lakh 1 lakh. Okay. So just to have here, sir, you have a quick recap again the tax rates here. On first 10 lakhs under the default regime, it would be 1.4 lakhs. Under the old regime, for the first 10 lakhs, the tax would be, sir, here it is like 15 lakhs. Sorry. Okay, under the default regime, on first 15 lakhs, the tax is how much? 1 lakh 40,000. Whereas under the old regime, you cannot calculate it till 15 lakhs because 10 lakhs only 20% slab gets ends, right? On first 10 lakhs, it is like 1 lakh 12,500. Here it is like senior citizen, resident, na, then first 10 lakhs, 1 lakh 10,000. Super senior citizen and resident, first 10 lakhs, 1 lakh. Okay, these are the tax liabilities. So we have just known the tax calculation. Now we are going into the surcharge part. So surcharge part, they are linking in questions. Yes, it might get linked somewhere. Surcharge applicable for individual HUF, AOP, where all the members are other than companies, BOA and AJP. If any member is company, na, or all the members are companies, na, then these are not applicable. Okay, all the members are other than companies. Then here under the normal regime, and even under the default regime. Okay. In other way, new regime, old regime. So under the new regime, up to 50 lakhs, there is no surcharge. What is the 50 lakhs? Total income is up to 50 lakhs now, then there is no surcharge. And the total income is greater than 50 lakhs, but less than or equal to 1 crore, then the surcharge rate is 10% on what? Not on the total income, 10% on the income tax calculated. Then 1 crore to 2 crores, the surcharge rate is 15% of income tax calculated. If it is greater than 2 crores, then the surcharge rate is 25% of income tax. So under the new regime, up to 50 lakhs, nil. 50 lakhs to 1 crore, 10% on income tax. 1 crore to 2 crores, 15%. Above 2 crores, 25% of income tax. Then here, okay, under the old regime, up to 50 lakhs, nil. 50 lakhs to 1 crore, 10%. 1 crore to 2 crores, 15%. There is another slab here, 2 crore to 5 crores, 25%. Above 5 crores, 37%. Up to 50 lakhs, nil. 50 lakhs to 1 crore, 10%. 1 crore to 2 crores, 15%. 2 to 5, 25%. Above 5 crores, 37%. Once again repeating, surcharge has to be levied on what? Tax computed, income tax computed. Then health and education cess. On what health and education cess has to be levied? First you will be calculating tax, then you will be calculating surcharge. Then on together of tax and surcharge, you will be levying health and education cess. So applicable in both the regimes, health and education cess, you follow like the default regime or the old regime, health and education cess is applicable. It has to be levied at 4% on income tax plus surcharge. Sir, if on surcharge marginal relief is there, then subtract the marginal relief also. And if any rebate is there, you should subtract. Sir, surcharge and rebate will not come at the same time. Either surcharge will come or rebate will come. If rebate na, subtract. Surcharge na, add. But while adding surcharge, if any marginal relief is there na, subtract that marginal relief. After that only, you will be adding the surcharge. Okay. So this one. Now we will be discussing about rebate under section 87A. Okay. So this rebate is applicable only to resident individuals. This rebate is there under both the old regime as well as under the new regime. So under the old regime, it is very simple, sir. Compute the tax on, where it is applicable only when the net total income is less than or equal to 5 lakhs. Less than or equal to 5 lakhs. Not the gross one, sir. Net total income less than or equal to 5 lakhs. What is the rebate available? 12,500 or the tax payable, whichever is lower, income tax payable. So income tax payable or 12,500, whichever is lower is the rebate. Then under the new or default regime, up to 7 lakhs the rebate is allowed. Okay, the total income is less than or equal to 7 lakhs. What is the rebate? Tax payable or 25,000, whichever is lower. Where the total income is greater than 7 lakhs, then also rebate is allowed, sir, just to cover the marginal relief extent. To cover the marginal relief extent. That means nothing but up to 7,22,500 of total income, you will get relief. Okay, you will get the rebate here. Up to total income of 7,22,500. If it is more than 7,22,500, you will not get any rebate under the new regime also. Okay, so how it works now? When it is greater than 7 lakhs, first calculate tax on total income. Tax on total income. Then calculate tax on 7 lakhs. If the tax on total income is greater than that of tax on, okay, the tax on total income is greater than that of tax on 7 lakhs, then the rebate is 1 minus 2. 1 minus 2, whatever is the difference is there, that will be taken as rebate. However, it is applicable only when the total income is up to 7,22,500. Sir, I can take example and explain here, but this, since I am covering rebate, I have included here, but nowhere relevant for us now. Okay, so only these points from the basic tax rates and all are needed, sir. Tax rates under 115 BSE under the normal regime. Then surcharge rates under the 115 BSE, I mean the default provisions under the old regime. Health and education cess. Then rebate, if any, applicable. Total income and tax payable. So we have computed here the total incomes and total tax payables, right? So the total income and tax payables has to be rounded off to nearest multiples of rupees 10. That means if it is like 735, 5 or more, you should be rounding off to the next number. 735 na, round off to 740. It is 734, round off to 730, like that. Okay. Where SSE opted, sir, what I am going to discuss is now, see, if you opt the default regime, 115 BSE, then you cannot avail certain deductions and certain exemptions. I'm not going to discuss the whole list here, but to solve DTA problems, there are certain frequent points, certain points which will come frequently. So those points for you to solve the problems, you need little knowledge here. So those and all I'll be covering here. Where SSC opted 115 BAC, default regime, deductions, exemptions that are not available. So I'm not covering each and every one which were needed now. Those only I'm discussing. Covered limited extent which are required to solve our questions. So see, income under the head salaries. Sir, under the head salaries, there'll be so many allowances, perquisites, and then we'll be having even deductions as well, right? So certain allowances or perquisites may not be allowed under the new regime. So since there is no question here deeply regarding salaries, okay, they may give a one point like here some salary like that, okay. So what is relevant for us there? Salaries, there is standard deduction that we should take it. So standard deduction, when you opt for the new regime, I mean the default regime currently, then the standard deduction available is how much? 75,000. As per old regime, it is only 50,000. Standard deduction, if you opt new regime, 75,000. Old regime, na 50,000 only. Then income under the head, house property. How do we calculate house property income? First, we will take the GAV, gross annual value. Fair rent or municipal rent, whichever is higher, restricted to standard rent, that is the expected rent. Compare expected rent with actual rent. Okay, so all this you will be doing that, right? So then that is called as what? GAV. From GAV, you will be subtracting what? Municipal taxes, property taxes, sewage taxes all together. Then you will be getting the NAV, right? From the net annual value, you should subtract 30% of standard deduction. 24 subsection A, 30% of standard deduction is allowed. So this standard deduction is what? 30% of NAV, which you can claim as deduction in both old regime as well as new regime. But coming to the 24 subsection B deduction, which is regarding the interest. Okay, the interest on loan which is taken for construction or purchase of a house property. When you are paying such interest, see that interest amount, if it is a let out property, okay, old regime, new regime. If it is a let out property, it is allowed under the old regime, sir. If it is a let out property, there is no limit how much ever is the interest you can avail as deduction. Self-occupied, the interest you can claim as deduction is restricted to 2 lakhs in a year. With respect to let out property under old regime, there is no limit for, okay, if you have 4 lakhs as interest, you can claim 4 lakhs as deduction. But self-occupied property, you can claim, even though you have 4 lakhs as interest, you can claim maximum of 2 lakhs only as deduction. But under new regime, sir, be clear, let out property for interest allowable or not allowable? Allowable up to taxable rent. Under new regime, for let out property, it is allowed up to what? Taxable rent. Self-occupied property, nothing is allowed. Nothing is allowed. So this is very important. Interest, old regime, let out property, no limit. You can avail how much ever is the interest. Self-occupied property, 2 lakhs. New regime, let out property to the extent of rent taxable. Self-occupied property, nothing is available. Okay, then after doing all this from GAV, subtracting municipal taxes, NAV, from their standard deduction, from their interest, then you will be arriving house property loss or gain. Okay, now, assuming it has loss. If it is loss, under old regime, it is allowed to be set off. It is allowed to set off with other heads. Allowed to set off with other heads up to how much, sir? 2 lakhs. I mean, within the head, you can adjust. With other heads also, you can adjust up to how much? Allowed to set off with other heads up to 2 lakhs. Whereas, Whereas if it is under the new regime, I mean the current default regime, let out property or self-occupied property, both, they are not allowed to set off with other heads. Within the head, the loss can be adjusted. You have 2 house properties, one property has loss, one property has gain. Those 2 you can set off under the new regime. But if after adjusting that also, still you have house property loss of some 1 lakh or 2 lakhs or 3 lakhs, you cannot set off it with the other heads income under the new regime. Then PGBP and capital gains, there are no much differences with respect to 115 BAC and all. So those are not much needed also for us now. Next, IFOS. Under IFOS, there is something called pension income, family pension. So pension, this is not the normal pension. This is called family pension. Okay, with respect to family pension income, you will take the full income, but there is a deduction available there. What is the deduction available? If you opt to old regime, 15,000 or 1/3 of pension is, whichever is lower can be taken as deduction. Whereas if it is new regime, 25,000 or 1/3 of pension, whichever is lower can be taken as deduction. So then after deducting all this, you will be arriving gross total income. Sir, again, by this we are even understanding the format for computation of tax. First, income from salaries, standard deduction point I have referred. Income from house property, I have discussed about standard deduction, interest deduction, and loss how to deal also. Then PGBP, capital gains, nothing much discussed, just the head names only I wrote. Then coming to income from other sources, pension, family pension. Old regime na 1/3 of pension or 50,000, whichever is lower. New regime na 25,000 or 1/3 of pension, whichever is lower. So after adding all this, okay, we'll be getting what? Gross total income. From the gross total income, we need to subtract chapter 6A deductions. Sir, I'll be discussing afterwards the deductions also, the important deductions which were needed for us now. And I'll tell what are the deductions which are only available under new regime. Okay, so after subtracting deductions, you'll get net total income. This net total income you should round off to what? Nearest multiples of rupees 10. Then on the total income, you'll be calculating the taxes. Okay, now first deductions are important deductions only. So just I'm not taking it so long also. 10-15 minutes maximum. ATC deduction. ATC deduction. Who can avail ATC deduction? An individual or HUF. Maximum how much? 1,50,000. Maximum how much? 1,50,000. Okay. On what or on happening or on doing of what you will get ATC deduction? You should be making investment in specified places. With respect to space, you should do specified investments, such as like you should take a insurance policy, you should invest in mutual funds or equity shares, or you should deposit in post office savings account, SPF, PPF, RPF, like that. So individual and HUF, what is the maximum amount of deduction available? 1,50,000. Okay. Life insurance premium, the deduction is with respect to what? Life insurance premium. When individual, okay, with respect to whom the policy can be taken, individual himself, spouse, children. If it is HUF now, with respect to any member, they can take the life insurance premium. Life insurance premium will be paid with respect to parents, not covered here. Amount deposited in PPF, Public Provident Fund, for self, spouse, child, or any member of HUF allowed. Employee contribution to SPF, RPF allowed under ATC. Fixed deposit with scheduled banks allowed under ATC. 5-year post office deposits you can do. Mutual funds you can invest, notified only. Repayment of housing loan. So all these are the certain specified investments. On investing in them, you are eligible to avail ATC deduction. Okay. Then ATCCC, contribution to pension fund of LIC by an individual. So ATCCC is available only to individual on contribution to pension fund of LIC. Up to how much? 1.5 lakhs. 1.5 lakhs. Then ATCCD, contribution to pension scheme of central government or NPS. How much is the deduction available? ATCCD subsection 1, 1B, 2. Total 3 subsections are there. CCD subsection 1, subsection 1B, and subsection 2. Under CCD subsection 1, either an employee or SSE can take deduction. What is the deduction he can take? The amount he contributed or 20% of gross total income if he is a self-employed. Contribution or 10% of salary if he is an employed person. Okay. ATCCD 1B. ATCCD 1B gives like the additional deduction of rupees 50,000 rather than the ATCCD 1 deduction. So what is ATCCD 1B, sir? Sir, under ATCCD 1, what I am saying, if you are an employee or a self-employed, you can take the contribution which you made actually or 20% of gross total income. Employee na 10% of salary or the contribution, whichever is lower, you can take as deduction. But let's say you calculated there, it came to 2,10,000. But you can claim the deduction under ATCCD subsection 1 is to a maximum of 1,50,000 only. Then what you do with the other 60,000? The other 60,000 is the additional amount which can be claimed under ATCCD subsection 1B. Additional 50,000 not allowed under ATCCD subsection 1 can be claimed under ATCCD subsection 1B. Now ATCCD subsection 2, the same contribution to NPS only, but here it is what? Employer's share of contribution. The previously we discussed this what? Employee's share of contribution. Now we are discussing about employer's share of contribution. Government employer, then the deduction available is employer contribution and 14% or 14% of salary, whichever is lower. Non-government employer, employer contribution, salary into 10%, which is the deduction you can available under old regime. Salary into 14% is what you can available, which you can avail as deduction under new regime. Sir, understand? ETC is available only under old regime. ATCCC is available only under old regime. But ATCCD also, ATCCD subsection 1, 1B, these are available only for old regime. But when it comes to 80 CCD subsection 2, it is available under both new regime as well as old regime. Both new regime and old regime. Sir, how to remember? See, deduction available under section 115 BAC, 80 CCD subsection 2. So that's why I need to get it registered for you. What is covered under 80 CCD subsection 2? Employer's contribution to NPS. How much is allowed? Government employer or non-government employer? Government employer. Actual contribution made, actual employer contribution made or 14% of salary, whichever is lower. Non-government employer, employer contribution or salary into 10% in case of old regime. In case of new regime, employer contribution or salary into 14% under the new regime. Okay, then ETD, deduction with respect to medical insurance premium. If any medical insurance premium is paid, how much is the deduction available? Okay, under ETD, it's not just only the medical insurance premium, it's even related to the any deposits made to central government health scheme or even amount or the expenditure incurred with respect to preventive health checkup. Now here, individual or HUF should be resident or non-resident. So he could be a resident or non-resident. He can claim the deduction under ETD. How much amount he should have paid? Paid any mode. Okay, sorry. What is the mode of payment? He should have made the payment through any mode other than cash. Any mode other than cash. It could be for self and even for spouse, children are dependent children and parents. If it is with respect to HUF, it can be taken for any member. So ETD, you can take the deduction with respect to medical insurance premium. Okay, medical insurance premium paid and contribution to central government health scheme and even preventive health checkup. These three. Who should be the eligible SSC? Individual and HUF, resident or non-resident. How the amount has to be paid in any mode other than cash. For whom the policy should have been taken? For self, spouse, children, dependent children or parents. HUF they might have been taken for any member. So we'll see here there are three types of contributions or payments. Whether all those three are allowed for individual and even for HUF? No. So in individual, for micro family, himself, spouse, children, one category. Parents, separate limit is given. And for HUF, differently. So that's why we are separating this and written. Medical insurance premium paid can be allowed as deduction for both self, spouse and children and even for parents, HUF for members. Where if any central government health scheme contribution is made, it is only eligible as deduction when individual has made such contribution for himself or for spouse or for dependent children It is not available when the deposit is or contribution is made with respect to parents and HUF with respect to any member. Preventive health checkup allowed with respect to self, spouse and dependent children, parents of individual, but not allowed with respect to HUF for any member. Okay. With respect to individual, there is a separate amount limit for self, spouse and children, parents. So the total together, medical insurance premium, central government health scheme contribution, preventive health checkup. The total with respect to self, spouse and dependent children can be taken as like how much? 25,000. With respect to parents, another 25,000. HUF with respect to members paid, 25,000. Understand? Where out of this micro family, self and spouse, children obviously they will be lesser age than them, right? Okay, if at all, that is applicable. Self or spouse, if any one of them are senior citizen, then this amount limit 25,000 will be increased to 50,000. Instead of 25,000, it will be increased to how much? 50,000. Then parents also, if any of the parent is senior citizen, then the amount is 50,000. Even for HUF also, if any member of the HUF is senior citizen, then the amount limit is 50,000 instead of 25,000. Now, here there is an enhanced limit when the SSC, that individual or the parents or HUF any member is senior citizen, the limit has enhanced from 25,000 to 50,000. But this enhanced limit is not available if the individual or HUF is non-resident. Okay, if they are non-resident, then the limit is restricted to what? 25,000 only. Okay, then where the individual or his parents or any member of HUF is a senior citizen. Because they are senior citizen, no insurance company is offering them a medical insurance policy. No insurance company is offering them a medical insurance policy. That's why what they are doing, they are just incurring the actual medical expenditure. Now what this section says, it need not to be premium also. Actual medical expenditure incurred also can be claimed as deduction. 50,000 for self, spouse and dependent children, 50,000 for parents and 50,000 for any member of HUF. Okay, then last one, sir. where the medical insurance premium, instead of yearly, it paid lump sum. For the 10 years, you paid in one go 3 lakhs as medical insurance premium. Can in a single year 3 lakhs can be claimed as deduction? If such a way, your maximum limit is only 50,000. The other amount you cannot be able to claim as deduction. That's why what they are saying now. Check what is the tenure of this policy. You paid 3 lakhs, right? What is the tenure of this policy? 10 years. So 3 lakhs divided by 10 you do. For a year, how much it is? 30,000. So claim that 30,000 as deduction, provided you are a senior citizen. Otherwise, it is restricted to 25,000. Understand? Lump sum na, divided by number of years. Okay, the tenure of that policy. Then that amount, again you check that yearly appropriation amount is there na, that you check whether it is within the limit or not. Hello? Okay, then ETQQB. ETQQB is about what? Royalty income from certain bonds. To whom this deduction is available? This deduction is available only to a resident individual. Only to a resident individual. For that, the royalty income from, okay, what is the eligibility, sir? Resident individual. What he can claim as deduction? When the income is royalty on writing a book. The book should be related to literacy, artistic or scientific nature. Literacy, artistic or scientific nature. Then the royalty amount earned can be available as deduction. What is the quantum of deduction here? The royalty paid in lump sum yearly. Okay, if it is paid in lump sum, royalty amount or 3 lakhs, whichever is lower. Sir, it's not paid lump sum. They are paying like based on number of copies sold. Based on number of copies sold. So the copies will be selling like year after year, year after year. So based on that only you are getting royalty. Then in such case, find out the value of books sold in a year. Then on that 5% you multiply, that is the quantum of deduction available. Quantum of deduction available. Okay, 5% of value of books up to that. Whereas the actual royalty is less than that, na, then that only. Actual or up to 5%. Understand? Then ATTTA and ATTTB. ATTTA, TTB, both are related to interest income only, sir. ATTTA is applicable to individual and HUF, whereas ATTTAB is applicable only to an individual, resident and senior citizen. TTA, they could be resident or non-resident. Okay, under TTA, the interest should be earned from savings account, whereas TTB, the interest could be earned from any deposit. So, okay, from where the deposit could be in a bank, post office or cooperative banks. Bank, post office, cooperative banks. TTB, individual, resident, senior citizen. Okay. TTA, individual or HUF, resident or non-resident. Deposit should be made in savings account, TTA. TTB, any deposit. Okay. Bank, deposit made in bank, post office or any cooperative banks. What is the deduction available under TTA? Actual interest or 10,000, whichever is lower. Under TTB, it is like actual interest or 50,000, whichever is lower. Now, what are the deductions we have discussed, sir? ATC, ATCCC, CCD subsection 1, ATCCD 1B, ATCCD subsection 2, ATD, ATQQB, ATTTA and ATTTB. Okay, out of all these deductions are available under the old regime. Whereas in new regime, only ATCCD subsection 2 is eligible. ATCCD subsection 2 is eligible. Sir, only these are the deductions? No, there are other deductions also. But for the purpose of these two questions which I am going to discuss in this particular video, these deductions are enough. Okay, I'm being specific only to this question, sir, because you know the syllabus is so much there to cover and all. So I want, or my agenda for this 5 hours or 6 hours of class is just that you should be able to do the question 6A, 6B, 7A, 7B crystal clearly without losing 1 mark also. That's my target. Okay. So these are the, okay, ATCCD subsection 2, you cannot avail deduction. Sorry, can be availed as deduction even under the new regime, default regime. See, one more point. ATC. ATC is what? Contribution to an SPF, PPF, LIC. That one is there like 1,50,000. ATCCC. Okay, contribution made to LIC pension fund. ATCCD subsection 1, employee or SSC's contribution to the NPS. Okay, so these three together, it's not just ATC, CCC, CCD subsection 1, all the three has individual limits of 1.5 lakhs. But what ATCCE says means all these three together also the maximum amount of deduction they can claim is 1.5 lakhs only. Okay, so one more point under the new regime, sir, you should understand. Deductions available under 115 BSE. ATCCD subsection 2 is eligible. That I already said. ATCCH. ATCCH means what? Any amount contributed to Agnipati scheme. Okay, there individual will be contributing. Okay, when individual contributes to Agnipath scheme, how much ever the amount he contribute, that is fully eligible for deduction. Whereas central government is making, that is also eligible for, central government is contributing on behalf of this person to Agnipath scheme. That is also eligible for deduction. But such deduction, central government contribution related deduction is available to, can be availed under both new regime as well as under default regime. Then ETJJA. ETJJA is with respect to additional employee cost incurred on recruiting new employees. Additional employee cost incurred on recruiting new employees. On the 30% can be availed as deduction. Such a deduction can be availed under both new regime, old regime. Sir, new regime. 3 Chapter 6A deductions are eligible. One is ETCCD subsection 2. Next one, ETCCH Agnipath scheme related. Third one, ETJJA. Okay, with respect to additional employee cost on new employees recruited. Okay, so with this we have completed the basics part which are needed for us to enter into DTA. The question number 6, as I said already, there will be a 6A and 6B. Both these questions are being asked from the chapter Double Taxation Avoidance Agreement. Okay, and in this also 6A is going to be a theory question, 6B is going to be a problematic question. Whatever are the basics we have discussed till now are majorly related to this problematic question only. Okay, so to solve this 6B DTA related problematic question, whatever is the basic part I discussed till now is very much relevant. So coming to this theory questions, theory is going to be easy one only. There are hardly 6 questions, theory questions. Out of them only there's a chance of, it's going to be asked. So we can certainly believe here, trust here that these 6 questions, one among them will be going to be asked. But for this problematic part only, we need to know the basics and inter-level knowledge also you might have, or else at least if you patiently follow all the questions which I am going to solve now, because there are different models being asked, sir. So there will be around some 10 or 12 problems actually. So all those, look, I'll be explaining, you patiently solve. Okay. So first, what is called double taxation? Sir, to tax any income in a country, usually we follow 2 kind of rules. One is source rule, the other one is like residence rule. Okay, so let's say, let me take an example. There's a person named Mr. Rakesh. So this Rakesh is used to live in India. He's a resident of India, but in the financial year, 1st January only, he left to US. Okay, he got a job in US, he has moved to US. So January, February, March alone he has worked in US. Till now he is in India only. So he is resident of India only, right? Indian rule says like, where a person is a resident of India, an ordinary resident of India, his global income is taxable. That means Jan, Feb, March salary, even though received in US, the 3 months salary is also taxable in India. Whereas US, they are following the source rule. For Jan, Feb, March, he may not be a resident in US, but the source of such income is US only. So the same income, the same salary which he received for Jan, Feb, March will be taxed in India as well as taxed in US as well. Okay, the same income taxed twice in the hands of same SSC. In one country based on source rule, whereas in one country based on residence rule. Okay, in home country, I mean the resident country, tax is an obligation because he need to do that. Okay, because he need to look after his home country because the infrastructure development and all will happen because of this taxes only. That's why it's an obligation. But whereas in the source country, it's a cost. Okay, so income is getting taxed in both resident country and source country. So this is leading to double taxation. This is leading to what? Double taxation. Now, double taxation can also be, or else like, it can also be because of, or can be classified into 2 types. One is economic double taxation. The second one is jurisdictional double taxation. So first of all, let me explain you what is called economic double taxation. So look at this example. X incorporation is located in USA and it has the profits in US which are taxable in US. Quite obvious because it is doing business in USA. It has the profits in USA. So it is taxed in USA. But the shareholders of, the major shareholders of X Incorporation is nothing but X. He is from India. Okay, so now this X Incorporation is declaring dividend to the shareholder who is in India. Now the dividend income, again it is taxable in what? India. So now understand, the same income which is already taxed in the hands of company is given as dividend. After payment of tax, a certain part has been given to the owners on the name of dividend. Now, the same profit, which is already taxed in the hands of company, is again being taxed in the hands of shareholder. So this is called as economic double taxation. The same income taxed in two or more countries, but in the hands of different taxpayers, it is called as what? Economic double taxation. Then jurisdictional double taxation. So jurisdictional double taxation is the one which we are majorly going to talk in this chapter. What is jurisdictional taxation? The same thing, sir. In one country, it is taxed under the residence rule or source rule. Okay, for example, in US, it is taxed under the source rules. But again in India, it is taxed under the residence rule. The same income, same person, but it is getting taxed in US as well as it is getting taxed even in the India. Two or more countries levy taxes on the same entity, on same income for the identical periods. Maybe the same assessment or previous years, okay, identical. Because in India, we follow financial year, okay, I mean April to March as the year. But in some countries, they may follow calendar years, right? That's why they are not saying like the same year, they're calling it as like identical years, okay? So what is called jurisdictional double taxation? Two or more countries levy taxes on same entity, on same income for identical periods. Now double taxation is there, right? So so double taxation is not good for any country, because if I get 100 rupees, on that 100 rupees, 30 rupees Indian government is taking, saying like resident you need to pay tax to India. This 100 rupees earned from US. US is saying like the source is in US, you need to pay 30 rupees in US. Sir, these two governments are taking 30, I'm ending up with only 40. So I'll lose the basic motivation to earn profit also. Understand? And then, okay, so it increases my costs and all. So it's not good in the growing economies to have double taxation. That's why countries enter into treaties. Treaties na some kind of agreements. Okay, so India may talk with US or UK or any other country. Okay, and they'll come into some mutual agreements which are called as treaties. So tax treaties are largely prevent jurisdictional double taxation. Jurisdictional double taxation. So you could see an example here. Mr. Rajesh is a resident and ordinary resident. He has 1 lakh rupees interest income received on FD, which is there in US bank account. So the FD is where? In US. Okay. And from the US bank FD, Rajesh got interest. What is the source? US, right? But Rajesh is a resident and ordinary resident. Since he is resident and ordinary resident, his interest income is taxable in India. Source US, taxable even in USA. So there is what? Double taxation. So, okay. So now, how do we control or how do we eliminate this double taxation? As I said already, treaties. Okay, they'll enter into treaty. What will be there in these treaties? Sir, these treaties might have, these treaties will have some kind of tax relief or tax exemptions. There are methods which we are going to discuss. So these treaties will have either tax exemptions or tax reliefs. Because of that, if the income taxed in one country may not be taxed in the other country, or else the tax which is already paid in a country A may be given as credit to country B, which can be set off while paying taxes in the country B, like that. Either it is like set off of tax paid in the foreign country, or either exemption of income which is already taxed in the foreign country. So like that, there are methods which we are going to discuss now. Double taxation. Sir, again, it's not possible or it may not be available a DTA with each and every country. With certain countries, we might have double taxation avoidance agreements, whereas with some countries, we may not have double taxation avoidance agreements. So the countries which we are having DTAs, either directly our country may enter, or on behalf of our country, any other association or organization may enter. Those are covered under section 90 and 90A. Section 90 and 90A. Sir, again, I said na, first we are focusing on the problematic related part only. That's why this related theory I am not discussing now. As I said, for the 6 year related, there are 5 or 6 theory questions, right? Then again, I'll be revising you the theory once again. Okay. So you don't think about the theory now. DTA. Okay. So this is now with that country, we are having a double taxation avoidance agreement. Then the relief, how the relief will be given is discussed through section 90 and 90A, bilateral relief, because both the countries has agreed. So bilateral relief. There are certain countries with which India doesn't have a DTA. Those are called as section 91, unilateral relief. Only the resident country is giving some kind of relief. but the other country doesn't have any agreement. Okay, unilateral relief, and the second one is what? Bilateral relief. Okay, so under unilateral relief, only the resident country will be giving the tax credit. Okay, see now, bilateral relief. Under bilateral relief, there are exemption method and tax credit method. Within exemption method also, there are two sub methods. What are those? One is full exemption method. The second one is like exemption with progression. One is what? Full exemption method. Whereas the second one is what? Exemption with progression. Then tax credit method. Under tax credit method, there is a direct credit. Okay, direct credit. Under direct credit, there will be full credit. And the next one is like ordinary credit. Under direct credit, one is what? Full credit. And the second one is what? Ordinary credit. And the next one is like indirect credit. Under indirect credit, this underlying credit is one method. Under indirect credit, this underlying credit is one method. And then special credit. This special credit will talks about tax sparing. Tax sparing. So exemption method. Under exemption method, again under exemption method, there are two types. One is full exemption method. The other one is like exemption with progression. With related to tax credit methods, there is a direct credit method. Under that, full credit method, ordinary credit method. There is an indirect credit method which is called underlying credit method. There is a special credit method which is called tax sparing. Tax sparing. Okay, now we're gonna talk about full exemption method. What? Full exemption method. Under this method, the income earned in the state of source is fully exempt in the state of residence. The income earned in the state of source. Okay, state of source is fully exempt in the state of residence. Let's say India, USA are having DTA. Income earned in USA. Okay, so I am resident of India, sir. I have an income in USA. I have an income in USA. Now, I have an income in USA. Now, the source of such income is USA, right? Since it is taxed in USA, such income is completely exempted in India. Then that is called as full exemption method. Okay, we'll see here with an example. Mr. Prabhas, sir, okay, sir, once again repeating, this PDF is available, uploaded there. You could find it like, okay, beneath this video description only, we are giving the link to download this particular file. The whole file you can download and watch it, okay. Mr. Prabhas, a resident has earned the following incomes for the year 24-25. Income from house property in India, but received in UK, 7 lakhs. Sir, income from house property in India, na, where the source is there, sir? House property in India, the source is where? India. Source, India, first point. Second point, royalty on patent outside India. Patent outside India. So, the source is what? Outside India. And past untaxed income brought to India. Past untaxed income brought to India, 2 lakhs. So now, okay, under full exemption method, what we need to do? You tax the incomes, only those incomes for which the source is also in India only. Because if the source is outside India, you're giving exemption, right? Okay. So now, house property income, source in India, na? So you need not to exempt it. Royalty income, source India, na? Outside India, na? Outside India. So you should do what? You should exempt it. Third one, past untaxed income brought to India. Sir, past untaxed income, outside India only, brought to India, taxable. For that, first you need to understand, sir, as per our scope of total income, if any income which was earned, accrued during the previous year is only chargeable to tax. So, the past untaxed incomes brought to India are not chargeable to tax in India. So, you could simply ignore this. You could simply ignore this. First one, 7 lakhs taxable in India. 5 lakhs, since it is taxed outside India, you are ignoring here. So, how do you calculate? Computation of tax liability. Income from house property only you are taking. IFOS, you are not taking royalty and all. Past untaxed income, I said like to ignore now because it was not at all taxable in India. Okay, even if there is no DTA also, still past foreign and untaxed income is not taxable in India. So 7 lakhs. Now, okay, so they are asked to compute tax liability. They said like compute tax liability, but they didn't said under which regime the tax has to be calculated. Old regime, new regime. Sir, we'll calculate in the both the options. See, option 1. Calculating tax under the default regime, 115 BAC. Sir, under 115 BAC, what are the tax rate? 0 to 3 lakhs, nil. 3 to 7 lakhs, 5%. What is the total income here? 7 lakhs. Sir, 7 lakhs full credit, full exemption method. Already royalty has been exempted, 7 lakhs. On this 7 lakhs, 0 to 3, nil. 3 to 7 lakhs, how much? 5%, 20,000. Okay, on this 20,000, you may do a mistake like leaving 4% as cess and finding and taking it as the tax liability. Understand, rebate under 87A, I discussed in the basics. What? Under 115 BSE, a person is allowed to avail rebate until his total income, I mean, when if his total income is within 7 lakhs. Here his total income is what? Within 7 lakhs. So he is eligible to rebate. So rebate has to be calculated before levying cess. So on 20,000, if you adjust rebate, the tax liability will come to nil. Under which method this is? Under the default regime. Now we'll do the tax calculation even under the old regime. Under old regime, 0 to 2.5 lakhs nil na. 2.5 lakhs to 5 lakhs 5%, whereas from 5 lakhs to 7 lakhs it is 20%. Sorry, why 5 lakhs to 7 lakhs we are taken? Total income is up to 7 lakhs. Nah, it's not just the slab is 5 to 7 lakhs. Slab is like what? 5 lakhs to 10 lakhs. In between, how much ever his income is there, on that we need to apply 20%. So 0 to 2.5 nil. 2.5 to 5, 5%, 12,500. In between 5 to 10, 2 lakhs. 2 lakhs into 20%, 40. So the total year tax is how much here? 52,500. Sir, under old regime, can you get rebate? No, because under old regime, to get rebate, the total income should be within 5 lakhs, whereas here it is 7 lakhs. So under old regime, the tax liability will be 54,600. Sir, are you able to understand, right? Full exemption method, na? Whatever is the income taxed already outside India, okay, and the source is also outside India, you just exempt it. Don't even consider that one. Okay. Then the second method is exemption with progression. What? Exemption with progression. Under this method, income from the state of source is considered by state of resident only for the rate purpose. For the purpose of computing the tax rate, you will include, I mean, nothing but you will take all the incomes which are chargeable to tax in India. Okay, you forget about DTA and all. Okay, if there are list of incomes given, na, so you just check whether such income is accrued in India or received in India. Because of any rule, if it is taxable in India, tax it. Calculate the tax liability, levy cess also. Okay, and find out average tax rate. Find out average tax rate. Then with this average tax rate, find out the incomes. Out of all the incomes you included, out of them, find out the incomes which were already taxed outside India. On them, multiply this with average tax rate and then reduce it from the tax liability you have calculated. Okay. Partially understood, na? You need to understand fully, right? Yes, for that only we have an example here. Ramesh, an ordinary resident individual, has the following income for the previous year, 24-25. Income from India, 16 lakhs. Income from countrywide, 10 lakhs. Investment in PPF, Public Provident Fund. Sir, do you recall anything? Can you get it linked to anything? ATC deduction, investment in PPF. Okay, investment in SPF, contribution to SPF, all those will come under what? ATC deduction. Okay, now additional information. India has DTA with countrywide, under which income is taxable only in the source country. However, such income is included for rate purposes under Indian law. Included for rate purpose, nothing but this is what? This exemption with progression method. Okay, income earned in countrywide has already been taxed at what rate? 25%. Compute is tax liability. Sir, they simply said like compute tax liability, sir. They didn't said like old rate or new rate. Sir, when they didn't said anything, you need to take it as like default tax rates. What are the default tax rates? 115 BSE are the default tax rates. Okay, you cannot even take assumption also. If they simply say like compute tax liability, you should take what? The default tax rate. Okay, so income from India, how much? 16 lakhs. Income from countrywide, how much? 10 lakhs. Okay, taken together 26 lakhs. Sir, now this ATC deduction we can take now. Can we take now? No. Why? We are calculating tax here 115 BSE mode. Under 115 BSE, Chapter 6A deductions are not allowed. Only 3 are allowed. What are those? ATCCD subsection 2. ATCCD subsection 2. Contribution by employer to NPS. Then next, 80JJA. Okay. Then 80CCH. Only those 3 are allowed. Others are not allowed. So that's why under 115 BSE you cannot avail Chapter 6A deduction, sir. So many students might do mistake here. Please be cautious when you are doing tax under 115 BSE. Only 3 Chapter 6A deductions are allowed. Be very clear. Okay. Total income 26 lakhs. On this you need to compute tax liability. Sir, I already said in the morning also, while explaining the morning, like in the introduction part when I am discussing. Okay. 0 to, okay. 0 to 3 lakhs nil, 3 to 7 lakhs 5%, 7 to 10 lakhs 10%, 10 to 12 lakhs 15%, 12 to 15 lakhs 20%. That and all I said. But there we wrote a line also. I have clearly said a line there also. On first 15 lakhs, the tax liability will be 1,40,000. On first 15 lakhs. Here also, if you need, check here. First 15 lakhs. 1,40,000 only, na? So, sir, once you remember, first 15 lakhs, 1,40,000, your job or your computation will become faster. First 15 lakhs, 1,40,000. 26. Out of them, first 15 lakhs, 1,40,000, na? How much is there? 11 lakhs. 11 lakhs into 30%. 3,30,000. 3,30,000 and this. Okay, sir, you don't need calculator also for that. Just within. Okay, your brain itself can calculate. Once you remember, first 15 lakhs tax. First 15 lakhs tax under default regime is like 1,40,000. Above 15 lakhs, 11 lakhs is there. 11 lakhs into 30%, 3,30,000, and add that 1,40,000, you will be getting 4,70,000. And add cess 4%. How much? 18,800. Tax. So now we'll be moving on to the tax credit methods. Under tax credit methods, under direct credit, there is full credit, ordinary credit, and then there is even tax pairing and all also, underlying credit and all. Okay. So now full credit. What does it mean by full credit? Tax paid in the state of source is allowed as credit against the tax payable in the state of residence. That means, let's say, in state of residence, the tax is 1,10,000. Whereas already, okay, nothing but considering the foreign income also, even though it was taxed in foreign country, as per residence rule, it is taxable in India. Na? Take all those incomes, calculate the tax normally only. Okay, once you calculate the tax, whatever is the, okay, you calculated the tax, right? Including all the incomes, you calculated tax as normally only. Let's say it came to 1,10,000 is the tax. From there, subtract the tax you paid in foreign country. Let's say 60,000, subtract. Then the balance only you pay. This is called as full credit method. Full credit method. Next one, ordinary credit. Here, the difference between the full credit and ordinary credit is like the same way you will compute tax. Okay, assume the tax has came to 1,10,000. 1,10,000 came to 1,10,000. The tax paid in foreign country is 60,000. But now you will not directly subtract 60,000. What you will do is like the tax in foreign country is 5 lakhs. The tax in foreign country is how much? 5 lakhs. Now you will bring proportionate to the top 5 lakhs into 1.1 lakh divided by, let's say, Indian income is like somewhere like 10 lakhs. Okay, the total, this 1.1 lakh came on 10 lakhs. Okay. Okay, let me make you little more clear for you. Sir, Indian income 5 lakhs. Country X income 5 lakhs. Total 10 lakhs. Na? On this 10 lakhs, what is the tax? 1,12,500 plus cess into 4%. How much it comes to? 4,500 you need to add. So how much it came to total? 1,17,000, right? On country X income, they already paid in their country 60,000. Full credit method means what you will do? You will directly subtract 60,000. Now what ordinary credit method says means the relief under section 90 is nothing but 60,000 or how much is the tax here? 1,17,000. Okay. How much is the country X income? Okay, 5 lakhs, right? So 5 lakhs into 1,17,000 divided by 10 lakhs. So okay, out of these two, whichever is lower, na, that only will be given as credit, not the full amount. Okay, you could look at the theory here. State of resident allows credit of tax paid in the state of source, restricted to that part of income tax which is attributable to, the income tax bill in the state of residence. Okay, you'll do this with this example, sir. Prabhas, resident has earned the following incomes in the year 24-25. Income from house property 7 lakhs. Royalty income 5 lakhs. Past untaxed income, already said. Past untaxed income, do we bother about it? No, it is not at all taxable in India, so ignore this. But this royalty income, sir, now we need to include. Sir, the same example we did in the full exemption method. There, 5 lakhs, what you did? You completely ignored there. But we are not doing now full exemption method. We are doing what? Credit. So you take this 5 lakhs, 7 lakhs, compute tax. This 2 lakhs past for untaxed income, ignore. Okay, because that is not taxable in India. So 12 lakhs is the total income now. See, sir. Income from house property, how much? 7 lakhs. Income from other sources, okay, 5 lakhs. Sir, here while calculating income from house property, we have assumed like the standard deductions, all those are already allowed. It's a computed one, okay, 5 lakhs. What is the total income? 12 lakhs. On this 12 lakhs, compute the tax liability. On first 10 lakhs, sir, how we are computing tax? Computing tax under normal provisions. That means not under the default provisions. Under the old regime, we are calculating. On first 10 lakhs, 1,12,500. Greater than 10 lakhs, 60,000. Total 1,72,500 is the tax. On that cess 4%, 6,900. What is the total liability? 1,79,400. 1,79,400 is the total tax liability. From there, this is the royalty income which is outside India, right? But it is taxed in India. Na? With respect to this, what is the tax paid in foreign country? 75,000. In ordinary credit method, we'll be subtracting, in full credit method, we'll be subtracting this full 75,000. Okay, so that means the credit allowed under full credit method is 75,000. Subtract 75,000. So the tax payable will be 1,04,400 if it is full tax credit method. Full tax credit method. When it comes to ordinary method, okay, it comes to the ordinary credit method. How it has to be done? Same here, sir. Till tax liability it is same. Okay, 1,79,400. Tax liability 1,79,400. What you need to do? How much is the tax paid in foreign country? 75,000 or 1,79,400. This tax into 5 lakhs is the foreign income. The total income is 12 lakhs. You do that. How much it came? 74,750. So 75,000 or 74,750, whichever is lower is given. So 74,750 is the credit given under which method? Ordinary credit method. So the tax payable is how much? 1,04,650. Okay. So now tax sparing. What does it mean by tax sparing? Means there are two countries, sir. Country A, country B. In country B, there is 10 lakhs profit. Okay, sir, country A is not country B. Okay, there's a X Limited. It has 10 lakhs profit. Okay, so nothing but, okay, there's a branch of X Limited. X Limited has a branch in country B. It has 10 lakhs profit. This 10 lakhs profit is exempted in country B. Is exempted in country B because of some reason. Now, this 10 lakhs profit is in the branch na. But in country A, the full profit of X Limited is taxable. That means this 10 lakhs even taxable in country A also. But now this 10 lakhs is exempted in country B. Na? That means it was not taxed in foreign country. Only being taxed where? Country A. Okay. But what does there is no double taxation here because it was not taxed in country B. It was exempted in country B. So this exemption is not because of double taxation and all. Okay. Maybe like this was, okay, this branch was set up in an SEZ area. Since it was set up in an SEZ area, the country B has given exemption. Okay. But now this branch income is even taxable in country A. But when in country A, when they are taxing, usually double taxation is there, na, that tax paid will be given as credit. But under tax paying method, even though tax is not paid in the foreign country or the other country, you assume like the tax has been paid and the deemed tax paid will be taken as credit. Deemed tax paid will be taken as credit. See, state of resident allows credit for deemed tax paid on income which is otherwise exempted from tax in the state of source. See an example. A Limited, the parent company in country X. It has a branch in country Y. Branch and 10 lakh profit. So branch has 10 lakhs profit. Company X takes resident on global income. So country X, what does it says? On its residents, global income, wherever they get income, they'll tax. I mean, this branch 10 lakhs is also taxable in country X. Tax rate in country Y is 25. Okay. However, as a measure to promote economic development therein, in country Y, there is no tax on this particular branch. That means in country Y, on the 10 lakhs profit, there is no tax. But in country X, A Limited is there in country X. So this 10 lakhs will get again taxed in country X. What tax paying says? Look at the solution. The total income of country Y is taxable. Okay, 10 lakhs. No tax there. Total income in country X is how much? The branch income only, 10 lakhs. Okay. If you see the tax on above before relief. Sir, why tax? Global income. What rate in country X? 30%. So on this 10 lakhs, levy the tax rate at 3 lakhs. Okay. Now, did they paid in tax in country Y? No, no. They didn't pay any tax in country Y, right? Because in country Y, it was exempted. But this tax paying method says like, even though didn't pay tax in country where assume as paid, if at all it paid, how much they'll pay? 10 lakhs into 25%, 2.5 lakhs they'll pay. So that 2.5 lakhs, even though not paid, take it as relief. The effective tax payable is how much? 50,000. Okay. Then underlying tax method. Sir, underlying tax method works only in case of economic double taxation. It tries to mitigate what? Economic double taxation, where same income is taxed in more than once in the hands of different persons. Nothing but X Limited as profit. The profit is already taxed in the hands of X Limited. Once the same profit is again declared as dividend to X, again it will get taxed in the X hands, right? So to address that only, this underlying tax method will be working. So not much significant for the purpose of exams and also. Okay. So now we'll be moving on to the very important method, sir. All the past exams, the question is from there. All the mock test papers, the question is from there only. So we'll be moving on to unilateral relief, where there is no agreement between the foreign country and India. So I mean where there is no DTAA, then we'll be following the unilateral relief. Okay, under unilateral relief, okay, here also relief will be given, sir, but only given by the resident country. With respect to the tax paid in the source country, country will give a relief. That is called as unilateral relief. Mostly the questions are being asked from here only. So very important topic. Even I discussed the basics related to deductions, the tax rates, all these will get linked here. The house property thing I have said, the salary standard deductions I have said, like 115 BSc linked, how it works and all. So all these will come here. So each and every problem has one or two different points. So it's needed. So you just focus on the problems which I am going to cover now. SSC, okay, to get this unilateral relief, SSC must be resident in India. The income should be, okay, on which you now need to find the unilateral relief. Such income should be derived from foreign country. Such income should be derived from foreign country. And income not deemed to be accrued or erased in India. SC resident in India. Income derived from foreign source and not deemed to be accrued in India. So tax should have been deducted or paid in foreign currency, and there is no DTA. So to apply unilateral relief, what are those conditions? First one, SC must be resident. No DTA. Income derived from foreign source and it is not deemed to be accrued in India. Tax already deducted on it or paid in foreign currency. Okay. Now how do we do the sums under the DTA unilateral relief model? First, as if like how you are doing the previous sums now, forget about whether it is Indian source or foreign source. Okay. If it is taxable in India, see, for a resident, global incomes are taxable, right? So such a way only take all the global incomes which are going to be taxed. If any deductions are there, take the deductions. If any set off carry forwards are there, take them. If any standard deductions are available, take them. If any exemptions are there, take them. So compute the net total income and calculate the tax on it. Normally, okay, if there is no such kind of DTA and all, how do you calculate? The same way, calculate the tax payable. Then calculate even the average tax rate also. Done. Then we need to find out the foreign tax rate. Sir, sometimes in the question itself, they'll give straight away the foreign tax rate. If it is given, no problem. If the foreign tax rate in the question is not given straight away, then we'll be calculating. How do we calculate? Find out the rate at which tax paid or deducted in foreign country. Okay. How we calculate? Tax in foreign country. So tax might have deducted or paid, right? That on divided by income in foreign country as per their law. How much is the income they will be treating? That, okay, if you do that, you will be getting the foreign country tax rate. You got Indian average tax rate and the foreign country tax rate. Take whichever is lower and multiply it with the double taxed income. Multiply it with what? Double taxed income. Okay. Take whichever is lower, average tax rate or the foreign country tax rate, and multiply it with what? The double taxed income. Sir, understand? Here income in foreign country as per the law and double taxed foreign income. Okay, some cases this may not be same, but very simple, understand? Okay, as per foreign country, whatever is their income now, that you should take for what? For computing the foreign country tax rate. But when you are calculating the relief, how do you calculate? Double taxed foreign income into whichever is lower rate. Okay, let us go into the questions. Mr. Ranjan, a resident Indian, has derived the following incomes for the previous year relevant to assessment year 25-26. Income from profession, 9,54,000. Royalty on books from foreign country, 8 lakhs. 3 lakhs is eligible for deduction under 80QQB. Sir, if you remember 80QQB, deduction I have discussed. Okay, how much? Okay, 3 lakhs or the actual royalty, whichever is lower. If it is paid what? Lump sum. The tax paid in foreign country is at 20%. Sir, if you see here, they have given the foreign country tax rate straight away. So do we need to calculate once again? No. They have given profession 9,54,000, 8 lakh royalty. So compute Indian tax liability if he has opted the old regime. So old regime now, how much is the total income, sir? 17,54,000. On this, you need to avail 80QQB deduction. Why? Because here they asked us to calculate the tax in which regime? Old regime. New or the default regime na deductions are not allowed except those three. What are those three? 80JJAA, 80CCD subsection 2, 80CCH. Except those three, none of the deductions are available. So here the deduction available is 3 lakhs. If you subtract 3 lakhs, how much it is? It would be 14,54,000 on this tax. You need to calculate. On first 10 lakhs under old regime, how much is the tax? 1,12,500. And on the balance 4,54,000, 30%. So if you do that, you will be getting 2,48,700 as the tax. On this cess, you need to levy at a rate of 4%. Then what is the total tax paid, sir? 2,58,648. 2,58,648. You should divide it by what? Okay, this is the tax. So 2,58,648 divided by 14,54,000. 2,58,648. This is the tax. With what you are dividing 14,54,000. This is what total income into 100. You got the 17.79 average tax rate. Then foreign country tax rate we need not to calculate. They given straight away 20%. Whichever is lower. Which is lower? 17.79. Now out of the incomes, which is the double taxed income? 8 lakhs. But out of this 8 lakhs, this the total 8 lakhs taxed in India? No, right? With respect to this 8 lakhs, there is a deduction available. Okay, with respect to this 8 lakhs, there is a deduction available. So how much income is only taxed in India? Maybe outside India 8 lakhs got taxed, but in India only 5 lakhs is taxed. So you should apply 5 lakhs into 17.79%. You'll get 88,950. So the tax payable will be rounding off and it comes to 1,69,700. Okay, is it clear? Then come to question number 3. Shubham, a sports goods merchant and resides India in doing business in India and abroad. During the previous year, he has disclosed the following information. He has disclosed the following information. Income from business in India, 28 lakhs. Income from business in country A with which India does not have DTA, 12 lakhs. Tax paid there, 3 lakhs. Loss from business in country B with which India does not have DTA, 5 lakhs. Contribution to PPF. Sir, contribution to PPF, where it is covered? ETC. Payment of life insurance premium on the life of his father and mother, ETC. But together, 1,50,000 is only given. But they asked to compute the tax liability. Sir, they didn't mention which method. But for assessment year 25-26, if they didn't mention any method, now what you should consider? You should assume it as like what? Default method. Default method. You should calculate it in default method only. So quickly, I'll solve the answer for you, sir. Okay. So there are totally what incomes? PGBP incomes only. All the incomes are from PGBP only. Income from business in India. Business in India. How much is from the business in India? 28 lakhs. And this person has business where? He has business even in country A. Business in country A. From country A, how much income he got? From country A, he got 12 lakhs. From country A, he got 12 lakhs. Then loss from business in country B. Loss from country B, 5 lakhs. Sir, 5 lakhs, why you are adjusting? Under the head PGBP, loss from one source of business or one business can be set off with another business. So we are setting off here. So after setting off, how much is the PGBP income now? 40 minus 5, it will be how much? 35 lakhs. It will be 35 lakhs. On this, can we take ATC deductions? No, because under which regime we are calculating? Default regime. So no deductions are allowed. Deductions under chapter 6A not available. So what is the net total income? 35 lakhs. On this 35 lakhs, you need to calculate tax. What is the tax amount, sir? On 15 lakhs. Under default regime, first 15 lakhs. How much is the tax, sir? 1,40,000. In an excess of 15 lakhs, how much is there? 20 lakhs into 30 percentage, 6 lakhs. So the total tax is how much? 7 lakh 40,000. On this cess we need to levy at a rate of 4 percentage. Cess we need to levy at a rate of 4 percentage. How much it is? 29,600. So if you take here 29,600, how much? 7,69,600 is the tax payable. Tax payable. Then immediately what we should find out? We should find out average tax rate. How do we calculate average tax rate? 7,69,600. This is the tax rate divided by 35 lakhs into 100. If you do, you will be getting the average tax rate. How much is that average tax rate? 21.99 percentage. 21.99 percentage. Now we need to get even the tax rate in foreign country. Tax rate in foreign country. What is the tax rate in foreign countries are directly given out? No. The tax rate, sir, country B anyhow loss, ignore. Country A, what is the tax rate? Nah, they didn't given, but they mentioned the tax amount. So tax rate in foreign country, take the tax in foreign country 3 lakhs divided by the income which is being earned in foreign country or taxable as per foreign country law, 12 lakhs. So 3 lakhs by 12 lakhs, if you do, you will be getting the foreign country tax rate. How much, sir, it is? 25 percentage. Now 21.99 or 25, which is lower? 21.99. So the relief under section 91. Under section 91 equals to 12 lakhs is the double taxed income, right? Country A also it is taxed, India also taxed. Sir, country B it is lost, so forget about it. So 12 lakhs into 21.99 percentage, if you do, you will be getting the relief amount 2,63,880. Okay, from this 7,69,600, you should subtract this 2,63,880. You will get it as like how much? 5,05,720. Clear? Okay then. Question number 4. Miss Kavita, aged 63 years, is a resident individual and a classical dance performer. During the previous year 2025, she earned income from India as well as from country X. India does not have DTA with country X. Her income and investments are as follows. She has rental income from residential house property located in country X, 28,000 XCD. Municipal taxes paid 250, conversion rate 70. Sir, whenever a house property comes, adjustment comes now, you should remember this. What you should remember? You should remember that income has to be calculated under what? Under the head house property. So when you are calculating the income under the head house property, how do we do? First, you should take the rental income which they got as the gross annual value. That is how much? See, I'm solving for you quickly. Income from house property. How do we calculate income from house property here? We are having 28,000 exceeding. What is the conversion rate? 70. So 28,000 rent received equals to 28,000 XCD into 70. Okay, you'll get an amount. How much? 19,60,000. 19,60,000. Then you should subtract what? Municipal taxes. So this rent received itself is the GAV. You should subtract municipal taxes. Municipal taxes, how much are here? 250. Municipal taxes you should subtract 250. Then you will be getting NAV. How much is the NAV you will be getting, sir? 19,42,500. 19 lakh for, okay. Municipal taxes also paid in XCD only na. 250 into 70. If you subtract 19,42,500 is the NAV. Sir, I said in the initial introduction, house property related adjustments also. From NAV, what we should subtract? 30% standard deduction you should take. Many students will forget this. You should not forget this. 30% standard deduction you should take. See. So if you take 30% standard deduction, 5,82,750, then the income from house property is 13,59,750. Done. Okay. This adjustment we have did. Then professional income from, then what? Professional income from concerts held in India, 16 lakhs. Professional income from concerts held in country X, 11,200. 11,200, what you should do? Again, multiply it with 70. Interest income from fixed deposit. Sir, these 2 and 3 are from PGBP head. Professional income from concerts in India, 16 lakh. Provision from concerts held in country X, 11,200 into 70. This is from income from house property. Now, interest income from Indian Bank FD, 3,25,000. Interest from Indian Savings Bank account, 18,269. So, these are like what? IFOS incomes. These are like what? IFOS, income from other sources. Then investment in PPF. Sir, investment in PPF na 80C deduction. Here, interest from Indian Bank FD na FDs, 80 TTB, if you remember. A resident, senior citizen derives any interest income from any deposit from bank, cooperative society, post office, then 80 TTB. Then interest from Indian Savings Bank account, then the deduction will be under 80 TTA. Then investment in PPF, 80C. 5-year deposits in the name of son not eligible for deduction. They only said medical insurance premium for self 27,000, for spouse 31,000. 80D. So all these are the deductions. Tax paid in country M is how much? 20%. Kavita has not opted 115 BAC. That means all these deductions will come relevant. 80C, 80D. Sir, under 80D, how much is the deduction we can avail? 27,000 and 31,000. Okay, together if one of them are senior citizen, we can avail maximum of how much here? 50,000. Here 1,50,000. Okay, interest on bank fixed deposits are 80 TTB, 50,000. But understand, sir, when 80 TTB and 80 TTA you cannot claim simultaneously. 80 TTB and 80 TTA both not available. So this 3,25,000 plus 18,269 together you are claiming deduction where 80 TTB. The maximum deduction available is how much? 50,000. Both cannot be availed. Only one. So only one he'll be availing what? 80 TTB. Sir, clear, sir? House property income will calculate PGBP 16 lakhs plus 11,200 into 70. Then interest income from Indian FD 3,25,000. Then interest from Indian Savings Bank account. Okay, IFOS. Then you will be taking what? Deductions. See, from concerts in India 16 lakhs. From concerts in country Y 7,84,000. Together it is how much? 23,84,000. Then interest on fixed deposits 3,25,000. Interest on savings bank deposits 18,269. Together 3,43,269. So the gross total income is 40 lakh. Then okay, we have income from house property, PGBP, IFOS. That's what we have at PGBP, house property, PGBP, IFOS. Then deductions. What are the deductions available? 80C. First 80C. How much, sir? 1,50,000. Under 80C, 1,50,000 is allowed. Then 80 TTB and 80 TTA we cannot avail together. Only one. So how much? 50,000 under 80 TTB. 50,000 under 80 TTB. Then medical insurance premium 80D. How much? Maximum of 50,000. So if you subtract all these deductions, 2,50,000, then the total income is 38,37,019. The total income rounded off to 38,37,020 total income. On this compute tax, default regime, old regime, old regime. Old regime means what? First 10 lakh, 1,12,500. On the balance, 30%. So it is like 9,61,106. HEC at a rate of 4%. How much? 38,444. So then the total will be 9,99,550 is the total tax and cess payable. Now we need to find out what? Average tax rate. What is the average tax rate? 9,99,550 divided by this 38,37,019. We'll get 26.05 as the average tax rate. Whereas the tax paid in foreign country, sir, one simple thing they give is like, you need not to compute the foreign country tax rate. They themselves given directly. How much? 20%. If you take the 20%, whichever is lower, na, foreign country only 20% lower. Now, you need to find out the double taxed income. What is the income double taxed? House property income. House property income, how much? 13,59,750. Then this professional income, 11,200 into 70, 7,84,000. So these two are the double taxed incomes. So take those double taxed incomes and multiply it with 20%. You will get the unilateral relief, 4,28,750. The balance tax payable is 5,70,800. Are you able to follow right? So moving to next question. SSC is a popular Kollywood star, Mr. Sohan Lal, He has business interest in few other nationals as well. He is a resident in India for the assessment year 25-26. Income and India by Mr. Shonlal during the year ended 31st March 2025 are as follows. Income from house property 4.3 crores and given directly, sir. So that means he has income from house property. Then business income from being the owner of cricket team Hyderabad. So business income, they directly said like PGBP. Acting in movies, his profession is acting in movies, PGBP. So you have house property income and PGBP income. Then Sohan Lal has deposited 1.5 lakhs in PPF, ATC. Life insurance premium 1 lakh. Together, these two are what eligible for ATC. The details of income earned by him from two countries outside India, X and Y, with which India does not have DTA during the previous year 24-25 are as follows. Okay, he has loss from house property, loss from house property. So the loss from house property can be set off with income from house property. Sir, I said under 115 BAC, okay, beginning of the topics also, like when I am discussing introduction, okay, if you cannot recall it, go back, see there and again come back, sir. So what I said, the loss from house property can be set off with another house property income, but such loss to set off with other heads under new regime 115 BSc, the default regime, you cannot set off with other heads if it is a let out property or self-occupied property. But under the normal regime, you cannot set off even with other heads also, but up to an extent of only 2 lakhs. Okay, so here within the head only 4.3 crores is the income from house property, loss 1.3 possible. So this is also under PGBP. Business income, so they said directly like it is what business income, PGBP. Sir, what is this one? Share of income from partnership. Share of income from partnership. From partnership firm, if you receive any share of income, that is also taxable under the head PGBP only. Sir, there is an exemption with respect to 10 subsection 2A. The partner receiving the share of income from partnership firm is exempted. But such exemption is available only that partnership firm is in India. Here the firm is there outside India, country X. So exempt when the firm is in India. When the firm is in India. Here it is outside India, na? So no exemption. No exemption. Agriculture income. Sir, agriculture income also, as per 10 subsection 1, there is exemption when the land is situated in India. But whereas here the land is situated where? Outside India. The land is situated outside India. Hence here also exemption is not available. So these are PGBP, agriculture income is taxable under IFOS. So we have identified the house property related, loss from house property, not PGBP, sir. House property. So under each head, you include them, the Indian income and the foreign country income, and calculate headwise first. Okay. Then in country X, share income is not exempt and loss from house property is not eligible to set off. Okay. And in country Y, agriculture income is chargeable to tax. Sir, we don't first bother about what happens in the foreign country. We assume or we think only what happens in India first. Like that only you will calculate tax and you calculate average tax rate. In country X, he has paid income tax of 2.16 crore and in country Y 80 lakhs. Why these are? To compute the foreign country average tax rate. Compute his income tax liability for the assessment year 25-26, assuming that he has opted for section 115 BSc. 115 BSc. Now see, sir. Computation of tax liability of Mr. Sohanlal. First, income from house property. How many are there? Here there is gain computed. You need not to take standard deduction and all because it is already computed. So take the income from house property 4.3 crores. From there set off the loss 1 crore 30 lakhs. You will be getting net income from house property. How much, sir? 3 crores. Okay, then PGBP. PGBP. How much income we are having in PGBP? 12.4, 9.415 and then this 7.2 and 4.8. So take all those. 12,40,000, 9,41,000. This is from where? India. Business income from country X 7 crore 20 lakhs. Business share of income from foreign from 4 crore 80 lakhs. Total 12 lakhs. And then from country Y also there is business income. How much? 2.9 crores. Take that also. Okay, 2.9 crores. So add all these. The total business income has came to 36 crore 71 lakh 50,000. And then agriculture income from country Y 1 crore 20 lakhs. So total 40 crore 91 lakh 50,000 is the total 40 crore 91 lakh 50,000 is the gross total income. Gross total income. Sir, here they have said like opted or not opted or? Assuming that he has opted for section 115 BSc. Sir, once he opted for 115 BSc, these ATC deductions are not available. So don't forget about ATC deductions. You got what? Net total income 40 crore 91 lakh 50,000. Okay. Tax. How to calculate tax on this, sir? First 15 lakhs separately, and on the balance you'll be doing 30%. 15 lakhs, 1.4 lakhs, balance into 30%, you'll get the tax. Sir, here one important point which you commonly forget is like surcharge. The total income is how much? 40 crores. 40 crores. Surcharge is applicable, right? Yes. What is the surcharge rate? 25% is the surcharge rate applicable. 25% is the surcharge rate applicable. Okay. Why? 0 to 50 lakhs, nil surcharge rate. 50 lakhs to 1 crore, 10% is the surcharge rate. 1 crore to 2 crores, 15% is the surcharge rate. Above 2 crores, 25% is the surcharge rate under the default regime or the new taxation regime. So take surcharge and then add it together on this levy, health and education cess. You will get tax liability. Okay. So tax liability. Calculate here till here. Then we'll be going to working notes. So till here it is clear now. Nothing we did. We taken the house property income, we have taken the PGBP income, we have taken the agriculture income, calculated the tax amount. Now we need to find out average tax rate. What is the how do we calculate average tax rate, sir? The average tax rate is like 15 crore 91 lakh 6500 divided by 40 crore 91 lakh 50,000. If you do, the average tax rate has came to 38.9%. Next, average rate of tax in country X. Sir, country X related incomes are what? It has a loss from house property. Okay, but if you, sir, when I'm explaining this provision also, see here, income in tax in foreign country we should take. How much? It is given straight away in the question, 2 point something has been paid. But denominator, numerator you are taking the tax in foreign country. Denominator you should take what? Income in foreign country as per their law. As per their law, what is the income in their country? Okay, in this particular example, see, as per their country, 7.2 crores and 4.8 only. Why not this 1.3 crores house property loss is not being eligible for set off? Why not? Now, because they said clearly in country X, share of income is not exempt. So consider loss from house property is not eligible for set off. So don't set off. Leave 1.3 crores. So total it is how much? 12 crores. Sir, again, this is the point where the students will do mistake. Surcharge will forget. And then here taking the denominator, he may adjust 1.3 crores also. No. What is taxable in foreign country? 7.2 crores taxable. No exemption on share of profit, 1.8 crore taxable. And loss from house property, it is not eligible to set off. Then the loss will remain like that only. It is not eligible to set off. So then what is the income taxable there? 12 crores. So 12 crores, 2.16 divided by 12 crores you should do. How much you will get? 18%. Then average tax rate in country Y. Country Y simple, sir. Because with respect to country Y, what is the income? 2.9 crore and 1.2. Total 4.1 crores. Whereas with respect to tax pay, 80 lakhs. 80 lakhs by 4.1 crore. You'll get the tax rate as how much, sir? 19.512. 19.512 as the tax in country Y. Clear, right? Okay. Now, coming back to the relief calculation. Deduction under 91 in respect of double taxed income in India and country X. Business income is how much they are having? 7 crore 20 lakhs. Taxable share income from 4 crore 80 lakhs. But again, we are subtracting loss from house property. Sir, why we are subtracting loss from house property? See, 12 crore is taxable in country X. I already said here, 12 crore is the amount which is taxable in country X. But in India, do we tax to 12 crores? No, right? What we have did, this 1 crore 30 lakhs we have given as set off in India. Okay, so in India, 10.7 crores is only taxed. But whereas in country X, 12 crores is taxed. So now, to what extent there is double taxation? To this extent of 10.7 crores only there is double taxation. So relief has to be applied only on the income which is double taxed. But whereas while calculating for average tax rate, you should not take only the double taxed income 10.7 crores here. You should take what? 12 crores. How do we got 12 crores? The total income derived from foreign country and which is taxable in foreign country, that we have taken. I hope the point is being clear to you. Okay. So which rate we should apply, sir? Lower of them. Lower of them, 18 or 38.9. Which is lower? 18% is lower. So if you apply, then the double taxation avoidance relief under 91 with respect to country X is 1 crore 92 lakh 60,000. And again, with respect to country Y also, 19.512 rate is only lower. What is the double taxed income with respect to country Y? Both the incomes, business income, agriculture income, 4 crore 10 lakh, multiplied with 19.512, you will get 80 lakhs as the deduction. So reduce both the deductions, you will get the net tax liability. So very simple provisions are here. You are calculating under 115 BSc. No deduction is allowed. That is one point of importance. Loss from house property, set off. Loss from house property is eligible for what? Set off. Okay, then you have what? This calculation. So the crux point where many students will do mistakes is here only. If this point you are taken clearly, then it is done. Okay. So these questions which I solved till now are from where? Workbook. Now I am moving on to MTP question. Mr. Amar, an individual resident in India receives the following payments after TDS. These are after TDS. Sir, after TDS now you should do what? You should take what? Gross amounts. This is the net amount. You should take what? Gross amount. Okay, after deducting TDS, he has received 2,40,000 and he has received 1,60,000. On both these services, TDS of 50,000 and 30,000 respectively has been deducted. So TDS deducted, sir. We want gross amount. So what we will do? We'll add the TDS amount also. Professional fees not taxable under which head? PGBP. So both these are under PGBP. PGBP. What you will do? You will add 50,000 here. You will add 30,000 here. So total it would be like somewhere 4,80,000. And to earn this income, he has incurred expenditure of 2,40,000. Sir, under income tax PGBP head, to earn an income, if any expenditure is incurred, then that is eligible for deduction. Then his income from other sources is 5 lakhs. He has made payment of 70,000 towards LIC. Sir, LIC na ATC deduction. Compute the tax liability under old regime. Compute the tax liability under where? Old regime. Okay. So how do we compute? See, first we are taking the professional receipts. Professional receipts. 2.4 lakhs plus 1.6 plus the TDS amount also we are adding 4,80,000. From there we are subtracting the PGBP related expenditure 2,40,000. So net PGBP income is how much? 2,40,000. Then we have IFOS income 5 lakhs here. Okay, then take that IFOS income 5 lakhs. What is the gross total income? 7,40,000. 7,40,000. From there, this fellow has made payment of 70,000 towards LIC. Made payment of 70,000 towards LIC. So when you made payment 70,000 towards LIC, that is eligible for what? That is eligible for what? ATC deduction. So subtract that 70,000 also. The net total income is how much? 6,70,000. 6,70,000. On this calculate tax and cess. 48,360. So till here it is done now. Till here no problem, right? No. What is the tax rate in foreign country? Did they given a? No. But how do we calculate tax in foreign country? 80,000 is the tax paid divided by, again, 80,000 divided by, we should do what? 4,80,000, because 4,80,000 is the income which is taxable in country, foreign country. Sir, where it is given, sir? Sir, even though it is not given, they didn't mention clearly that these expenses 2,40,000 are eligible for deduction or eligible for set off in foreign country also. They didn't mention that point. So we are taking a deemed assumption that this 2,40,000 is not allowed as an expense in foreign country. Since it is not allowed as an expense in foreign country, this 4,80,000 totally it is taxable in foreign country. That is one thing. And even TDS is deducted on full amount now. So that's why we'll be considering what? The total 4,80,000 is taxable in foreign country. That's why while calculating average tax rate, we are taking 4,80,000. So 80 by 4,80,000 into 100, you get the foreign country tax rate. How much, sir? 16.67%. Whereas the average tax rate in India is how much? 48,360 divided by 6,70,000 into 100. We got how much? 7.218%. 17.218%. Out of these two, whichever is lower, 7.218%. Now, this 7.218% has to be applied on 4,80,000. No. Double taxed income only. Sir, understand again. The same logic came in the previous example also. Previous question also. Here, the total receipts are 4,80,000. 4,80,000 is taxable in country, foreign country. But in India, do we tax 4,80,000? No, right? We have allowed expense as deduction. So 2,40,000 only taxed. So double taxation relief is given only on 2,40,000. So 2,40,000 into 7.218%, you will get 17,323 as the deduction, and the tax payable is rounded off to 31,030. Hello, are you able to understand? Is it clear? Is it clear? Okay, then. Sir, in all these questions, we are having foreign incomes, right? Those foreign incomes we are considering, if at all they are taxable, because he is a resident, global incomes are taxable. So foreign incomes also we are considering them. If any exemption deductions are available, we are providing them, calculating tax and all right. If a foreign source income is given in foreign currency only, now how do we convert that foreign source income into Indian currency? For that, there is rule 115. For that, what there is? Rule 115. This rule 115 will tell how a income which is in foreign currency can be converted into Indian currency. Which rate has to be used? Okay. Which rate has to be used? Not TTBR rate. Which rate? TTBR rate. Now, for salary, interest on securities, dividend, you should use the TTBR rate. Which day TTBR rate? Before month, last day to month, which salary interest is due or dividend paid. Sir, the salary is or interest became due in May, or the dividend has been paid in May. May is the current month. What is the last month of May? April. April last day, na 30th April. That should be taken as the base. On 30th April, whatever is the TTBR rate, that should be taken as the base. For the interest became due in May, salary became due in May, or dividend received in May. In respect of house property income, PGBP income, IFOS income, then you should take the TTBR rate as on the last day of relevant previous year. On which day, sir? Last day of relevant previous year. Okay, sir, very simple, sir. Salary, interest or dividend. Dividend na paid only you should take. I mean received only you should take. Okay. In which month they have been accrued or received? Take that month. That preceding month last day TTBR rate you should take as the base for converting them. If it is IFOS income, house property income, PGBP income, not the last month, last day TTBR rate. It's like the last day of relevant previous year. So previous year is 24-25. The last day na 31st March 2025. That rate you should take. Okay. So now, Mr. Rahul is an Indian citizen aged 52 years. He has left India on 1st April 2020 to settle in country X. But owing to some personal unavoidable circumstances, he returned back to India permanently on 1st June 2023. He has a residential property in country X, from which he has earned an income of $25,000 from the year ended 31st March 2024. Okay, okay, sir, first we'll decode only the first para. Rahul, Indian citizen aged 52 years. Left India on 1st April 2020 to settle in country X. But owing to some personal avoidable circumstances, he returned back to India on 1st June 2023. Sir, okay, then he has a residential property in country Y, from which he has earned 25,000 rental income. On that, basic exemption limit of 8,000 is applicable in the foreign country. And income tax paid in foreign country is how much? 20%. The tax was paid on 20th May from his bank account. Then his income from business in India is how much? 5 lakhs for the year ended 31st March. He also received dividend income from an Indian company and also interest of 11,500. The exchange rates given. Compute the net tax liability. There is no DTAA. There is no what? DTAA. Sir, if there is no DTAA na unilateral relief, what are the conditions? First one, he should be resident of India. Sir, does the question clearly said like is he resident of India? No. Sir, go to previous question. Resident of India, clearly given. Go to that before question. Sohan Lal. He has business fee and trust. He is a resident, straight away given. But whereas here, in this question, did they said Rahul is a resident straight away? No. They just given the situation or the required data to us to calculate the residential status also. So now what is the provision for calculating residential status? The basic condition only, sir. A person will be called as a resident if he has stayed in India in the relevant previous year for 182 days or more. 182 days or more. Sir, when he came back to India, sir, I think you can understand, sir. The question is relevant to like 24, 25, but no problem. Just you can follow with the same dates also. Nothing will happen. Okay, just years later. 1st June 2023 to 31st March 2024. How many days he will be there? June, July, August, September, October, November, December, Jan, Feb, March. Definitely more than 180 days. See, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 months he is there in India. More than 10 months now, average 30 if you take also 300 days he stayed in India. More than 180 days, 182 days. So he is resident. Sir, in residential status, there are basic conditions and additional conditions. Here, basic condition 1 satisfied because his stay in India during the relevant previous year is more than or equal to 182 days. But to call him as a resident, he should be even ordinary resident also. When can we call him as ordinary resident? When the additional conditions are satisfied. What are the additional conditions? Out of the 10 preceding previous years, he should be resident for at least 2 preceding previous years. And then, out of last 7 preceding previous years, his period of stay in India should be a minimum of 730 days. See, 1st April 2020 only, he left India. Before and all, where he is there? India only. Sir, 10 years if you take now from 2023-24, definitely they will extend till 2013-14. 13-14 to 2020, where he is there? Completely in India only. All those years he is resident only. So, additional condition 1 satisfied. Then additional condition 2. What is additional condition 2? Out of last 7 preceding previous years. Sir, here 20 to 23, here only 3 years. Past 4 years, where he is there? In India only, right? Completely. So, there also again more than 730 days. So, he satisfies both the additional conditions and the basic condition 1. So, Rahul is what? Resident and ordinary resident. Nothing but resident of India. See, Rahul number of days stay in India during the relevant previous year is greater than 182 days. So, he is a resident. Out of 10 preceding 10 previous years, he is resident for greater than 2 preceding previous years. And his stay out of 7 preceding previous years is greater than or equal to 730 days. So, Rahul is a resident and ordinary resident. His global income is taxable. So, whatever he earn income, that is taxable. Okay. Now, he has residential property in country way. Residential property, but nothing but it is what? House property. House property income, how much is there? $25,000. Now, by using what rate this $25,000 has to be converted is the question. Here 74 given, 75 given, 75.5 given. Which rate has to be taken? Sir, I already said. With respect to house property income, IFOS income, PGBAP income, which day's TTBR rate we should take? Relevant to previous year, last day. Relevant to previous year, here 23-24. Last day, 31st March 2024. That 75 has to be taken. So, income from house property. $25,000 into 75, 18,75,000 minus standard deduction. You should not forget this. 5,62,500. So it is how much? 13,12,500. Then income from business or profession. How much is the income he derived from business or profession, sir? His income from business in India is 5 lakhs. Okay. So take PGBP income, how much? 5 lakhs. And he has even IFOS income, sir. How much? Received dividend of 1,25,000. Sir, again, this is also very important point. Many students will do mistake. On dividend, there is TDS under section 194. 10% dividend has to be deducted. So now he received 1,25,000. The dividend he received is like net of TDS. So you should gross it and take. Sometimes dividend income they will say. If dividend income, then you need not to do grossing. Dividend received is the word, then you should do grossing. So 1,25,000, you should take it to 100%. This is only 90%. And interest he has received of 11,500. So these are the IFOS incomes. Okay. Dividend and this 1,50,389. So what is the gross total income? 1,62,889. Okay then. Under which methods are the tax calculation? Does not opt 115 BSc. Since it does not opt 115 BSc, if any deductions are there available. Sir, here no investments and all he mentioned, but he has interest from savings bank account. Interest from savings bank account, he's not a senior citizen also. So how much is available? 80 TTA. Up to 10,000 interest on savings bank account can be available. So subtract that 10,000. Then you'll be getting net total income of 19,52,890. 19,52,890. So the tax plus cess will be 4,14,301. The tax plus cess will be 4,14,301. And average tax computed will be 21.215. Now we need to do what? Average tax rate in foreign country. So now we can come back. Sir, does the foreign country total $25,000 is taxed? No, right? They are having a basic exemption limit of $8,000. I mean, how much is being taxed in foreign country? Only how much on which you need to calculate tax rate? Tax 25,000 minus $8,000 into 20% if you do, then you'll get the tax amount. So $25,000 minus 8,000 into 20% divided by 25,000. If you do, you'll get the average tax rate as how much? 13.6%. You cannot take straight away this 20%. Why? Because there 25,000 might be taxing, but there is basic exemption limit, na? So I mean, first $8,000 it's not taxed. Above $8,000 only it is taxed at 20%. So to find out average tax rate, sir, we don't want the foreign country direct tax rate. We want foreign country average tax rate. That's why we are again calculating their tax. How much? 17,000 into 20% is the taxable in foreign country by 25,000. So the foreign country average tax rate is 13.6%. Whichever is lower, na, 13.6. Sir, if you don't do this, I mean, if you take straight away 20%, na, then your answer will go wrong. Understand this point. How we are calculating average tax rate? How much is the tax paid in foreign country? Not 20% they paid, right? They paid only on $70,000 into 20%. Take that only. Divided by taxable income, $25,000. Okay? That is the foreign country tax rate. Then double taxed income. What is the double taxed income? The double taxed income here is income from house property is the double taxed income. What is the income from house property? We have taken 13,12,500. That is the double taxed income. Multiplied with the 13.6%, you will get relief. Finally, you will get the tax payable also. Sir, is it clear now? So moving to next question. Mr. Avinash, a resident aged 45 years, is a salaried employee with ZP Private Limited. With what? ZP Private Limited. He received the following components of his salary. Basic salary 60,000 per month, DA 12% of basic salary, transport allowance, medical allowance 5,000. Now, see the question now being related to salaries. Sir, first of all, you think like the very in-depth points and all being asked. No, basic things only they are being asked. Okay, and you might be worried now, sir. What if the provisions which I don't know will ask? So, okay, trust me. So only the basic points, deductions alone, read properly. 115 BS. So the basic part which I said na, that is very, very important. Cover that properly, then you could see solve this question very, very easily. Okay, trust me. Basic salary 60,000 per month. Dearness allowance 12% of basic salary. Transport allowance 10,000 per month. Medical allowance 5,000 per month. All these are fully taxable. All these are fully taxable. So how much? 60,000, 12% of basic salary, 10,000, 5,000. Okay. Then he contributed 18,000 to approved pension fund of LIC. So when contributed to pension fund of LIC na 80CCC. And then one more point, sir. Here this is under which head? Salaries. Under salaries head also there is a standard deduction. Okay, but we don't know which regime he has taken. But under salaries chapter also there is standard deduction. Under new regime na 75,000 is the standard deduction. Under old regime only 50,000 is the standard deduction. You should remember. New regime 75,000 is the standard deduction. Old regime 50,000 is the standard deduction. He also paid 2 lakhs by paid. He also paid 2 lakhs by crossed check for medical insurance premium to ensure the health of his mother, a resident aged 63 years, who is not dependent on him, as a lump sum payment for 5 crores, including the current previous year. Sir, if you see, he has paid how much? 2 lakhs by crossed check. Crossed check allowed. Again, a confusion will come. Medical insurance premium can be paid in any mode other than cash. So crossed check also fine. To ensure health of his mother, mother covered there, senior citizen, who is not dependent on him. Okay, fine, but still medical insurance can be taken. A lump sum payment for how much? 5 years, including the current previous year. Current previous year. So the medical insurance, sir, it's not paid yearly. It's paid almost like what? Lump sum. It's paid like lump sum. Then what to do? 2 lakh divided by number of years the policy. 5 years. So how much it is? 40,000 for each year. For each year how much it is? 40,000. So 40,000 is the yearly amount, which is within the limit 50,000. So they can avail deduction. Next. He also derived guest lecture in a reputed university and received 8 lakhs. So this is taxable under which head? IFOS. After deduction of tax of 2 lakhs in country A. After deduction of 2 lakhs. So you should take what? Gross amount 10 lakhs. Then India does not have any DTA. Okay. With country A, calculate the tax liability of Avinash. He has opted out of default. Sir, understand? He has opted out of the default tax regime. Na? Then under which regime you should calculate tax? normal provisions only. Normal regime only you should calculate. Normal regime only you should calculate. Right. So now see. Basic salary. So first take the basic salary. What is the basic salary here? 60,000 per month na. So 60,000 into 12, 7,20,000. Dearness allowance, fully taxable, take 86,400. Transport allowance, how much? 10,000 per month, fully taxable. So transport allowance exempted is there if any something like interlevel, some past memories if you are getting na, that is available only to disallowed persons, transport allowance exemption. So he is not a disallowed person, so fully taxable. Medical allowance, fully taxable. Medical perquisite exempted, not medical allowance. So all these are fully taxable. It came to 9,86,400. Standard deduction, 50,000. Why? Opted out from default. That means what? New normal regime. So that's why we are taking 50,000 only. If at all new regime, na 75,000 is the standard deduction. So income from salary, 9,36,400. Then income from other sources, guest lectures from country A. How much? 10 lakhs. 8 lakhs only you received. 2 lakhs tax amount also add. Gross amount you should take 10 lakhs. Then gross total income we got 19,36,400. Now what are the deductions, sir? Contribution to LIC 80 CCC. How much? 18,000. Then medical insurance premium 80D 40,000. Both are allowed. Both are allowed. 80 CCC, 80D. If at all you solve the question under 115 BAC, then both these deductions are not available. So 58,000 if you subtract, net total income is 18,78,400. On this, the tax plus cess is how much? 3,91,061. Now what to do? Find out the average tax rate. What is the average tax rate, sir? 20.819%. Now foreign income. Go to the foreign income. What is the foreign income? This guest lecture related 10 lakhs. How much is the tax paid on it? 2 lakhs. What is the income? 10 lakhs. 2 by 10 lakhs now. How much it is? 20%. So which is lower? Foreign tax rate is only lower. So if you subtract the double taxed income, what is the double taxed income? Guest lectures. Here also it is being taxed. Foreign country also taxed. So 10 lakhs into 20%, 2 lakhs if you subtract, the tax payable is 1,91,060. 1,91,060. Clear? Now moving on to the next question. This is MTP June 2025, sir. Virat Pandey, aged 62 years. 62 now what? Senior citizen. Then individual furnishes the following particulars of income earned by him in India and in Canada for the previous year 24-25. India does not have a double taxation avoidance agreement with Canada. So now India does not have a DTA and he is what? He is a senior citizen. Now what is his gross salary in India? 6,25,000, sir. Salary na what? Standard deduction you should remember. Professional income received in Canada, PGBP head. Dividend income in country Canada. Sir, they given dividend income. Okay, and also in country Canada. So don't take it like dividend received only will do grossing. Here dividend income. The given income, not use the word dividend received. So IFOS. Rent from house property situated in country Canada. Income from house property. See, salary set they have given. Okay, they have given PGBP, IFOS, house property. Interest income on FDR with Bank of Baroda, Pune branch. Again what? IFOS. Sir, he is a senior citizen, resident of India, and he is having what? Interest income from fixed deposit. So ETTTB also you should take. ETTTB also you should check. Then paid interest on housing loan to Punjab National Bank, Pune branch for the residential house property. Sir, Pune branch for the residential property where he resides. So it is what? Self-occupied property. With respect to self-occupied property, he has paid interest. 24B deduction. So we should check whether it is available or not now. Investment in PPF, 80C. Medical insurance premium paid, 80D. Assume the tax rate in country Canada is 12%. Sir, what they said simply given this and asked us to calculate the tax. Okay? They asked us to calculate the tax. If at all they asked us to calculate tax and they didn't set the method, and this question is related to which year? The current applicable assessment year only. That means what? You should take the new regime only as the default regime. New regime only as the default regime. If it is new regime, then these deductions and all not available. Forget about deductions. Then salaries at standard deduction, how much is available? 75,000 is available. So take income from salaries. From there subtract standard deduction of 75,000. It came to 5,50,000. Then income from house property. The annual value of self-occupied property. Sir, here they given interest with respect to self-occupied property. So take that annual value of self-occupied property. Nil. On that, you should subtract interest on them. Sir, under 115 BAC, with respect to interest, said in the beginning itself, basics itself, if it is a let out property to the extent of rent taxable, they can claim deduction with respect to interest. But with respect to self-occupied property under the new regime, they cannot avail any deduction. So this 1,80,000, they cannot avail deduction from house property income. Interest from house property 24B is not allowed. Then so not allowed. Then he has rental income from Canada. How much he is having Canada? 1,80,000. On 1,80,000, he has taken 30% standard deduction, 54,000, and straight away taken the house property income as 1,26,000, salary income as 5,50,000. So PGBP, sorry, salary set done. House property had done. Now PGBP. PGBP, they gave in only one receipt, sir. Professional income, 4,80,000. Straight away take it. Straight away take it. Then IFOS. We have interest income received, and then we have dividend income. Dividend income, not dividend received. So take 88,000, and then take interest on FDR with Bank of Baroda. How much is the interest on FDR? 62,000. If you take together 13,06,000. 13,06,000 gross total income. Done. Deductions available are 80 TTB not available, C not available, D not available, because we are calculating tax under what? The default regime, new regime. So if you forego them, then the total income is 13,06,000. Now calculate tax on this. How much? First 15 lakhs only. So calculate step by step. You'll get 1,05,248. What is the average tax rate now? 1,05,248 divided by 13,06,000. 1,05,248 by how much? 13,06,000. So the average tax rate is how much? 8.588%. Then Canada. Canada, they straight away given, sir, the rate of tax itself 12%. So you need not to calculate again. 12%. Sir, in some questions they given directly also, we are not taking. Why? Because they are giving additional information, like they might have got that basic exemption limit in the foreign country also, or else they might have not adjusted certain things. That's why we are not taking the rate straight away. If any other, based on question only, sir. Here, with respect to Canada income, there is no such other extra point has been spoken. That's why we can take the 12% directly. So 12% 8.58, which is lower. 8.588 is only lower. So now we need to find out the double taxed income. Double taxed income. What is the double taxed income? Canada rental income double taxed. Canada rental income double taxed, but not the total 1,80,000. Only this 1,26,000. Professional income double taxed. Dividend income double taxed. So 1,26,000, 4,80,000, 88,000. Take them. So take them. So you'll be getting 6,94,000 into 8.858, 8.0588. Then you'll get 55,928 as the relief. And the final tax payable will be 49,320. Clear? Are you able to understand now? Then Mr. Arun, the last question, sir, from here. If at all you need to solve some extra questions regarding these topics now, go and solve the past 3 attempts exam questions. One question already being covered here. Okay, 2 questions will be there additionally from the past 3 attempt examination questions. If you want to do those 2 questions also additionally, fine. You need not to go and refer any other questions, sir. These are fine. Okay. Arun, an Indian resident aged 49 years, is employed as a supervisor in the country UAE, earning monthly salary of 7,500. Okay, how much salary? 7,500. In order to look after his mother, India, he shifted to India when 1st July 2024 and started his business in India. Before shifting to India, he left out his house property UAE from the same month. Okay, he let out. Okay, sir, when he is coming back now, his property will be vacant there, right? So he has given the property on rent. Few months. So see, what are the incomes he is having? Salary he is having. But leaving that job, he came to India and started business. Business income he has. And his property given on rent. So he is having house property income also. So he has PGBP. He has salaries. He has income from house property as of now. Okay. And then Arun, an Indian resident. Straight away they given the point as like he is resident. He is resident. So they given additional information. Before shifting to India, his stay in India in last 7 years is 780 days, and he was resident for 5 previous in 10 previous years. So this complete statement is irrelevant. Why? Because they clearly said like here itself he is resident. So this statement irrelevant for us. Then the details of other income. PGBP income is there now. From there he got 8,35,000. He has FD in country UAE 45,500. He has savings bank interest 15,250. He has dividend income. See, they didn't mention dividend received, dividend income. So we need not to do grossing here. Dividend received, they said, then do grossing. Rate of income tax in country UAE, 25%. During the previous year, Arun paid 45,000 as medical insurance premium for himself and 56,000 as medical insurance premium to insure the health of his father, a non-resident. Sir, for him, not a senior citizen, 25,000. For parents, actually, senior citizen parents, 50,000 is allowed. But if parent is non-resident, then 25,000 is only allowed. So 80D total, how much? 50,000 is the deduction. You are required to compute the total income for the assessment year. No DTAA. He has opted out from 115 BSE. No 115 BSE. Then where the tax has to be calculated? The tax has to be calculated under the old regime. Okay, so deductions are available. So now see, here 80D deduction is available. Then savings bank interest is having. So 80 TTA is available. Then any other things he has made? No. So two deductions are available. So headwise first. Okay, we'll come headwise. Salary. What is the salary income he is having, sir? AED is $7,500. Okay, one AED equals to how much? 25. So 7,500 into how many months? He worked there till 1st July. That means April, May, June. 3 months, 7,500 into 25. How much is his salary income? 5,62,500. Sir, standard deduction available. New regime na 75. Old regime how much? 50,000 only. So it is how much? 5,12,500. Then income from house property. Income from house property, sir. He given him from where? He came to India on 1st July. So the salary, the house property is also given on rent from July only. 9 months. So 9 months into how much rent? 4,250. 4,250 AED into 25. 9 into 4,000 AED into 25. Again, house property now you should take what? Standard deduction 30%. How much is the net amount? 6,69,375. Then PGBP income. He has PGBP income straight away, sir. 8,35,000. PGBP head is also done. Then he has income from other sources. What are the income from other sources he is having? FD interest 45,500. Savings bank interest 15,250. Dividend income 7,750. Take all the three. Then the income he is getting is like how much? 68,500. Total gross total income 20,085,375. Okay. Then the deductions. How many deductions he is having? 80D is having and 80 TTA is having. So 80D, medical claim for self 25,000 because 25 only allowed since he is not senior citizen. For father 56,000 but restricted only to 25,000 because usually he can claim up to 50 senior citizen but non-resident that's why only 25,000. 80 TTA 10,000 savings bank interest. So total deductions if you subtract the total income is 20,25,375. Compute the average tax rate on it. Okay, compute tax. The tax come to 4,36,919 and on that average tax if you calculate, what is the average tax rate, sir? Indian average tax rate 4,36,991 by 20,25,380 into 100, 21.572%. Rate of tax in country UAE 25%. So you should take what? Lower of this. You should take what? Lower. Okay. Country UAE, sir, they given directly only. Country UAE, the tax rate is how much? 25%. Okay, sorry, they didn't given directly, right? Okay, given directly, sir. 25%. So take that one straight away. Whichever is lower, na 21.572%. Now we need to find out which is the income double taxed. Okay, both in India and foreign country. Sir, in India, the salary is taxed. Outside India also taxed. Say, take 5,12,500. House property income taxed in India, outside India. Take this as well. PGBP nowhere. And then take FD income 44,500. So add only these three. 5,12,500, 6,69,375, 45,500 and multiply it with this tax rate 21.572. Then you will be getting the relief as how much? 2,64,769. If you subtract this, you'll be getting the net tax liability as 1,72,150. So now you have understanding, right? To solve this question, you should be clear-cut knowledge of double deductions. Sir, the basic method for problem formula is same. Calculate tax, average tax rate in foreign country, take whichever is lower, multiply it with on the double taxed income. We'll get relief. That is simple only. But they're asking sometimes in the default method, sometimes in the old regime. There, you need to have command over deductions. You need to have command over standard deductions. You need to have command regarding which 115 BS in a which kind of standard deduction is allowed and all. Okay, so the basics part, that's why. Sir, in the chapter DTAA, 6A and 6B are actually from DTA, right? 6A usually a theory question. There are hardly 5 theory questions which only being repeated there. If at all not this question, then the theory question will be from the transfer pricing, like regarding APA, rollback provisions. So based on that area only actually they're asking questions. So that anyhow I'll cover in the transfer pricing chapter. Now coming to here, the first question is about explain the term permanent establishment and state whether use of facilities for storage or display of delivery of goods or merchandise is a permanent establishment. It was there in another mock test paper also, sir, but not linked to OECD. There they even asked like what are the exclusions to PE. So together I am discussing now. Permanent establishment. Permanent establishment means it's like a branch office of foreign company which was kept in India, sir. I mean, it should have some degree of permanence. It's not like some campaign kind of, like let's say this SIM card vendors and all, they'll put a tent and will be selling. So it doesn't have no degree of permanence. Okay, so it should have some degree of permanence. It could be a branch office, something kind of, or a factory, or it could be a oil exploration site, or it could be a project of construction. Okay, so like that, or it could be a warehouse or go down. So something, okay, some degree of permanence would be there through which the business of an enterprise is wholly or partly carried out. What should be carried out, sir? Business should be carried out. Permanent establishment means a fixed place of business, and from there business should be carried out either wholly or partly. Okay, usually it includes a place of management, maybe something like a corporate office is kept. Okay, not usual buying and selling, but they will manage from there. That is also part of business only. So corporate office, a branch office. I mean, say like let's say if Tesla has opened a outlet in India, then that it comes as like a branch. Okay, an outlet kind of, or else their office with respect to service sector. With respect to service sector, they may start an office there and their people may be working from here. Or a factory, or a workshop, or it could be a mine, oil, gas, well, quarry, or any other place of extraction of natural resources. Sir, you'll be taking these theory questions so light, but these are being asked repeatedly. So learn properly. 5 questions only there. Learn properly. Okay, listen to this class properly and then try to you do little kind of by hearting here, because we need all the points to be written in the exam. It's not like maybe here and there you may not receive, I mean as it is you cannot bring there, but at least the point should be there. Okay, for that it requires so many times revision. 5 questions only na, do 3 or 4 times minimum of revision. Okay, don't go with like a PE na, this overview and all, that you shouldn't do. Have thorough understanding, and if needed, like write point by point, and then understand it, memorize it. Okay, permanent establishment means a fixed place of business through which the business of an enterprise is wholly or partly carried on. It includes especially a place of management, a branch, an office, a factory, a workshop, a mine, oil, gas well, quarry, or any other place of extraction of natural resources. The term permanent establishment also includes a building site. Let's say a Singapore company is constructing a project here. That building site, such construction, assembly or installation project or such supervision activities which they are carrying out, that is also permanent establishment, provided such activity should be there for a minimum of 6 months. Then furnishing of services including consultancy services by an enterprise. Consultancy services, like so they may take a lease an office there or a co-working space there, where the enterprises or other personnel engaged by the enterprise for such other enterprise, if activities of that nature continue with for a minimum period of more than 183 days in a 12-month period commencing or ending in the fiscal year concerned. The term permanent establishment also encompasses what? The building site, the project site, the assembling, installation of a project, where the project should last for at least for a period of 6 months. Then the furnishing of services including consultancy service by an enterprise through employees or other personnel engaged by the enterprise, if activities of that consultancy nature continue within a contracting state for a period or period aggregating more than 183 days in any 12-month period in the fiscal year. Then as per OECD model and as per UN model, there is a difference between permanent establishment. Okay, PE does not include as per OECD model. So OECD model is like the kind of treaty which is followed by developed countries. UN model is a kind of DTA treaty which is followed by developed and developing countries when they are having treaties. Okay, so the PE does not include use of facilities solely for the purpose of storage, display or delivery of goods or merchandise belonging to the enterprise. I mean, here a warehouse kind of is kept where the goods are just stored and they are kept for display, or they will be delivered. Nothing but there is no sale transaction and all, no billing, nothing is happened there. That is not a permanent establishment as per OECD model. But as per UN model, permanent establishment does not include the use of facilities for the purpose of storage or display of goods or merchandise belonging to the enterprise. So it's only covering storage or display. Whereas here they are covering storage, display as well as delivery. In OECD model, storage, display, delivery, both are there. But in UN model, storage and display is only there, delivery is not there. That means as per UN model, because India follows or adopts UN model, as per Indian PE concept, if at all a permanent if at all an establishment is there, from there if the goods are being delivered, not sale, just being delivered, that amounts to PE only. If goods are delivered, then as per UN model, PE is said to be existing. Then exclusions to the permanent establishment. Okay, an enterprise shall be deemed to be have a permanent establishment, shall not be deemed to be have been a permanent establishment merely by reason of, if at all they are having a cold chain facility or warehouse facility kind of, where they are just storing the goods or displaying the goods or merchandise belonging to the enterprise. They are just what? Storing and displaying the goods. Next, they are maintaining the stock of goods. They are maintaining the stock of goods or merchandise belonging to the enterprise solely for the purpose of storage or display. Sir, let's say in the port area, the goods will be going from USA to Hong Kong, let's say. Okay, so the goods went to Mumbai port, and in Mumbai port they were unloaded. Once they were unloaded, they kept in a inland container depot. That goods keeping in that inland container depot does not amount to permanent establishment, because they were just kept for storage or display. Then the maintenance of stock or goods, merchandise belonging to the enterprise solely for the purpose of processing by another enterprise. The goods were kept in that particular place only because they have to be processed by someone else. For that reason you brought and kept there. So that cannot be treated as PE. Fourth one, the maintenance of a fixed place of business solely for the purpose of purchasing goods or collecting information. You are maintaining a fixed place of business. There you will keep your goods, or from there you will buy goods, or just you will collect information. That is not PE. And the last one, the maintenance of fixed place of business solely for the purpose of advertising. You don't sell anything. So Tesla doesn't open a store. It didn't open a store in India, but it has taken a office, and from there it started marketing Tesla car. But if you want to buy Tesla car, you should buy from USA and import only. But they are marketing here, and then they are checking like which are the strategically best location to open their stores, or whether it is viable to launch there, or which model has to be launched and all. So all the studies they are doing from that office. Then that is also not a PE. The maintenance of fixed place of business solely for the purpose of advertising, for the supply of information, for scientific research, or for similar activities which have a preparatory or auxiliary character for the enterprise. An enterprise shall not be deemed to have permanent establishment merely by reason of use of facilities solely for the purpose of storage or display of merchandise belonging to the enterprise. Okay, the maintenance of stock, there you will maintain stock only for what? belonging to the enterprise solely for the purpose of storage or display, then you will maintain stock there. But only purpose of what? The other enterprise has to do processing. Fourth one, you maintain a fixed place of business where from there you will buy goods or you will do collection of information. And then you maintain a fixed place. That means like office. But from there you will do advertising or you will supply information or you do scientific research, such kind only. But you will not sell the goods or deliver the goods. So these are not PE then. So this one in the problematic part only we have discussed, but it's been asked as a theory question. So quickly we could wrap up. Explain methods of bilateral relief in DTAA and briefly state how unilateral relief is provided. Sir, when bilateral relief, when both the countries have entered into DTAA, double taxation avoidance agreement, then that is called as bilateral relief. When only one country has entered, there is no DTA actually. Okay, there is no DTA actually. Sir, bilateral reliefs are covered where? 90 and 90A. Whereas unilateral relief is covered under where? Section 91. That means there is no DTA. Okay, so bilateral relief under 90. When two countries enter into DTA, 90A, it's not 90, 90A. So then when a enterprise or a specified enterprise from India may be entering into DTA with another specified enterprise in foreign country, okay, then they may entering into a treaty which would be, by considering the treaty, central government may make the provisions or may make the adjustments and all. So then that is covered under 90A. So where there is DTAA, bilateral relief, no DTAA, unilateral relief. In bilateral relief, in case where DTA between two tax jurisdictions, bilateral relief is provided. There are two ways by which jurisdiction may agree to provide relief from double taxation. One is exemption method and the next one is credit method. Exemption method and credit method. Under exemption method, again there are two. Full exemption method, exemption with progression. Full exemption method, exemption with progression. Both the methods we have discussed and solved problems. Full exemption method, whatever is the income already taxed in other country, that you will be exempting in the resident country. Income earned in the state of source is fully exempted in the state of residence. Whereas exemption with progression, whatever is the income taxed outside India in the foreign country, that also you include while calculating Indian tax and calculate the tax. After calculating the tax, reduce the tax which has been paid outside India. Under this method, income from the state of source is considered by the state of residence only for the purpose of rate purposes. Then credit method. What? Credit method. In this method, the tax are nothing but, here you will calculate tax considering the foreign income also as taxable, and from there the foreign tax paid you will be subtracting. Sorry, how will be subtracting? You will be subtracting here like the tax you paid in foreign country into average tax rate which you have calculated, that you will be subtracting. It's not like the directly the foreign tax which you have paid will be subtracting. It's like you will be multiplying that is tax into average tax rate which you have calculated. By using that you will be subtracting and you will be providing the relief. Credit method. In this credit method, the taxpayer remains liable in the country of residence. Global income you calculate tax. However, the liability which you have incurred outside India, that would be given as credit. Okay, out of them the first one is full credit. Full credit, now what? You calculate tax. Whatever is paid outside India, just subtract it. Full credit method. Ordinary credit, you will be first calculating the tax as it is, find out the average tax rate. Taking the global income, you will find out the gross total income, net total income, then find out the average tax rate. Then what you will be doing, sir? You will be taking the tax paid in foreign country and the double taxed income into Indian tax rate. Out of these two, whichever is lower, you will be subtracting. State of residence allows tax paid in the state of tax paid in the state of source restricted to that part of income tax which is attributable to the income taxable in the state of resident to the extent of income which is attributable to tax in residence. To that extent only the credit is given. Ordinary credit method. Tax pairing. What is tax pairing? So there are two countries. Country X, country Y. In country X, you have a source of income. Whereas country Y is like resident country. In country X, actually that income should be taxed at 30%. But because that was kept in a specified area, the income is exempted. Income is exempted. Okay, now in country Y, even though it is exempted in country X, it will be taxable in country Y. Now if you see in country X, it is exempted. So there is no double taxation. But tax pairing things like, even though it is not taxed in country X, think as like taxed in country X, and the deemed credit can be taken. Okay. State of resident allows credit for deemed tax paid on which income otherwise exempt from tax in the country of source. Then underlying tax credit. So this underlying tax credit is applicable because of economic double taxation. There are two types of double taxation, sir. One is economic double taxation. The other one is like jurisdictional double taxation. When it is economic double taxation, like the same income being taxed in two different persons, and they may be even in two different countries. Like let's say the profit of the company is already taxed in company's hands, but if it is again given as dividend to the shareholder, it is again getting taxed to the shareholder. So in such cases, the taxes already paid in the capacity of that company will be given as like credit, will be given as credit. It's not just the dividend distribution tax or the TDS withholding tax, even on the profits paid, all will be allowed as credit. That is called as the underlying credit. Credit is allowed to resident not only for the taxes withheld, the TDS, but also for the taxes paid on the underlying profit out of which dividend is paid by a company in the overseas jurisdiction. However, overlying credit may only apply if satisfaction of substantial shareholding requirement is met. Next, unilateral method. Sir, unilateral method, there is no DTA with that country. Then you will be entering into unilateral method. Section 91 of the Income Tax Act contains unilateral relief where there is no DTA between Indian and foreign jurisdiction. If any person resident in India proves that his income is accrued or erased outside India and he has paid tax thereon, then he is entitled to deduction from Indian income tax payable of a sum calculated on such double taxation income at the Indian rate of tax or the rate of tax in foreign country, whichever is lower. So on the double taxed income, you should apply the Indian tax rate or the foreign country tax rate, whichever is lower. That would be given as relief. Indian rate of tax means the average tax rate, sir. Okay. Then explain briefly the different modal tax conventions that currently in vogue and their significance in international transaction. So these are the model DTAs, model tax conventions, model double taxation avoidance agreements. It's not like whenever we enter into a DTA with a country, we'll be pointing or we'll be framing each and every point. No, we'll just copy paste from this base model and then we'll change here and there based on the relation between that country and all. So we'll be changing here and there, little modifications, but the draft will be from this particular model only. So there are three drafts available. One is OECD, the second one is like UN model, and the third one is like US model. The name itself says like US model only when the DTA is with US or when the US is entering into DTA, then US model is followed. Then when OECD, when UN model, OECD model is when they are both the countries are like developed countries. Both the countries entering into DTA are like developed countries. Now OECD model. One is developing country, other one is developed country, then it is like OECD model. Understand? OECD when both are developed countries. So for India, it is not applicable. Why? India is what? Developing country. So OECD is not applicable. UN model when between developing country and a developed country. So India is a developing country or between developing countries also UN model only. Developing and developing or developing and developed. So UN model only what India follows actually. Then US model for US. If you see, The present form of OECD model was traced back to 1927. So first time among the developed countries, they thought like there should be some kind of this treaty. So they prepared a base format of treaty in 1927. When the Fiscal Committee of League of Nations prepared the first draft model form applicable to all the countries. Since then, it has been revised several times, and the latest being in the year 2017. So it has been updated, and the latest is 2017. OECD model is a model treaty between two developed nations. This model advocates, this model says like residence principle. The tax is more based on residence principle than that of source principle. So that is to say, it lay emphasis on the right of state of residence to tax the income. So resident country will only get tax income rather than the source country, Then UN model. In 1968, United Nations set up an ad hoc group of experts. A group has been formed from various developed and developing countries to prepare a draft model convention between developed and developing countries, because it was related to, OECD is related to only developed, so this is between developed and developing. In 1980, the group finalized the UN model convention in present form. Sir, the committee is like 1968. The model came when 1980. It has been further revised a number of times. The recent one is like 2021. OECD recent one 2017. UN recent one 2021. It gives more weightage to the source principle rather than residence principle. UN model is designed to encourage flow of investments. Sir, why? To encourage. Sir, we want to open the gates to FDI investment. If at all residence rule, US people has lot of money. They'll come and invest in India. But still, the tax will be going to US only because of residence rule if they follow OECD. So we are not liking it. So what we said, UN model. If UN model, if a person from US is having money, he can come and do business here. The tax will be coming to whom? Will be payable to whom? Indian government. So that's why this developing countries has taken to what? Source model, which encourage flow of investments from developed countries to developing countries. It takes into account sharing of tax revenue with the country providing capital. Most of Indian tax treaties are based on UN model. Then US model. The US model convention was first published in 1976 and has been revised several times. US model is issued by the United States while entering into tax treaties with various countries. Sir, US model is like what? It was first published in 1976. It is followed by United States when entering into tax treaties with various countries. Then, analyze the special provisions relating to DTR in case of specified associations in India. Sir, when specified associations are entering, it is like 90A. When the country, India itself is entering with another country to country, 90. Specified association with another specified association in foreign country, 90A. Double taxation avoidance relief in case of specified association, section 90A. If a specified association in India enters into agreement with any specified association in a specified territory outside India, then Government of India will make provisions for implementing such agreement and exchange of information to prevent evasion or avoidance of tax or recovery of tax. To prevent evasion or avoidance and recovery of tax. Okay? Exchange information, agreement for DTR. It's not just only regarding DTR and exchange of information also to prevent what? Evasion, avoidance, and in case of evasion and avoidance, recovery of tax. Then provision of Income Tax Act shall apply. Sorry, between DTR and Income Tax Act, if there is a conflict, either 90 or 90A, the whichever is beneficial will only be applicable. Only they are more beneficial to the SSE. For example, if tax is paid to foreign income outside India, no tax is payable on such foreign income in India. Sorry, if DTA says one thing, tax is another thing. If DTA thing is favorable, you can follow whichever is said in the DTAA. Okay, this is what the question number 6A. Theory questions. The last questions are now. What is foreign tax credit in the context of international transaction? State the documents which are required for availment of such credit. So this foreign tax credit, nothing but the tax we paid outside India is there, right? As per section 90 and 90A, that itself is the foreign tax credit. So they are saying like clearly, foreign tax credit, an SSE being a resident, shall be allowed a credit for the amount of any foreign tax paid by him in a country or specified territory outside India. If he is a resident of India, then he shall be allowed the credit for the amount of foreign tax paid in the country or specified territory outside India by way of deduction or otherwise. Okay, the tax you paid outside India is there, na? If you are a resident, that can be taken as credit. Okay, by way of, and that credit can be taken as what? By way of deduction or otherwise in the year in which such corresponding income is taxable in India or offered to tax in India. Okay, where such foreign income is offered to tax in India in more than 1 year, then the credit can also be adjusted in the same proportion which it is offered to tax. If it is taxable in 2 years, so adjust the foreign tax credit like half in first year, half in second year. The credit shall be availed only against the amount of tax, surcharge and cess. I mean, you will be getting the foreign tax credit, the relief with respect to foreign tax credit, only to the extent of tax, interest and cess. Sorry, tax, surcharge and cess. Tax, surcharge and cess only can be taken as credit. If any interest paid, penalty paid, fees paid, those are not covered under the foreign tax credit. Then, no credit shall be, so in respect of any foreign tax which is disputed. So that means in foreign country they asked you to pay 5 lakhs as tax, but you are not paying. You have contended that. You went to tribunal, you went to appellate authority, or you went to court. Okay, then in such cases it is disputed. Since it is disputed, no credit will be given to you in India. However, the credit of such disputed tax has been allowed in such income is offered to tax in India, and if the SSE within 6 months from the end of the month in which the dispute is finally settled, okay, from the time when the dispute is settled within 6 months, furnishes a evidence of settlement of dispute and the evidence that tax liability for payment of foreign tax has been discharged. So within 6 months from settlement of evidence, that person has to submit a proof that he has paid taxes, okay, and the dispute has been settled and all, and furnish an undertaking that no refund in respect of such amount as directly or indirectly has been claimed. Then the disputed amount also later on you can claim as credit. The credit of foreign tax shall be the aggregate of the amount of credit computed separately for each source of income from a particular country. So the foreign tax credit you cannot calculate for all the countries' incomes. Sir, I am having income from country X, country Y, country Z. So for each and every country you should calculate separately for foreign country. Okay, then you will total it. The credit shall be the lower of tax payable under this act or such income the foreign tax paid under such income. Okay, however, where the foreign tax paid exceeds the amount of tax payable in accordance, sir, let's say as per DTAA he should pay 5 lakhs only in foreign country also, but he paid 7 lakhs. Do we consider 7 lakhs? No. As per DTAA, how much he should have paid in foreign country, that only will be taken as foreign credit. Then documents required for availing the credit. Credit of any foreign tax shall be allowed only on furnishing the following documents within the due date of furnishing of return of income. First one, a statement of income from the country. I mean, in that country you will be filing a return of income, right? Such statement of income which you filed outside India for the previous year, and tax deducted or paid on such income in form number 67 in verified and should be verified in the manner specified. Then a certificate or statement specifying the nature of income and the amount of tax deducted thereon or paid by the SSE, tax remittance certificate, TRC. So in the state of source, you should get a certificate like what is the source of income, what is the nature of income, and whether tax is paid or deducted, that has to be provided. Who should be giving? From the tax authority of the country of the specified authority. US tax authority, if it is UK. UK tax authorities. Then from the person responsible for deduction of such tax. If the tax is not withheld by the government, then from the person who has withheld such tax and should be signed by the SSE, the statement furnished and signed by the SSE shall be valid if it is accompanied by an acknowledgement of online payment or banker counterfoil or challan for payment of tax where the payment has been made by the SC and the proof of deduction where the tax has been deducted. So this should be signed and the statement should accompany with the proofs. Those annexures has to be given. Then only it is called as what? A valid statement furnished and signed by the SSE. Clear? So what is called the foreign tax rates are the tax paid in foreign country. Okay? In simple. You cannot take interest, fee, penalty paid as foreign tax rate, only the tax, surcharge and cess. This foreign tax rate can be allowed for adjustment with the tax payable in India in the proportionate to the tax such foreign income taxable in India. If it is taxable in 1 year, na, adjust in 1 year. Multiple years, na, adjust the credit in multiple years. Then if the tax in foreign country you have contested, it's a disputed one, then you cannot take credit in India. Then what to do? Once the dispute resolved, from the month in which the dispute resolved, from there within 6 months, you need to provide a evidence of the dispute settlement and the proof of tax payment to get it as credit. Okay, then the foreign credit, since it is paid in foreign currency, it can be converted into Indian currency by using the TTBR rate. By using the credit shall be determined by conversion of currency of foreign tax at TTBR rate on the last day of the month, immediately preceding the month in which such tax has been paid. Tax paid in July, preceding month June. So June last day TTBR rate should be taken to convert into Indian currency. Then the documents, statement of return which is filed in foreign country and a tax remittance certificate in the foreign country which is issued, which says the source of income, nature of income and the tax paid or deducted. It should be given by the tax authority in foreign country or the one who have deducted the taxes. Then it should be signed by the SSE. This is about the foreign tax credit. So with this, we have completed the double taxation avoidance agreement. 2 questions standardly you could write with this discussion. See, we have completed the discussion regarding 6A and 6B. Now, our discussion is regarding what? 7A and 7B. So 7B, it's from transfer pricing. They are asking a question on these methods. It could be cup method or it could be like cost plus method. Okay, most frequently these two only, sir. Comparable uncontrolled price method. Okay, or it could be a cost plus method. So like that only they are asking. So there are other methods also, but majorly these two are being focused. Then 7B, the focus is on thin capitalization. Thin capitalization, that interest regarded one, sir. With the associated enterprises, if you have taken any loan and the interest you paid is beyond the permissible limit, how to deal with it? So that is called the concept of thin capitalization. So the questions are mostly being asked on what? Transfer pricing, cup or cost plus method or thin capitalization. Okay, but these 2 questions, 6 and 7, I already said to you, these are the areas of our focus. So I don't want you to lose a single mark or I don't want you to take a chance with respect to these 2 areas. So that's why I'm going to cover everything from there, but quickly. Okay, so first of all, where there are 2 entities which are associated enterprises. Associated enterprises. So associated enterprises, for the time being, assume them as like related persons. How they are related and all we'll understand, because there are almost like associated enterprises is there and deemed associated enterprises are there. There are 13 entries or 13 different type of transactions are covered to call them as deemed associate enterprises. So that's why we'll discuss that one detailedly. First of all, both these entities are related persons. Somehow some connection is between these 2 associated enterprises. Then in between them there is an international transaction or specified domestic transaction. Between 2 associated enterprises, if there is an international transaction or specified domestic transaction, then transfer pricing provisions are applicable. Okay, we'll understand detailedly what is called international transaction. All those will be understanding. Okay, now let's say for example, there's a LLC in USA. The tax rate in USA is assumed 10%. it has supplied goods to B Limited. Tax rate in India, B Limited is 30%. Sir, so this US company, holding company, okay, these are associated enterprises, so let us take it as like holding and subsidiary. The holding company has supplied goods to subsidiary at 150 per unit. How many units? 10,000 units. Whereas the market price is how much? 100 per unit only. That market price only, we are taking it as what? Arm's length price here. Okay, arm's length price. But actually there are methods to calculate arm's length price and also. So straight away, for the purpose of example only, we'll take arm's length price as 100. But for what price this holding company has sent? 150. Sir, why holding company has to send it for 150, sir? It also can send for 100, na? See, there is a tax planning involved here. Sir, in USA, the tax rate is 10% only. Holding and subsidiary, overall they belongs to a single group only, right? So what their objective is like, their profit should be maximized with less taxes. See now, as a group, now if in US, they get more profits also, tax rate is 10% only. So it's better for them to earn more profits in US. Because in India, the tax rate is 30%. That's why a 100 rupees product they are selling for 150. So the profit in US will increase. Whereas in India, this Indian subsidiary company is buying a product which is available for 100 for 150. That means it is paying more. When it is paying more, it cost will increase, profit will come down. See, as a group, they think ALLC should have more profits because the tax rate in USA is only 10%. By doing this, I mean selling at 150, whereas the market value is only 100, profit in USA will increase, whereas the profit in India will come down. See, I'll prove that also. Sale value, what is the actual price they sold? 15 lakhs. But the arm's length price is how much? 10 lakhs only. So 5 lakhs profit has been increased in USA because of this. In India, the cost if they purchase for market price, okay, the actual purchase price for them is 15 lakhs. Whereas if they purchase at the arm's length price, now it is only 10 lakhs. So what is the difference? 5 lakhs. The difference 5 lakhs. So USA 5 lakhs profit increased, India 5 lakh profit decreased. Okay. So now what is happening? So the income is being taxed more in USA. So they are getting, as a group, they are having benefit. But it is not favorable to Indian government. Indian government is losing revenue because of this kind of adjusted transactions. To curb these practices as stated above, transfer pricing provisions are introduced. Instead of valuing the transactions at actual price, I mean taking this 150, instead of 150, we'll take what? Arm's length price. We'll take what? Arm's length price. Okay, now we'll understand what is called an international transaction. An international transaction is a transaction between associated enterprises. Again, that it is a transaction between whom? Associated enterprises, where both or one of them is non-resident. Sir, here if you look at this example, ALLC, where it is there? USA. B Limited, where it is in India. So out of them, one of them is a non-resident. ALLC is a non-resident. So in such cases, it is an international transaction where both of them are non-resident. Then A Incorporation had a prior agreement with C Limited. Now this C Limited is supplying goods to whom? B Limited. Sir, A Incorporation has a prior agreement, like what goods has to be sent, at what price it has to be sent. There is an agreement between whom? A Incorporation and C Limited. Now this C Limited is sending goods to whom? B Limited. Actually, this A Incorporation and B Limited are associated enterprises, but the goods are not sent directly by the associated enterprises. Sent by whom? Sent by some other person. Sent by some other person with the non-resident. He is having a prior agreement. He is having what? Prior agreement. So then this transaction is also treated as a deemed international transaction. See, sir, here the goods are supplied by C Limited to B Limited only. C is where? India only. Or if he is non-resident, straight away international transaction, no problem. He is in India only. B Limited where? India only. But at what price the transaction between C and B should happen is decided by A Incorporation, which is in UK. So since the terms of contract are decided by a non-resident, the contract happened between these two domestic persons or these two residents is also has to be treated as an international transaction. So this is called as what? International transaction. Then computation of income from international transaction. Okay. So now any income or allowance for expense or interest arising from an international transaction shall be determined at what? Arm's length price. If any income is arising or any expense is allowed or any interest is allowed to calculate the income arising from international transaction, then this income, allowance or expense interest shall be taken as what? Arm's length price only. If they taken above arm's length price, you will not consider, you will again add it. While determining arm's length price under transfer pricing, income should not be lower than which is shown in books of accounts. Sir, if you are following transfer pricing provisions, by applying transfer pricing provisions, the SSC's income should be increased. It should not decrease. If it is decreasing, don't apply transfer pricing. And then his losses should increase, shall not decrease. If losses are decreasing, then again don't apply this transfer pricing. Income should increase, losses should decrease. This should have happened. By applying transfer pricing provisions, a person's income should increase or losses should decrease. This thing should have happened. If losses is So the same thing, sir. Income shall also increase by applying transfer pricing provisions. Losses shall decrease. Whereas if losses are increasing, income is decreasing, then transfer pricing provisions you shall not apply. Clear? See, with respect to international transaction, if it is that is related to an income or an expense or interest, that should be at arm's length price. Okay? Only when the application of transfer pricing provisions will increase income or decrease losses, then only transfer pricing provision shall be or international shall be applied. Then now we'll be discussing about the concept of associated enterprise. When two or more entities will be treated as associated enterprises. These are discussed under section 92A subsection 1, associated enterprises, 92A subsection 2, deemed associate enterprises. What are called associated enterprise? Where an enterprise participate directly or indirectly through one or more intermediaries in management capital of other enterprises. Participate directly or indirectly through one or more intermediaries management capital or control of other enterprises. Nothing but if one entity can control the other, then they are associated enterprises. Okay, it could be even directly or even indirectly. A Limited control B Limited with 60% shareholding. These two are associated enterprises. B Limited control C Limited with 65% voting powers, and these two are also associated enterprises. Now, with A Limited can control B Limited. By controlling B Limited will control again C Limited. So, indirectly, A Limited can even control C Limited, So, both AB directly associated enterprises, BC directly associated enterprises, whereas A and C indirectly they are associate enterprises. Then, if one or more persons participates directly or indirectly through one or more intermediaries in the management control capital of two different associate enterprises. Simple thing, sir. X has 70% in Y Limited, associated enterprises. X has 60% in Z Limited, associated enterprises. Now, since both these Y and Z, both these two are managed by one person, by a single person only, hence both these two are also called as associated enterprises. If one or more person directly or indirectly control both those, then both of them are also called as associated enterprises. Sir, are you able to understand? One is like directly or indirectly. Here what is happening? The same person either directly or indirectly control both of them. Then both those are also nothing but in companies, in CFR language, these two are what? Subsidiaries of a common holding. So subsidiaries of common holding are also treated as what? Associated enterprises. Then deemed associate enterprises. These are mentioned under 92A subsection 2. So associate enterprises, these two. Whereas there are other cases also, deemed associate enterprises, which are like 13 relationships has been mentioned here. First one enterprise holds greater than or equal to 26% voting power directly or indirectly in other enterprise. Greater than or equal to 26% voting power directly or indirectly. First one, voting power greater than or equal to 26% directly or indirectly. Second one, any person or enterprise holds 26% or more of the voting power directly or indirectly in each of two different associated enterprises. That means what, sir? Okay, that means what? Let me write down here. A Limited has 30% in B Limited and A Incorporation, let us take, okay, and 30% in C Limited as well. Now, A Incorporation and B Limited are associated enterprises. A and C are associated enterprises. Now, these two are also called as associated enterprises because in these two, only one or more persons directly or indirectly holding more than or equal to 26%. Any person or enterprise holds 26% or more of the voting power directly or indirectly in each of the two different enterprises. Okay, sir, these are related to companies. The first and second points we talk are regarding companies. In a company where there holds 26% or more voting power directly or indirectly associated. In a company, either a person or a company holds 26% in two different associated enterprises. Like in A, in B, there is 30%, C also 30%. Now B and C are also called as associated enterprises. Third one. One enterprise form AOP BOI. Okay. One enterprise is form AOP BOI. In this form AOP BOI, if a person is having greater than or equal to 10% interest, 10% interest na profit sharing ratio. Sir, I have 20% profit sharing ratio in a firm. Then that firm and me are called as associated enterprises. To call them as associated enterprises in a firm AOP or BOI, the voting power, the share of interest should be greater than or equal to 10%. Interest na here, profit sharing ratio. Then one enterprise can appoint 50% or more of directors. If an enterprise can appoint 50% or more of directors or greater than or one executive director of other enterprise, they can appoint more than or equal to 50% of directors or more than one executive directors. Okay. Then same person or same persons can appoint more than or equal to one enterprise can appoint greater than or equal to 50% of, sir, correction here, it's not like greater than, it's not greater than or equal to, only greater than. One enterprise appoints greater than 50% of directors. That means in a company there are 10 directors. If this associate if this person, let's say in a company I can appoint 6 directors out of 10, then me and that company are associated enterprises. Or else there are executive directors. Out of them, at least one executive director I can appoint. Then we both are associated enterprises. More than 50% of directors or more than one executive director if I can appoint, then then I am called as what? Associated enterprises. Then the same person, see, me only, I can appoint more than 50% directors in A Limited as well as in B Limited. In A Limited 10 directors, I can appoint 6. B Limited 10 directors, I can appoint 6. So in both, with A Limited associated enterprise, with B Limited associated enterprises, not only this, both A and B, because I am controlling the board in A Limited and I am controlling the board in B Limited. So both A and B are also called as associated enterprises. Then one enterprise offers loan to other enterprise and the loan amount is greater than or equal to 51% of the total assets of other enterprise. Sir, let's say this is A Limited. Okay, and its total assets are 100 crores. Now the loan given here should be 51 crores or more. It should be what? 51 crores or more. 51 crores or more to call them as associate enterprise. One enterprise is giving loan to other enterprise and the loan amount given is like greater than or equal to 51% of total assets of other enterprise. Next, one enterprise gives guarantee to other enterprise. The guarantee given is greater than or equal to 10% of the borrowings of other enterprise. Sir, here again, this company, other enterprise A Limited. it has 100 crores of total borrowings. Out of this 100 crores, the guarantee given with respect to borrowings are like 20 crores. With respect to 20 crores, guarantee has been given. 20 crores now, how much it is like? More than 10% of the borrowings, right? So again, these two are also called as associated enterprise. Then one enterprise manufactures or processes goods. To this enterprise, other enterprise may provide know-how, patent, trademark, license, franchise, or any of that similar nature, and the production process is wholly dependent on those know-how, patent, trademark, license, franchisee, or of any other similar nature. It's not like partly dependent, wholly dependent on those know-how, patent, trademark, licenses, franchisee. Then they are called as associated enterprises. Then one enterprise manufactures or processes, and then the 90% of the raw material or consumables needed, 90% or more, are needed or supplied by other enterprises. Then they are also called as associate enterprises. Then one enterprise manufactures or produces, and those goods are sold to other enterprise or persons specified by other enterprise, whereas the conditions are influenced by whom? This, okay, sir, one enterprise is selling their whole production to other enterprise, associated, whereas not selling to other enterprise, but to whom the goods has to be sold is decided by this other enterprise only. Okay, now whether the goods has to be sold to this person or not is decided by other enterprise. What price, what conditions, all those. Then these two are also called as what? Associated enterprise. Then individual controls one enterprise. Individual controls one enterprise, let's say A Limited, whereas individuals relative are both together, individual and relative together, or is relative, controls other enterprise. Then the both these enterprises, sir, I'm controlling MDK Private Limited. My brother also own a company. He is controlling another company. Now my company and my brother's company both are also called as what? Associated enterprises. Then HUF controls one enterprise, whereas the member of HUF or relative of a member of HUF controls other enterprise. Okay, sir, I'm a member of my father HUF. Okay, see, our HUF as a family, we have investment in one company, where HUF and the company are associated enterprises. Me individually, I have invested in another company, so me and that company are associated enterprises. Since I am a member of that HUF, the company controlled by HUF and the company controlled by me, both are also associated enterprises. Then enterprise 1 and enterprise 2, between them there exists any relationship of mutual interest, then they are also called as associated enterprises. Totally how many, sir? 13. So now see, what are those 13 associated enterprise relationships? One enterprise holds greater than or equal to 26% of voting power directly or indirectly. Next, the same person has more than or equal to 26% of voting power in two entities, two enterprises, then both those are also associated entities. Then one enterprise, in a form AOP or POI, the others will having more than or equal to 10% of interest, being profit sharing ratio. Then one enterprise appoints greater than 50% of directors or greater than one executive director, related persons. And then a person can appoint more than 50% directors or more than one executive directors in two different companies. Then both those companies are also associated enterprises. Then one enterprise grants loan. One enterprise grants loan, and the loan amount given is more than 51% of the, or equal to 15% of the total assets of the other enterprise, associated enterprises. Guarantee given, the guarantee given is more than or equal to 10% of the total borrowings of associated enterprise. Then know-how, patent, trademark, licenses, such kind of similar nature has been given, and the other enterprise production is completely dependent on them, associated enterprises. Next, one enterprise is into manufacturing or processing. The other enterprise has supplied raw material or other consumables. 90% of them are supplied by them only, associated enterprises. Next, where one enterprise manufactures and processes goods and sell goods to other, whereas the goods the goods sold to other enterprise, the conditions are decided by the other enterprise. Then also they are called as what? Associated enterprises. Then individual controls one enterprise, his relative controls another enterprise, then both those enterprises are also associated. Then HUF controls one enterprise, his relative of each of member of each of or member of each of controls another enterprise, then also both are associated enterprises. 13th one, residual case. So this is about what associated. So we have completed this associated enterprises, right? As I'm saying, like arm's length price we'll be taking, because since they both are associated enterprises, the price between them might have compromised. So we cannot take that price or the cost, whatever it is. So that's why we'll be finding out what arm's length price. So how do we find out arm's length price? Section 92 CSA is like arm's length price means price which is applied or proposed to be applied in a transaction. So in this associated enterprises transaction, the price which we are going to apply is called as arm's length price, which is happened between persons other than associated enterprises in uncontrolled transactions. So there is no influence there, and those are not associated also. In such cases, the price happened between them now. So that which we'll be applying for this associated enterprises transaction is called as arm's length price. So for determining arm's length price, there are like two kind of approaches. One is like transaction based method. The second one is like profit based methods. Sir, we'll be mostly following for the academic purpose transaction based methods only. Profit based methods, actually these are not, we don't have much problems also on this. Only on profit split method there is a problem which has been added now in the workbook. I'll be discussing that one as well for you. So first our focus is on what? Transaction based methods. How many methods are there? Transaction based methods? 3. Comparable uncontrolled price method. Very simple, sir. Comparable uncontrolled price method. Sir, me X Limited in USA, both are associated enterprises. So it has sold goods to me, or I have it has sold goods to me. So this is like compromised transaction. So here price you cannot take. So find out an arm's length price. So through that also through what? Comparable uncontrolled price. Comparable uncontrolled price. Na, that USA X Limited is there, na, that even supplies goods to some other person in India. For him, with him there is no associated enterprise relation and all. So whatever is the price charged to him is called as uncontrolled price, right? So we'll take that one. Nothing but identical or similar good price. That we'll take. To that, we'll adjust the differences. So we'll adjust what? The differences, like in differences between my transaction and his transaction. Let's say I might be buying at like a high volume, whereas he is not, he is buying at a low volume. So I might have some extra discount that for him warranty is provided, for me not warranty is provided. So those kind of adjustments will be there, na? So those adjustments you will take, and the price which is happened between the unrelated person, that will take as base and will adjust the prices. That is called cup method. Then resale price method. So resale price method, na, my associated enterprise has sent goods to me, sold goods to me. Now the same goods I am selling to someone else. So I have a resale price. So nothing but here I'm going to sell those goods like the same way to some other person. Then what we'll be doing, like we'll take the resale price, okay, and then subtract the normal gross profit margin. Whatever is the profit margin will be there, that will be subtracting in a similar transaction. Let's say, okay, that one. And then purchase related, if any expenses, if any other expenses are there, we'll be subtracting. So will be, this is what? Resale price method. My selling price, from there subtract the gross profit margin in a similar transaction, and even subtract the purchase related expenses. This is what? Resale price method. Then there is cost plus method. What is cost plus method? You will take the total cost, direct cost or indirect cost, and add normal gross profit margin in a similar transaction. Sir, here cost route na you are adding profit margin. Here sale price route na you are subtracting gross profit margin. And here you will be again adjusting for any differences with respect to international transactions. Okay, so then you will be getting the cost plus method. So 3 most popular methods with relation to problems are like cup method, cost plus method, CPM method. Cup method na controllable uncontrolled price method. Okay, then cup method na comparable uncontrolled price method. Next, CPM, cost plus method. Third one, resale price method. So these 3 methods are most familiar. Okay, I'm not going through this profit split method, transactional net margin method. So profit split method na nothing but the profit would be splitted between the associated enterprises both, okay, based on the risk they have taken, based on the processing they have made, and then the value will be arrived. So there's a problem on it, we'll do at last. Then transactional net margin method. Transactional net margin method na, so what is the margin that would be there in the similar kind of transactions that would be taken, based on that it would be arrived. So okay, comparatively these 3 are only more relative. And the next one is like any other method which is prescribed. Okay, now sir, what if more than one arm's length price is available? Sir, Exin Corporation in USA and me are associated enterprises. X Incorporation sold goods to me. It is an international transaction. We are associated enterprises. So transfer pricing provisions are applicable. We cannot take the price which was happened between. Now we need what? Arm's length price. Arm's length price na comparable uncontrolled price na X Incorporation might have sold goods in India. It has sold to A, B, C, D, E. So many people it has sold. Okay. So if it is sold to so many people, how many arm's length prices are there? There are 3 or there might be 5, there can be 10, so many arm's length prices will be there. So that how many arm's length prices, I mean how many comparable transactions are there, how many arm's length prices are available, you need to check. If they are like within six, okay, so I mean my kind of similar transactions are only 3. So there are only 3 arm's length prices. Out of those 3 also, which you should take, okay, take the arithmetic mean of all those 3. Arithmetic mean all those 3 add and divided by 3. That is called as the arithmetic mean. Okay, and take that arithmetic mean and compare the difference between that average you have calculated. Na? Arithmetic mean is nothing but average. That average and the actual price. If the difference between them is within 3%, then no problem. Actual price itself can be taken as arm's length price. The difference should be within how much? 3%. Then no problem. Next, 1% only, sir. The margin should be only 1%. Like the difference between them should be only 1%. In case of wholesale trading, if it is within 1%, then only you can take it as what? Arm's length price. Normal cases, na 3% is the variance that could be there. Within 3% variance, na, no problem. Actual price only take as arm's length price. In case of wholesale trading, the difference should be only within 1%. More than 1%, na, that average you calculated, right? That itself only taken as arm's length price. Next, if the values or if the arm's length prices available are greater than or equal to 6, then there is something called range concept. There is something called what? Range concept. So this range concept is applicable. What is this range concept? How many ever arm's length prices you have available? Let's say I have 10. 150, 152, 153, 155, 158, 145. So like that I have total 10 arm's length prices. Arrange all them in ascending order. What does it mean by ascending order? Lower value to higher values. So like that arrange. Then we have 10 numbers, right? 10 data set, right? From there calculate 35 percentile. Sir, out of 10, 35 percentile, it is how much? 3.5. Then even calculate 65 percentile. 65 percentile, 10 into 65. That is what? 6.5. So 3.5, 6.5. Okay? Are you able to understand, sir? So out of the 10 data ranges, we need to calculate what? 35 percentile. 35 percentile is what? This red line. And we need to calculate even the 65 percentile. 65 percentile is what? This red line. Okay. Now, in between this is there, na? This is called range. Between 35 percentile and 65 percentile. Okay. That is called range. If the actual price is between this range, okay, let's say we have 10 transactions, 150, 152, like that. So here the value is somewhere like, let's say take 145. Here it is coming somewhere like 155. If within that only the actual price is there, take that price as the arm's length price, no problem. Okay. If it is not within this range, if the actual transaction price is not within this range, what to take? Now again calculate 50% here. 50%. Okay. So 50th percentile also you will calculate. That itself will be taken as arm's length price. See, arrange values in ascending order. Calculate 35th percentile and 65th percentile. Actual price is not between the 35th and 65th. If it is within this range, then take that itself as the arm's length price. Not there, then 50% shall be taken as arm's length price. Then these percentiles are, sorry, you are calculating here 35. So 35 means our range, what our data set, what we are expecting, like 10 numbers we are having. I mean 10 data values we are having. 10% of 35% na 3.5. It's not a whole number, sir, because it is in points. It is in fractions, na, so it's not whole number. Same way 65% na 66.5. It is also not a whole number. Okay. Whereas 50% if you do, it is like what? 5. It's a whole number. See, we are having 3 calculations here. 35, 65, 50. 35 na 3.5, not a whole number. 65 na 6.5, not a whole number. If you do 50% na 5, it's a whole number. So what to do? Sir, if it is not a whole number, 3.5 na, then take the value at third row and take the value at the fourth entry. Those two you should take the average. So for you, I'm giving a example also, sir. 1, 120, 125, 130, 132, 135, 138, 140, 142, 147, and there is 150. So first we need what? 35 percentile. 35 percentile equals to how much? 3.5. So 3.5 is not there. 3 is there, 4 is there. So what you should do? Take 3 plus 4 divided by 2. That equals to 130 plus 132 divided by 2. That equals to 131. Then 65 percentile you should do. 65 percentile now how much? 6.5. Sir, we don't even have 6.5 here. 6 we are having 138, 7 we are having 140. So what you should do? 6 plus 7 divided by 2. That equals to 138 plus 140 divided by 2, which equals to again 139. Then 50th percentile, how much? 5. 5 is a whole number na? Yes, available, 135. But still you cannot take that straight away. See, if it is a whole numbers, then take average of that number and the next number. Whole number na, take average of that number and next number. So 5 and 6. 135 plus. Okay, so if it is a whole number, what you should take? 5 plus 6 divided by 2. That is nothing but how much? 135 plus 138 divided by 2. Divided by 2 now how much? 136.5. This is the arm's length price. Okay, so this is the range concept. This range concept is applicable only for cup method, cost plus method, resale price method, and transaction net margin method. That means not applicable in case of profit split method. Not applicable in case of what? Profit split method. Clear? So now we are moving on to the next topic. Not topic, directly into the problems now. Okay, so first we do one cup method related problem, then we'll finish off the other models, and at last again we'll discuss some cup method problems. First one, X Limited is an Indian company which supplies 50,000 products to Y Limited, a German company. See, I have decoded the question also. X Limited supplied 50,000 products to Y Limited, which are associated. So these two are what? Associated enterprises. How many? 50,000. The price, FOB price. Sir, FOB na what? FOB means only till, okay, this is the price only till they hand over the goods in foreign country. FOB price na. In Germany, they'll hand over. From there, all the delivery and all you should only bear. 4,000. Okay. It supplies 5,000 products to Z, which is not ascertained. Okay. How much? 5,800. Sir, for Z na, they will deliver the goods at their place for 5,500. But for Mr. Whom? Y Limited. Okay, for Y Limited, it will not deliver the goods. It will hand over them in the port in Germany only. Port in Germany only. So then the transport and all has to be paid by whom? Y Limited only. So Z Limited, they charged 5,800 with the delivery. With the delivery. Remember that one. Next. For 5,800. And that 5,800 is also including of what? Warranty charges also. But whereas to Y Limited, they are not giving any warranty. For Z Limited and all, they are giving warranty also. That means this 5,800 includes freight. That even includes what? Warranty as well. Okay, then insurance and freight charges are rupees 600. That freight charges also they given. Profit disclosed is 8. Sir, simple thing, sir. To an unrelated person, they are selling it for 5,800. But that 5,800 is inclusive of what? The transportation cost from Germany to India, insurance cost, and even it even includes what? Warranty cost also. So take the comparable uncontrolled price. How much? 5,800. 5,800. And next, insurance and freight 600. Warranty 300. Because that is inclusive of those two na. So you need to subtract them. Because for Y Limited, those things are not provided. What? Insurance and freight and warranty are not provided. So that's why to make it a comparable, you are subtracting those two costs which were only provided to Z Limited. Then discount is given to whom? Y Limited. How much discount? Whereas such discount is not there to Z Limited. Okay. So I mean, if discount is given now, what is the price? That you should arrive, right? So discount also you should reduce. Okay. Discount also you should reduce. Sir, simple things are here. Simple thing, how do you should understand is like, for you, assume like this person, for you, like Y Limited na, Y Limited assume as you. For you, you are getting at how much? 4,000. After discount, this is after discount, you are getting for 4,000. Whereas to an unrelated person, they are selling it for 5,800. For them only high price. Okay, for you 4,000. That's why only transfer pricing came. Because it seems to be like what, there's so much difference now. That's why. But you cannot straight away take the 1800 difference as the difference and you cannot add it to the profit. So that's why. Why? Because both are not compared here. The terms are different. So you should make them comparable. What are those differences? For you, no delivery is made. For them, delivery is made. That's why those delivery charges also included. That's why it was how much? 5,800. So delivery charges, I mean the transport, freight, insurance, subtract. Okay. For you, warranty is not given. That's why 4,800. For him, warranty also given. That's why 5,800. Subtract that warranty also 300. For you, discount is given. That's why after discount it is 4,000. For that fellow, no discount. Sir, why discount only given to you? Sir, see the volume, sir. You purchased 50,000 goods. That fellow purchased only how many? 5,000 goods. So you purchased so many goods. That's why you got discount. That fellow, no discount. So you should reduce the discount also. If at all discount given, what would be the price? So from 5,800, subtract 600 insurance and freight, subtract warranty 300, subtract discount 200. So it will be how much? 4,700. So 4,700 is the comparable uncontrolled price method related arm's length price. Whereas the actual price transaction is happened for how much? 4,000. So there's a difference of how much, sir? 4,000. There's a difference of how much? Sorry, there's a difference of how much? 700. That means your associated enterprise is selling for your value less than, okay, is selling for your value less than how much, sir? 700 rupees. So that 700 rupees need to be added to what? To the profit. So amount of profit to be increased equals to 700 into 50,000. 3 crore 50 lakhs is the profit to be increased because of transfer pricing adjustments. Sir, one more thing you should understand, sir. Okay, I didn't said, but I'll be referring to that also. Because of transfer pricing, I said right already. Okay. Because of transfer pricing provisions, either the income should increase. Here increasing only should increase of what? The Indian enterprise. The Indian enterprise related income should increase or loss should come down. Then only transfer pricing shall be applicable. Here what's happening? The Indian companies related profit is increasing because the Indian company is the one who is selling goods. That's way. Okay. Then this is like cup method related question, sir. Cup method. Sir, where is it? Sir, this cup method and all, there are 3 questions. First 2 questions, you should properly apply your brain. Otherwise, you'll confuse them. Okay. You'll get confused. So clearly listen to that. Logic, once you understand, it's very easy. So transfer pricing, especially these sums, it's not about the tax part you studied. It's about the logic you know. Logic you understand, the sums are like very easy only. If logic you didn't get it, then how many times you revise transfer pricing, the sums you cannot do, sir. Especially these methods related sums. Here, common sense, that logic understanding plays a crucial role. When it needs to be added or it needs to be subtracted, or that kind of logic will be there. Okay. Here we have subtracted these two like the same way. Okay. Brain Incorporation London has 35% equity in Salem Limited. The company Salem is engaged in development of software. So Salem is an Indian company. It does what? Development of software across the globe, which includes Brain Incorporation. Brain has 35% equity now, which is greater than or equal to 26%. So they are what? Salem Limited and Brain Incorporation or associated enterprise, and Salem is providing, developing and maintaining software to Brain Incorporation. Next, done. During the year, Salem spent 2,000 man hours for developing and maintaining a software for Brain Incorporation and build 1,000 per hour. Can we take this 1,000 per hour? No, this is what? Actual transaction price. This actual transaction price we cannot accept because here it is, these are associated enterprises and there is an international transaction here. So transfer pricing provisions apply. You cannot take this 1,000 into 2,000 as the actual price. The cost incurred for executing the maintenance work is like 15 lakhs. The cost incurred by this Salem Limited is given. How much the cost incurred? 15 lakhs. 15 lakhs. Whereas similar work is done for an unrelated party, they will do it with a profit of 50%. Sir, when they simply mention it as like profit of 50%, this profit of 50% is on what? Selling price, not on cost. Profit of 50% is on what? Selling price. It is not on cost. So take the profit margin for an unrelated person is how much? 50%. Then Brain Incorporation gives technical support. Sir, who is giving technical support, sir? Brain Incorporation is giving. Brain Incorporation is seller or buyer? Brain Incorporation is giving what? Brain Incorporation is giving the tech support. Sir, that means actually the service provider is whom? Salem Limited. But Brain Incorporation should pay only money for that services it has taken. But Brain Incorporation is providing what? Tech support. That means they are paying partly in money, partly by way of tech support. Okay, that means since they are providing tech support, you will reduce the price for them now. You will reduce, sir, for outsiders, you are ensuring that 50% profit should be there. 50% profit. Because outsider will not give you any other benefit. Only you sell goods or you sell service, he'll be paying money. That's why you are expecting how much as the profit margin? 50%. But this Brain Incorporation is giving you tech support. Okay, so that means an advantage is there to you. So what you will do? You will reduce the price to him, right? How much you are reducing? So the impact of this tech support is like 8% of gross profit. 8% of gross profit is the effect of tech support. Okay, so to the extent of 8% of gross profit, you will be reducing the price to this particular person because he is giving you an added advantage. First one. Second one. Salem Limited gives credit of 90 days of the cost, of which is 3%. Sir, you are giving credit of 3 months. Sir, when you give credit of 3 months, you are losing the interest time value of money. Okay, to whom you are giving? Is given credit of 90 days of the cost, which is 3% of the normal billing rate, which is not given to others. Outsiders you will not give. But for your related person or your associated person, you are giving how much? 90 days credit. Sir, usually when someone pays you instantly, you'll give a benefit or you'll charge normally. But when someone asks you credit, you'll charge more, right? You'll charge more, right? For a person who is paying instantly itself, the margin is 50%. If a person is asking 3 months credit, then you will take more margin, right? Because you need to cover even the interest part. So here also, the 3% is what? Is of normal billing rate, which is not given to other parties. So the 3% of profit is there, 50%. That also, sir, here understand. Okay, credit you are giving to your associate enterprise more period than compared to others. So because of this, you should charge more actually. I mean, your profit margin should be much more higher to the extent of this. So this 3% should be adding. Understand? So take the gross profit margin 50%. Tech support. So tech support. Sorry, you are thinking from whose perspective? Salem Limited perspective. So if you are getting tech support additionally, so you are reducing the margin little bit. That's why how much? 8% of 50%, 4% got reduced. But you are giving extended credit. Okay, normally instantly you have to pay, but you are giving here 3 months extended credit. That means what you will do? You will ask extra, right? That's why you are asking extra how much? 3% of 50%, 1.5%. So the arm's length markup is 47.5%. The arm's length markup is how much? 47.5%. On what it is? On selling price. Do we have selling price? No. What we have is only cost 15 lakhs. So how to do the selling price, arm's length selling price by using cost? Take the cost 15 lakhs. So now 100 minus 47.5 is there, that you should divide it by 15 lakhs. Okay, 15 lakhs divided, or simply you can do, okay, if y division and all you are not applying now, cost 15 lakhs. Cost 15 lakhs. Sir, if 47.5% is the profit on selling price, then what is the cost involved in it? 47.5 minus 100, that equals to how much? 52.5% is the cost. I mean 15 lakhs equals to 52.5%. Then 100% is equals to how much? You should bring that. If 15 lakhs equals to, sir, understand, profit is how much? 47.5%. Okay, that means what is the cost? 100 minus 47.5 is only cost now. So 52.5% equals to cost. That means 15 lakhs equals to 52.5%. What we need? 100%. So 100% equals to how much? Nothing but you will be getting the same. Okay, you do cross multiplication, 15 lakhs into 100 divided by 52.5%. You'll get this 28,57,143. From there, what is the actual build amount? You build how much? 2000 man hours into 1000. 2000 into 1000 if you subtract 20 lakhs, then the increase in total income to be made is how much? 8,57,143, because the arm's length is 28, but you charged only 20 lakhs. So 8,57,000 you should increase. Clear? Are you able to understand, right? Now, We are going to the next one. SDLLP, a foreign company, holds 32% of voting power in ZX Limited. ZX Limited, Mumbai, an Indian company, provides banking related software services. So SD is a foreign company, holds voting powers in ZX. ZX is an Indian company. ZX provides what? Banking related software services to its clients. SDLLP is also one of the major customers. Okay, so ZX Mumbai is providing services to SDLLP. So for you to understand, who is the service provider? ZX Limited providing service to SDLLP. SDLLP. Service to SDLLP. Okay. And these two are associated enterprises because the voting share is the voting power is greater than or equal to 26%. So these two are associated enterprises also. Okay. During the previous year, it has billed 30,000 man hours at 36 per man hour. $36 per man hour. Fine. Direct costs, the costs which they have incurred are like $18 per man hour and indirect cost 12 per man hour. The cost is like how much? Direct 18 per man hour, indirect 12 per man hour. So total $30 per man hour. How many man hours? 30. So 30,000 into $30 into, what is the conversion rate given? The conversion rate given here, sir, clearly. So take it as like simply how much? 80. So into 80 if you do, this is what? This is the cost given in the question. This is what? The cost given in the question. Okay, now, if at all, Colombo is also a client to ZX. So ZX here not only providing to the foreign incorporation SDLLP, it also providing similar services to whom? Similar services provided to ZX Limited. Okay, Colombo is also a client of ZX Limited. TY Incorporation is the other person to whom ZX is providing similar services, where they charge 45% of profit to operating costs. Sir, understand? Here 45% of what? Cost or selling price? Cost. Here it is 45% of what? Cost. Whereas in the previous question it is what? 50% margin they given, but that margin is on selling price. Whereas in this question the margin is on what? Cost. So you should have that clarity. Next. However, the following aspects may be noted. Since SDLLP now your associated enterprise gives huge volume of business because they'll buy in so much quantity, a special quantity discount is given which may be taken at 8% of gross operating margin. Sir, you are a seller. One person came and buying only one good, whereas the other person buying 100 goods. For whom you will reduce price? To the one who is purchasing 100 goods, you will be reducing the price now. For the person who is buying only one good, you are having 45% margin. If someone is buying 100 goods, you will give discount now. So your price would be, your margin will be 45%, will come down, right? Because you are giving discount there. Okay, that's why from 45%, whatever is the discount mentioned here, subtract. Because when you are okay with giving discount to them, okay, so once you are giving discount, your margin will come down. So that's why because of this discount, you should reduce it from the margin. Then SDLLP provides some technical support because of its specialized knowledge in the banking domain. No such support is derived by the SEC from TY Incorporation. Sir, SD now whom? Buyer. Sir, your buyer is giving you additionally tech support also. Sir, usually to an unrelated person, if you sell, he'll not give any tech support and all. So you are having margin of 45%. But this person is giving you tech support also. Some extra benefit he is giving now. So what you will do? You will reduce price. Once you reduce price, your margin will come down. So your margin will be reducing now. So that's why this tech support related benefit you are coming now. That's why you will be reducing your margin. Understand? Common sense, basic common sense. Your buyer giving you tech support. So normally you will charge 45% margin. But since your buyer is giving you tech support, you will reduce price. When you are reducing price now, your margin will come down, right? So that's why this tech support related also you should subtract. Third one. LLP has given a credit of 15 days. Okay, to your related person or associated enterprise, how much credit you are given? 15 days. Whereas to outsider, you will give 45 days. Sir, how much, sir? How unjust it is? Outsider, you will give 45 days. For your person, you will give only 15 days. Okay. For this extent, impact of extra credit provided, it is like 5%. Sir, this is again the same basic logic. For whom you will charge extra? If you give 45 days credit, you'll charge extra. Na 15 days credit, you'll charge extra. Na 45 days only, you'll charge extra. Okay, with 45 days credit itself, you are having 45% margin there. Here 15 days credit only, na, that means much more margin should be, okay, the margin should be little less, right? So understand, a person came to me and said like he'll pay after 1 year. With that person only I'm earning 40% profit. If at all some person is paying now itself, na, I'll be giving it for a lesser price, right? Because when I am selling it to that 1 year credit person, I need to cover the interest cost. But when someone is paying within 10-15 days, now I need not to bother about interest and all. So that's why what I'll do, I'll be giving it for a lesser price. That means I'll be giving it as a lesser price. When I'm giving it a lesser price, my margin again will come down. So here also this margin will come down. So all the three needs to be subtracted. All the three needs to be what? Subtracted. So look at the answer, sir. Discount 45% is from there. Sir, here 8% we cannot subtract directly because that is on profit margin. 10% also. So 8% on 45, 3.6. 10% on 45, 4.5. Then 5% on 45, 2.5. If you subtract all this, 34.65 is the arm's length price margin. This arm's length price margin, on what you need to apply? You need to apply on cost, not on selling price. So you should not divide it the difference and all. So on cost, directly apply this 34.65% and add. Okay. So arm's length price in India is like, first you will calculate 30,000 into 18 plus 12, okay, into 80. So this we wrote now, that one we did. How much it is? 7.2 crores. For this 7.2 crores, add 34.65%. If you add, what is the arm's length price? 9 crore 69 lakh 48,000. And the actual price is how much? 30,000 into 36 into 80. What is the actual price? 30,000 into 36, because they charged 36 into 80. How much it is? 8 crore 64 lakhs. So the difference is like 1 crore 5 lakh 48,000, which is the increase in total income. Sir, this is December 23 exam question also. Okay. If you refer to the MTP or even to the exam question, you will not get this basic explanation and all. Straight away they'll calculate like this. So you will not be understanding how they got this 34.65% also. Okay. They don't even give this 34.65% also in the answer. Okay. It has taken me a lot of time, but I thought like it's a valuable time because I could properly explain you with respect to when the margin is given with respect to selling price, how to do. When the margin is given with respect to cost, how to do. There's a third similar kind question also in workbook, but it is simple only, sir. Just like as the first sum. Galaxy Incorporation hold 40% equity in Comet India. Comet is engaged in providing designing services. Comet rendered 2,500 man hours for Galaxy, charging 1,200 per hour. So actual price, how much? 2,500 into 1,200. Whereas the cost is how much? 22 lakhs. Okay. The profit margin they are having is how much, sir? 55. Sir, they didn't said like on cost. That means you should take it on what? On selling price only. So start with what? 55% gross profit margin. Now, Galaxy Incorporation. Sir, here who is the seller? Who is the buyer? Comet Limited is the seller. I mean the service provider. Whereas Galaxy Incorporation is there, na? That Galaxy Incorporation is the buyer. Galaxy Incorporation is the buyer. Okay. Now, Comet Limited is getting what? Galaxy Incorporation, your buyer, giving you additionally infrastructure support, cloud infrastructure support and all. So not only money, he is giving you cloud infrastructure support. Once he is giving you cloud infrastructure support, now outers know they'll not give such kind of benefit. But this buyer giving cloud infrastructure support. So what you will do, since you are getting cloud infrastructure support, to that extent you will reduce now. You will reduce price now. Once price reduce, your margin will also reduce now. So to this extent, you should reduce. Then Galaxy, to this Galaxy Incorporation, you are given 60 days credit. Okay, you asked him to pay after 60 days. Whereas that is not given to unrelated persons. Unrelated persons now they are giving instantly. Instantly paying itself, you are getting 55% more margin. But this fellow asking 2 months credit. 2 months credit now you will incur additional interest cost and all, right? Time value of money and all you are losing. So you will be having more margin here. Okay, you will increase price. When price increases, margin will also increase. So what you should do, this you should add. So second point you should add. First point you should do subtract. Okay, sir, don't try to by heart thing. If you ever by heart these kind of adjustments, you'll never do. Understand the logic. Okay, when we are doing this, what is happening actually? Okay, this simple logic. Okay, close your eyes and think of it. When the buyer is giving you cloud infrastructure support, it's an additional benefit he is giving. Since he is giving you additional benefit, you will reduce price to him. Once price is reducing, the margin shall also reduce compared to the other outsiders. So outsiders, it is 55%. So compare, this person is giving this cloud infrastructure support now. So the margin, the price decreased, margin decreased. So from there to bring there, you need to word minus. Okay. Next, credit. Credit, what is happening? Outsider, no credit. For him, 55% profit. Okay. But whereas your associated enterprise is asking 2 months credit. That means the price should be little higher because credit is given na, little higher. When little higher na, even the profit will also be little higher. The profit will also be what? Little higher. So then what to do? The profit will also be little higher. So what to do? This related extent you should add. So if you add these two, okay, first you should subtract 10% of 55 and 2% of 55. If you subtract, then you'll be getting how much? Okay, sorry, it got. Okay, so arm's length price markup is like how much? 50.6. This is on what? Selling price. So what you should do? 49.4 is the cost. That is how much? This 22 lakhs is there now. This is equivalent to 49.4%. So you should calculate 100%. 100% is how much then? 44,53,441. So what is the difference between actual billed amount? Actual billed amount is how much? That 2,500 into. Okay, 2,500 into 1,200. That is how much? 30 lakhs. If you do the difference, it is 14,53,441. Increase in total income. This is called as what? Arm's length price adjustment. So this is the arm's length price adjustment you need to do. So I hope so it's going very well, right? See, so now before solving the other problems, so you need to understand this particular section, section 94A. This talks about central government may notify any country or territory as notified jurisdictional area. When they can notify such areas as notified jurisdictional area, that countries are not supporting or not entering into any treaties to share the information and all. Okay, so where Mauritius and all, you'll see in movies also, where so many shell companies will be formed and all. So those countries will not share information or will not enter into treaties with India. So those areas will be treated as like notified jurisdictional areas by central government. Once if it is notified as a notified jurisdictional area, then even though he is an unrelated person, sir, let's say Mauritius is a country or territory which has been declared as notified jurisdictional area. From there, one person sold goods to me. I don't even know his face. I never seen him also. Okay, but still, since he is from notified jurisdictional area, we both will be treated as associated enterprises only, and the transaction would be treated as a deemed international transaction. Hence, all the transfer pricing provisions will be applied. So, since even though it's not a actual associated enterprises, but since he is in notified jurisdictional area, transfer pricing provisions will applicable. So I need to maintain all the documents and information related to it. Then, if any payment is made to a person located in notified jurisdictional area, if I am making any payment to such person, I need to deduct TDS at 30% or the rate prescribed in Income Tax Act. One more thing, sir. When you are doing a transaction with a notified jurisdictional area person, while deciding arm's length price, usually 3% variance will be there now. Usually arm's length price with 3% variance will be there now. That is not applicable. I mean, you should not give that 3% variance also. Just check with whether the arm's length price is only the price or not. Difference na, then add that to the profit computation and all. Okay, so that is the point here. Now come to the question. BPL Limited, the SSE has sold goods on 12th January 2024 to X Limited, located in notified jurisdictional area. Sir, BPL Limited, India. This fellow can sell to some other, to whom he sold? He sold to a person who is in notified jurisdictional area. Unrelated person only, but still it is what? Deemed to be a international transaction. They are deemed associated enterprises. Transfer pricing provisions are applicable. Which section said that one? 94A. Okay. Now, during the current financial year, BPL charged 11.5 crores from JD of New York. So this BPL is supplying the same kind of goods to JD of New York for how much? 11.5 crores. And even supplying to ZZ of London, how much? 12 crores. To others, 12 crores and 11.5. With this person, how much? 10.5 crores, and is in notified jurisdictional area. Now, okay, and this ZZ and JD are not associated enterprises, are not associated enterprises, and are not, they are not even situated in notified jurisdictional area. Next, see, while sales to JD and ZZ are on CF basis, sir, to these two unrelated persons, now you are selling on what? CF basis. I mean, you are only incurring freight, whereas to that particular unrelated person, to that deemed associated enterprises, you are selling it for what? FOB only. I mean, you are not incurring transportation cost, whereas here you only have to bear the transportation cost also. So here the price is little high now, because you are bearing transportation cost and all. Okay, whereas here no transportation cost. Remember that one. Then, so they paid ocean and freight charges how much, sir? 20 lakhs. And then India has a DTA agreement with USA and UK. With USA and UK, they have DTA agreement. The SC has a policy for providing after-sales service to the tune of 14 lakhs to all the customers except X Limited. So to that notified jurisdictional area person, you are not even providing after-sales support also. But to the outside, but to this ZZ Limited and ZD Limited, you are even providing sales support also. So to this ZZ and to this ZD, you are providing delivery. So freight is extra. You are providing what? Extra sales support. That part is also extra. Since you are not charging them, you are not providing them to notified jurisdictional area person, price would be little lesser only now. So what to do now? Here, which method is better, sir? By reading the question, we can understand. Here, they didn't given the profit margin and all, nothing. They have given the comparable prices. So it is what? Comparable uncontrolled price method. That is the appropriate method here. So you'll be following what? Cup method. So you will taking the prices which were sold to ZZ Limited and the ZD New York. Okay, how much? 11.5 crores and 12 crores. 11.5 crores and 12 crores. Then sales support. Okay, sir, not sales support. Transportation. Sir, transportation not given to that person, but given to them. So you should subtract that now. Okay, you should subtract, because that person cost you should come. Okay, we need the price without transport, without sales support, how much you might have charged. That's why subtract transportation. 20 lakhs subtracted. Then sales support provided now, but whereas that person sales support is not given, subtract sales support also. So subtract sales support, how much? 14 lakhs related. Okay, 14 lakhs subtracted. Then what is the arm's length price here? 11.16 to ZD, 11.66 to ZZ. So two arm's length prices are available. What to do? Remember one thing. When two arm's length prices are available, what we will be doing? We will be checking whether the data sets are within 6 or greater than or equal to 6. Okay, where they are like within 6, or whether they are 6 or more than 6. Sir, here there are only 2. That means what you'll do? You'll take arithmetic mean. Arithmetic mean divided by 2. Divided by 2, how much? 11.41. And here it is what? Sir, here 3% that range differences and all will be there, right? Can you take that? No. Why? I said here already. Where if it is with a notified jurisdictional area person, that 3% variance margin and all you need not to check. Okay, that space, that okay, even though the actual price is within the 3% difference also, still you take the arm's length price only. You cannot take the actual price here. So what is the actual price? 10.5 crores. Arm's length price is how much? 11.41. Difference is how much? 0.91. So this is the increase in profit to be made. Increase in the profit to be made, because outsiders you are charging 11.41. This deemed associate enterprise 10.5 only. So the difference you need to add it to your profit. Okay, so look at the theory. A transaction where one of the parties is a person located in NZA would be deemed to be an international transaction, and all the parties would be deemed as associated enterprises. Accordingly, all the provisions of transfer pricing apply. As the transaction between BP Indian Company and X Limited would be deemed as international transaction. The transactions between ZD and ZZ of London are for sale of identical goods are comparable uncontrolled international transactions, since they are neither associated enterprises nor situated in NZA. Hence, comparable uncontrolled price method can be determined. Where one or more price is determined by the most appropriate method, cup method in this case, then arithmetic mean has to be taken where the number of entities is less than 6, because here in this case only 2. However, the benefit of permissible variation of 3% is there, na? That is not available here. Next. Xenon India Limited, an Indian company, sold goods. Next one, sir. This is from workbook. Xenon India Limited, an Indian company, sold goods on 15th January. A company located in notified jurisdictional area. Okay, you sold to unrelated person only, but that fellow, they are in notified jurisdictional area. You cannot do anything. Deemed associated enterprises, deemed international transaction, transfer pricing is applicable. Actual how much? 9.8. During the same financial year, identical goods were sold on CIF basis to unrelated customer in Germany for how much? 10.7 crores. Okay, but this is on what basis? CIF basis. Whereas to the NZA person, notified jurisdiction area person, it is on FOB basis. That means to unrelated person, you are even providing the transportation also. And then sales support also you are providing. How much to the extent of sales support? 12 lakhs to customers as per the 12 lakhs. So I mean extra to unrelated person, who is he? The one who is in Germany, you are providing transportation 18 lakhs worth extra and sales support also 12 lakhs worth extra. So you should subtract them to arrive the arm's length price. When you are following what? Comparable uncontrolled price method, CUP method. Okay. Whereas here the cost plus method related value also given 11.2 crores. But can you take 11.2 crores? No, sir. Here comparable uncontrolled transaction is available. If it is available, you should give the basis to whom? Comparable uncontrolled price transaction method only, because that is the most appropriate method. Most appropriate method. So price in comparable uncontrolled transaction 10.7. From there subtract freight and insurance after sales support. Then what is the arm's length price? 10.4. Whereas the actual price is how much? 9.8. Sir, variance 3% can we check out? No, that is not available. So if you see what is the 0.6 crores is the difference. This has to be added to the total income. This has to be added to the total income. Right then. Arbitron Limited, an Indian company, receives technical advisory services from its German subsidiary Nova for a consideration of 85,000. Sir, who is the supplier or who is the seller? Who is the buyer? Technova, where Germany. It provides services to whom? Arbitron. Okay. For how much? 85,000. And these two are holding and subsidiary. So they are what? Associated enterprises. So here it is only 85,000 euros. In similar transactions with unrelated persons, Technova charges 1 lakh euro dollars per year. Arbitron reports a profit of 78 lakh before arm's length price. Assume exchange rate as how much? 68. Compute the taxable income, assuming arm's length price as 1 crore or 1 lakh euros or 50,000 euros. Sir, which method we need to follow? Here comparable transactions only given na, CUP method. Okay, what they are taking like 1 crore, you should take, not CUP method also, they are straight away saying like arm's length price. In one case the arm's length price is how much? 1 lakh euro. In second case the arm's length price is how much? 50,000 euros arm's length price. So we will be converting it into rupees. How do we convert? 1 crore in 1 lakh euros into 65. How much? 65 lakhs. Whereas 50,000 euros into 65. How much? 32 lakh 50,000. So the purchase price, sir, here you are talking about whom? Arbitron, because Arbitron is the Indian company. So you are thinking from whose perspective? Arbitron, Indian company. You are the buyer here, not seller. You are the buyer. When you are buying, what is the arm's length purchase price? If you take 1 euros, 65 lakhs. If you take 50,000 euros, what is the arm's length purchase price? 32 lakh 50,000. Okay. But what is the price actually paid? 85,000 euros. Multiply it with 65. 55 lakh 25,000, 55 lakh 25,000. Sir, see. First case. You purchased for how much? 55 lakh 25,000 only, actually. But whereas the arm's length price decided is how much? 65 lakhs. That means you purchased for lesser price. I mean your cost got reduced. When your cost, okay, you purchased for a lesser value than that of arm's length price. Okay, so here transfer pricing is not applicable, because understand, sir. When something is at 65 lakhs, you purchased only for 55 lakh 25,000. That means your Indian profit will jump, na? It will be increasing only, na? Okay, because of this thing and all. If at all you invoke transfer pricing provisions here, na, the difference what will impact? So you'll be making your cost from 55 lakh 25,000 to 65 lakhs. Once you increase cost, your profit will come down. So transfer pricing provisions you cannot invoke when that results into profit reduction or taxable income reduction. So here, if you take or invoke arm's length price here, your cost instead of 55 lakh 25,000, you can take 65 lakhs. Your cost will increase, profit will come down, which is not permissible under transfer pricing provisions. Case 1. So case 1, transfer pricing is not applicable. Take the actual purchase price only as it is. Second case, what is the cost? You actually incurred 55 lakh 25,000. But what is as per arm's length price? As per arm's length price, it is only how much? 32 lakh 50,000 only na? 32 lakh 50,000. That means what? You paid 55 lakh 25,000, whereas the arm's length price is only 32 lakhs. That means you paid more. Your cost has been already increased. So you should bring down. When you bring down, your profit will increase. So here transfer pricing provisions can be invoked. So total income before arm's length price adjustment, 78 lakhs. First case, no transfer pricing adjustment, taxable income is 78 lakhs. Second case, you should adjust the difference here, add it, 22 lakhs 75,000, 1 crore 75,000 is the taxable income after making the TP adjustment. Okay. Next, AB Limited is an Indian company in which Oceania Limited, a US company, has 32% shareholding and voting power. Following transactions were effected between those two companies during the financial year 24-25. AB Limited sold 1 lakh pieces of t-shirts at $3 per t-shirt to Oceania Limited. The identical t-shirts were sold to unrelated party at $4 per t-shirt. Sir, here AB Limited is an Indian company. Oceania Limited is a US company. 32% shareholding, which is greater than or equal to 26%. That means what are these two? Deemed associate enterprises. Transfer pricing applicable. Okay. AB Limited here sold 1 lakh pieces at $3 to their associate enterprise. Whereas to unrelated person, they'll sell for how much? $4. That means what is the difference here? $1 is the difference. Okay, $1. Into how many pieces? 1 lakh pieces. 1 lakh pieces. Into per dollar how much? 84. 84. Then AB Limited borrowed 2 lakhs from a foreign lender based on the guarantee given by Oceania Limited. So your associated enterprise given you guarantee service here. For guarantee service, how much you paid? $10,000. But whereas to unrelated party, Oceania charges only $8,000. I mean, you should pay only $8,000, but you paid how much? $10,000. That means $2,000 you paid extra. This also you should add $2,000 into 84. Then A Limited paid $15,000 to Oceania Limited for getting potential customers' details to improve business. Okay, $15,000 paid. Whereas to outsiders, it will be given only at $12,000. That means how much you paid extra here? $3,000. So $3,000 into 84. If you do all this, you'll be getting the value here. Okay, the difference, $1 lakh into 84, 84 lakhs. Then 2,000 into 84, it came to 1.68 lakhs. 3,000 into 84, it came to 2.52. So the total adjustment to be made is for how much? 88.2. There's another question, sir. AB located is in SEZ and income before transfer pricing adjustment is like 1,200 lakhs. Compute the adjustment to be made, state whether it can claim deduction under 10AA with respect to income enhanced by applying transfer pricing provisions. Sir, yes, they can claim 10AA adjustment also. Okay, they can claim 10AA deduction also with respect to the increase of this 88.2 lakhs made if the transfer pricing adjustments are did voluntarily before the AO assessing officer points out. See, but here what they assumed, AB Limited cannot claim deduction, they are saying, being the amount of income by which total income is enhanced by virtue of first proviso section 92, assuming it is increased by AO. But actually, if it is not increased by AO, they can claim the deduction. Okay, so look at the theory also. Holding shares not less than 26%, so they are related persons. As per explanation, the transaction is between two companies for sale of product, lending or guarantee, provision of services related to market research within the meaning of international transaction. Accordingly, transfer pricing provisions will applicable. So they have to be computed at arm's length price. Okay. Accordingly, transfer pricing would be attracted and the income arising from international transaction have to be computed regarding the arm's length price. In this case, from the information given, arm's length price has to be determined taking comparable uncontrolled price method as the most appropriate method. Okay, most appropriate method. So here, sir, this is like resale price method. Sir, how do we do in resale price method? We already discussed that one, right? So just once again, try to have a recap. Price charged for goods sold to unrelated customer will be, sir, I'll be buying from my associated enterprise and then I'll be selling it to an unrelated customer. So what we'll do now, take the sale price. From there, subtract the gross profit margin. From where I'll get this margin? In an comparable transaction, in an identical transaction, how much is the profit margin that you should subtract? Okay, then if any purchase related expenses are there now that you will be subtracting, you will be arriving what? Arm's length price. You will be arriving arm's length price. Sir, coming back to our question here. Terabyte Incorporation of France and R Limited of India are associated enterprises. R Limited imports 6,000 compressors for air conditioners from Terabyte at 6,600 per unit. So for what price importing? 6,700. And these are sold to Refresh Cooling Solutions, okay, at 10,000, who is an unrelated person. R Limited had also imported similar products from Gold Incorporation Poland and sold outside India at a gross profit of 20% on sales. Sir, here we have resale price 10,000 and we have the gross profit with respect to an identical transaction. How much it is there? 20%. Then Terabyte Incorporation has offered a quantity discount of 10,000 per one unit, whereas Gold could offer only 500. Sir, you are buying from two. Terabyte is your associate enterprises. Terabyte is giving 1,000 discount, whereas this person is giving only 500. Sir, here you are taking this Gold Incorporation related margin. Sir, understand? When a person is giving 1,000 rupees discount, there the margin would be, okay, the margin would be impacted, right? So that's why, what is the difference between this discount? Like 1,000 per unit is what offered by Terabyte, whereas Gold Incorporation could offer only how much? 500. So the difference should be what? Subtracted. Then the freight and customs duty paid for imports. Gold Incorporation has cost of R Limited 1,200 per piece. When you incur from Gold Incorporation, you will incur 1,200. Whereas when you incur from, sir, why we are minusing here? Na? We want to increase the profit margin much more. I mean, compared to the outsider, here the profit margin will be much more higher. Why? Because outsider, na, he'll give only 500 discount. But your associated enterprise Terabyte will give 1,000 rupees discount. So your margin will be much more higher, right? That's why you are reducing this one also from the sale price. Then coming to the freight charges. From outsider, if you buy, the freight charges is 1,200. Whereas from your person, if you buy, the price charges is only 200. Na? That means you will be getting it for a much more lesser price, right? Your margin, you will be getting for a much more lesser price. So that's why you are reducing all this. Understand? So once again repeating, sir, the discount difference, why we are subtracting? Because your associate enterprise is giving 1,000, but whereas this person is giving only 500. So additional 500 discount also you should subtract. Sir, could I subtract the whole 1,500? No, because with respect to the GP related 500 discount, already that was included in this margin part. So that's why the difference amount only you should subtract. Difference only you should subtract. See, how much then? Take the resale price, 10,000. From there, subtract the adjustments. First one, gross profit in identical transaction, 2,000, subtract 20% into 10,000. Then discount related. From associated enterprise 1,000, from this unrelated person 500 only, that difference 500 you should subtract. Then you are having how much here? From your associated enterprise 200 only, but from this person 1,200. Again there is a cost related, how much here? 1,000. That also you should what? You should subtract. So if you subtract all these, then the arm's length price would be how much? 6,500. 6,500. Okay. But what is the actual price, sir? 6,700. So okay. Price at which actually bought from Terabyte is 6,700. Arm's length price is 6,500 as per resale price method. So the decrease in purchase price per unit equals to 200. So the number of units to be purchased from Terabyte Incorporation, okay, is like 3,000 units. So that an increase in total income per unit 200, total 3,000, it will come to 12 lakhs is the increase you should make. So this is about what? Resale price method. Sir, we have discussed about cup method. We have discussed about cost plus method. We have discussed even about resale price method. Sir, in resale price method related, in workbook also there is a question, but that workbook question, this particular point, freight related point will be there. That will be a mistake in the workbook. That will be a mistake in the workbook. They will subtract, but actually they should add as per the logic. Okay, they should add it, but actually in the workbook they will be subtracting it. Okay. Now we are moving on to the next method, sir. Profit split method. The last one, sir. Profit split method. So with this, we can finish off the arm's length price related. Profit split method is applicable when both these two associated enterprises are operating jointly. So, okay, one will do some kind of process, the other will do the other part of the, I mean, let's say, I do the raw material. From a basic chemical, I was the one who will make it as like a raw material, which can be used, or else another way, sir. There's a mobile manufacturer, but I will be, okay, there's a mobile, so actually, sir, they'll be selling mobiles. The holding company will develop the software updates needed for that mobile. Whereas I'm subsidiary company, I'll be manufacturing all these hardware components like this motherboard, this display, speakers, all those I'll manufacture and sell. I'll be selling it to the holding company. Holding company now add software and will sell them. Okay. Now we two together manufacturing mobile. So that's a joint venture here. Find out the total profit earned in the JV. Okay. With respect to the both holding and subsidiary together, how much is the profit earned? Then divide the profit between associated enterprises in the ratio of manpower, or in the ratio of functions performed, or in the ratio of risk taken. It could be any possible measure which is justifiable there. Then, okay, so how it works? Take the cost incurred by SSE and then add this share of profit. Then that itself is the arm's length price. One question has been included in the workbook, sir. We'll be solving that one. Inditech, an Indian company, designs and develops a proprietary solar-powered drone. Okay, they manufactures drone. Further, subsidiary develop advanced navigation software that integrates with the drone. So subsidiary develops a software, but the drone and software are key to the commercial course. Okay, both the hardware is needed, software is needed. Inditech manufactures and supplies the drone hardware, whereas Skytech integrates the software and sells the final product. Sir, Inditech is in India, which manufactures what? Hardware. Skytech is in outside India, which manufactures software and it sells the final product. Due to uniqueness of the technology, no direct comparable transactions are there. Traditional methods are like CUP, transactional net margin method, are not reliable. However, comparable market return for routine manufacturers without intangibles is like 12% of manufacturing cost. So it's like the 12% is only on what? Manufacturing cost. They are usually earning the profit. The others like, okay. Then the available financial data. How much sales they'll make to outsider? 3 lakhs, 3,000. Manufacturing cost 400, 500, total 900. Development cost 150, 100, total 250. Operating cost 100, 200, total 300. Total cost, like it would be 1450. When you subtract the gross profit they are having is how much? 1550. They are asking us to calculate the arm's length price. They are not asking how much to be added to the total income. They are first asking you to derive the arm's length price for first one. First, there is a routine margin. First, we'll find out that routine margin. How much? 12% on manufacturing cost. So 400 into 12%, 500 into 12%. How much it is? Like 48, and here it is 60. Out of total 1550, you subtract this 40 and 68, because this 40 and 68 we can already apportionate because of this particular line. The comparable market return for routine manufacturers without intangibles is like how much? 12%. So that part we are excluding. So like for Inditech, it is like 48, Skytech 60. So already 48 and 60, total 108 already allocated. The balance how much? 1442, we need to again split them. 108 we have split based on what? Based on this 12% on market manufacturing cost. That approach is given, that line is given based on that. The balance 1442 we need to apportionate. How do we apportionate is the next one. Sir, what are the other costs here we are having? Development cost and operating cost. So out of this, development will only feels here significant one. Okay, development will only be significant because manpower not there. Functions performed is there. So development is a function performed. Okay, so that's why based on that we could apportionate 150 and here it is 100. So how do we take here now? Residual. Okay, so understand here, sir. Split residual profit. How do you split residual profit? 150 by 250. The total development cost is 250. Out of 150 na 60%, whereas Skytech it is 40%. So this 1442, you will be apportionating 60% and 40%. 60% na 865.2. 40% na 576.80. 576.80. So now total profit to each entity. Inditech. Routine profit 48 calculated na, take that. And then this 865. Total 913. Skytech 60 is the routine profit. Residual profit is 576. So total profit is 636.80. Now come back to the question. So what is the cost to Inditech? 650, right? And what is the profit share we given? 913. If you add these two, that itself is the arm's length price. See, transfer price 400, 150, 100, okay, 100. So how much it is? 650. 650. For this, what we need to add? This 913.20. This together is what? 913.20. Then the total transfer price is 1563.20. Since no reliable comparables exist, profit split method is the most appropriate method, which is allocated based on the relative contribution to the intangibles. Relative contribution to the intangible, that is development cost. So transfer pricing is justified. 1563 is justified under this particular method. Okay. So now we are going to talk about section 92C is secondary adjustment. What is called secondary adjustment? For that, first we need to understand what is called primary adjustment. Sir, in all these methods, we are finding out the difference between arm's length price and the actual price, actual transaction price, and we are adding it to the income, right? That itself is the primary adjustment. Okay, primary adjustment means income means increasing income or reduction in the losses due to arm's length price adjustment. Primary adjustment means what? Increasing the income or reducing the losses due to arm's length price adjustment. That itself is called as the secondary adjustment. So, sorry, that itself is called as the primary adjustment. Now we'll see what is called secondary adjustment. Excess money with associated enterprise shall be treated as deemed to be loan or dividend to associated enterprise. See, sir, here. Sir, here. A Limited India sold goods to its associated enterprise B LLC in UK. Actual price 10 crores. Arm's length price determined is 12 crores. What is the difference? 2 crores. This difference 2 crores itself, what we'll do? We'll add to the taxable income. We'll add it to the taxable income, right? That itself is called as primary adjustment. Primary adjustment. Okay. You are adding this 2 crores difference to your income. That is called primary adjustment. Then just if you add now, that's not enough. That 2 crores need to be brought to India, because that income should have been is earned in India, should have came to India. But did the money brought? No. For the taxation purpose, you just added 2 crores. Did the money actually flown into India? No. So secondary adjustments is like, now this 2 crores has to be recovered from BLLC UK. That should come to India. If it is not repatriated into India, if it is not brought into India in reasonable time, we'll discuss the time limits also. Then the 2 crores will be treated as an advance or loan. Okay, treated as an advance or loan. And on that again, you'll be levying imputed interest. Even though no interest is paid, you will charge interest, and such interest will also be added to the next coming years and all income. I mean, there's a time limit, sir. Within the time limit, you need the other foreign enterprise need to repatriate them to India. If they didn't repatriate, then on that interest also has to be levied. Even though it's not paid actually, imputedly you'll be levying. And that will also be again taxed. That will also be again taxed. Okay. Secondary adjustment, with respect to whatever is the primary adjustment you are doing, that amount should be brought to India within reasonable time. If not brought, consider it as advance. And then on that, you'll be imputedly calculating interest. Okay. See. Cases where secondary adjustment is applicable. When you will make secondary adjustment, where primary adjustment has been made sumo to. SSC himself has made primary adjustment in his return of income. Or primary adjustment is made by SSC owing officer, which has been accepted by the SC. Sumo to done by assessing officer. Or based on APA. APA entered in by SSC. So because of APA, primary adjustment has been made. Or because of safe harbor rules. To determine arm's length price and all, there are safe harbor rules given. Okay. Based on safe harbor rules, if any arm's length price is determined, then based on that price, primary adjustment, if any, is made. Then the last one, as a result of mutual agreement under DTA, okay, because of some agreement between that country and all, if any adjustment is made, that one, okay. Primary adjustment made summarily, or by the order of assessing officer, or by the effect of APA, or because of safe harbor rules, or because of this mutual agreement entered under DTA, okay. Because of this, the primary adjustment should have been made, then the secondary adjustment is applicable. Then the time limit, sir. If the order is passed by AO, if the order is passed by AO or appellate authority, then the repatriation has to be made within 90 days from date of order. Within how many days? 90 days from date of order, where the APA entered up to due date of return of income in that previous year. Okay, APA entered up to due date of income, sir, I mean before due date of return of income only APA entered, and based on APA only the primary adjustment has been made. So before return of income due date only APA has been entered na? So then in that case return filing due date will be the time, will be the checkpoint here. From there within 90 days, actual date of return of income from there 90 days. Then entered, APA entered up to due date of return of income in that previous years, not up to, sir, here after. Okay, entered after the due date, not up to here, entered after the due date of return of income in that previous year. Then from the end of the month in which APA entered, from there 90 days. Sir, APA entered before return filing time. Then in such cases, before the due date only, then in such cases, actual return filing date from there 90 days. APA entered after the return filing due date actually. Then in such cases, in which month APA entered, na, that month last day in, from there 90 days. In case of this mutual agreement and all, okay, this mutual agreement point, secondary adjustment has to be made. Then from the date of giving effect of such agreement, from there within 90 days, in any other reason, na, like sumotoli, if he has determined or made the primary adjustment, in such cases from the due date of filing of return of income, from there within 90 days, from there within 90 days. So within how many days the repatriation has to be made, sir? Within 90 days. From when? In case of order, from the order 90 days. In case of APA, you should check APA has been given before filing return of income or after filing return of income. Okay, before filing return of income itself or before the due date of return of income itself. Then actual date of filing return of income from there 90 days. After the due date the APA has been given. In such cases, the APA entered month last day from there 90 days. In case of mutual agreement under DTA and all, from the date from which the agreement comes into effect, from there 90 days. In any other case, that is nothing but sumotoli. From the date of file, from the due date of filing of return of income, from there within 90 days, amount has to repatriate. Okay, if not, interest has to be calculated. From when? In case of AO, in case of order passed by AO or appellate authority, from the date of order till the date of repatriation, interest has to be calculated. Okay, in case of entered up to due date of return of income in that previous year, in such case, from the due date of return of income, sir, actually for repatriation you'll check actual date, but for interest you'll be checking from due date only. APA entered, in such cases, APA entered after the due date of return of income. Then for 90 days you'll be checking the end of the month in which APA entered, interest also from that day only. Next, for mutual agreement, same, from the date it has been given effect, from there only interest also calculated. Any other reason, from due date of return of income only. Okay, so in case of secondary adjustment, what they are saying, sir, the primary adjusted amount should be repatriated into India. If not, it would be taken as what? Loan. Some countries it may taken as dividend also, but in India we'll take it as loan only. Loan only. What is the rate of interest? The rate of interest, if the transaction is denominated in Indian currency, then Indian currency, sorry sir, when the transaction, here I have written oppositely, let me correct it. If the transaction is denominated in foreign currency, then you should take 6 months LIBOR. On 30th September, you should take what? 6 month LIBOR. Okay, if the transaction is entered in foreign currency, you should take what, sir? 6 month LIBOR. Okay, 6 months LIBOR on 30th September of previous year plus. So if the transaction is in Indian currency, then take 1 year marginal cost of fund lending rate of SBI. SBI marginal cost of fund lending rate on 1st April of previous year plus 3.25%. SBI fund marginal cost interest rate as on 1st day of previous year plus 3.25. In case the currency, the transaction is in foreign currency, take 6 month LIBOR on 30th September of previous year plus 3%. 6 month LIBOR on 30th September of previous year plus 3%. Okay. Then no secondary adjustment is needed if the primary adjustment in any previous year does not exceed 1 crore. The amount of primary adjustment is within 1 crore. Then there is no need of secondary adjustment. Or the primary adjustment is made in respect of assessment year 16 before, in respect of assessment year 16, 17 or before. Then no secondary adjustment is needed. Okay. Sir, there is one more option to relieve from this secondary adjustment. The other option is like you can pay additional income tax and relieve from this secondary adjustment. How much additional income tax you should pay? Sir, whatever is the difference between arm's length price and the actual price that you are adding to your income already. By adding to income, already it's been taxed. The tax has been paid. The problem is what? You paid tax, but the amount should be repatriated into India. That was not made. For that, you are doing secondary adjustment. If you don't want secondary adjustment, then on the repatriate, then the income which should be repatriated, on that you should pay additional income tax. How much? Tax at 18%, surcharge 12% on it, and HEC 4% on it. Effectively, it comes to 20.964% on that excess money. If you do this, then secondary adjustment is not applicable. Okay, and if any this additional tax is paid now, with respect to this additional tax paid, no credit, no deduction, nothing is allowed. Okay, advance pricing agreement. Why, sir? Sorry, we are talking about what? Secondary adjustment here. What is secondary adjustment? Because of primary adjustment, if any income is increased, that amount should be repatriated into India. Okay, within the reasonable time limit. Otherwise, it would be treated as an advance or loan. That is called secondary adjustment. Okay. When the secondary adjustment will be made applicable? Because of summarily SSC has made primary adjustment. Because of AO order, primary adjustment has been made. Because of APA, primary adjustment has been made. Because of safe harbor rules or because of a mutual agreement between DTA under DTAA. Then the repatriation has to be made within 90 days. From where? From the date of order. From the date of return of income. In case the APA is filed, APA is entered before the date of return of income. If APA is entered after the date of return of income, due date of return of income, then the end of the month in which APA entered, from there 90 days. In case of mutual agreement, from the day which it comes to effect, from there 90 days. In case of other reason, from the due date of return of income, from there 90 days. Otherwise, interest has to be applicable. I mean, even though interest not received also, again imputed interest only. Loan itself you are assuming, on that again you will assume interest also and add it to your income, and again on that you need to pay tax. Okay, the rate of interest. Foreign currency na 6-month LIBOR on 30 September of previous year plus 3%. Indian currency, SBI, marginal fund. Okay, on first day of relevant previous year, whatever is the rate, plus the 3.25%. No secondary adjustment if the primary adjustment in a previous year does not exceed 1 crore or primary adjustment is for assessment year 16, 17 or before. To relieve from secondary adjustment, you have another option. Pay additional income tax. How much? At a rate of 18% on the 12% surcharge and again 4% HEC. Together it comes to 20.9664%. So look at this exam question. December 2024. TAN Limited, an Indian company, is a part of multinational group by name Colors Incorporation of USA. During the financial year, it had entered into various transactions with group companies spread in different countries. All the transactions are denominated in Indian rupee. It gives you the following information. Transaction price declared by TAN. Transaction price computed by TPO. Sir, here the primary adjustment is made by whom? TPO. Okay. The date of order is 31st October. Date of repatriation also given. And the interest rates also given. Sir, interest rates too given. But they said like all the transactions are in Indian rupees only. So which interest rate you should take? You should take 1 year marginal cost of funding lending rate of SBI as on the relevant date. That is, you should take how much? 7%. Okay, you are required to discuss the tax implications. So we need to calculate interest on secondary adjustment. So first transaction. Sir, how much is the transaction price? 3 crore. TPO decided how much? 3.5. I mean, assessing officer. How much is the increase made? 50 lakhs. So the primary adjustment is only for 50 lakhs. When secondary adjustment is applicable, where the primary adjustment is more than 1 crore. So here, secondary adjustment not applicable. Then here, the transaction price is 5 crores. Whereas the transaction price computed by TPO is 4.5 crores. Sir, here, primary adjustment itself is not applicable, sir. Why? The transfer pricing should be, okay, the transfer pricing should increase the income or reduce the losses. But here, this is giving negative impact because actual price itself is high than that of transfer price. So that's why you'll ignore here. Coming to the last one, 10 crores is the transaction price declared by TAN Limited, whereas TPO has said it like 12 crores. I mean, the primary adjustment is for 2 crores, which is more than 1 crore. So secondary adjustment is applicable. Okay, now, by when it has to be repatriated? Sir, here the order is passed by whom? Assessing officer. So then, from his order within 90 days, within 90 days it has to be returned. Within 90 days, na, by November 30 days, December 31 days, and again January, you should take 29. By 29th January, it should be repatriated. But is it repatriated by 29th Jan, sir? No. When it is repatriated, 31st March. That means interest has to be levied on this 2 crores at a rate of 7%. From which date to which date? From 31st October 2023 to 31st March 2024. In this period, how many days are there, sir? 30, 31, no, 30 November, December 31, January 31, 28 and 31. For all these days, interest has to be levied at a rate of 7%. See, tax implication of transfer pricing in the hands of TAN. With respect to Blue LLC, the income of TAN Limited will increase by 50 lakhs by way of primary adjustment. Since it is only within 1 crore, secondary adjustment is not needed. In respect of transaction with Pink Incorporation, there is no need of primary adjustment itself because it leads to reduction in total income. So secondary adjustment is also not applicable. In respect of transaction with Green GmbH, total income will increase by 2 crores by way of primary adjustment. The excess amount lying with 2 crores will be treated as what? Deemed loan. And it need to be repatriated by within 90 days by 29th Jan. But it was not repatriated. Since the foreign associate enterprise did not repatriate within the time limit, TAN Limited will have to add imputed interest income to its total income in the financial year 24-25. Sir, one thing I missed here is like it's not 7% plus 3.25 because this is the marginal cost of fund lending rate, SBI lending rate. So that for that you need to add how much? 3.25. If you add that one, it comes to 10.25%. Okay. Since the amount is being repatriated, there is no need to pay any additional income tax. Okay. Then next question. This is June 2024 past exam question. Fast Growth Limited is an Indian company belonging to Bolo Group. It is engaged in sale of air conditioner throughout the India. And Eric Incorporation of USA having 28% shareholding in Fast Growth. Fast Growth. Eric is having how much shareholding, sir? 28%. Greater than or equal to 26% voting power. So these two are what? Associated enterprises. It is engaged in manufacture of air conditioners and belongs to Bolo Group. During the financial year, Fast Growth purchased 20,000 air conditioners from Eric for price of 70,000. For what price purchased, sir? 70,000. Actual price 70,000 per unit. How many units? 20,000. Whereas identical units manufactured by unrelated parties were purchased by it at 65,000. Sir, in a identical transaction, it can purchase it for how much? 65. So that means there is a comparable uncontrolled transaction is available for 65,000. So which method you should follow? CUP method. There is a comparable uncontrolled transaction price. Okay then. Eric has given credit period of 1 month to Fast Growth, whereas to others it has given 2 months. So for them 1 month na, the price should be actually less. Okay, sorry. Eric Incorporation gave credit period of 1 month to Fast Growth, whereas unrelated parties are giving 2 months. Sir, this 65,000 is there na, unrelated person, that is with 2 months credit. I mean 2 months credit now, the price is little more higher. Because 1 month credit, 2 month credit, which would be higher? 2 month credit will only be little higher. But here they are giving only 1 month credit. So with respect to this credit, we need to subtract. Further, they are not giving the amount with respect to credit. They are just giving 12% per annum as the cost of capital. And supply be assumed as uniform. That means throughout the year, 65,000 will only be supplied. Assume. Into 12% into, what is the difference? 1 by 12. How much it is? 650. 650 is the credit related which we need to subtract. Okay. And determine the arm's length price per unit if you need to be made to the total income. If primary adjustment is proposed on sumo basis, state the time limit for repatriation, state the consequence of non-repatriation, tax liability if such repatriation is not opted by Fast Growth, consequence of repatriation of money. See, first one, we'll talk about only arm's length price. Price with unrelated parties, 65,000. Excess credit related 650, subtract 64,350 is the arm's length price. Whereas the actual price is how much? 70,000. That means You are purchasing for 70,000. Arm's length price is only 64,350. You paid more. You paid more because of that. Your cost increased, profit decreased. Now with this transfer pricing impact, your income will increase. So now, how much is the adjustment per unit? 5,650. How many units are there? 20,000, right? 20,000. 5,650 into 20,000. Let me cross check, sir, once again. I didn't. So how much? 11 crore 30 lakhs, correct only. Okay, this is the this is the increase to be made. Primary adjustment to be made is how much? 11.3 crores. More than 1 crore. So secondary adjustment is applicable. As the primary adjustment by way of arm's length price exceed 1 crore, secondary adjustment is applicable. This 11.3 crores need to be repatriated within 90 days from the due date of filing of return of income. 90 days from due date of filing of return of income. The time limit for secondary adjustment is 90 days from due date of filing of return of income. Thus, it must be counted from 30th November 2024. The same will be 28th February 2025. So, by then, the amount should be repatriated. If not repatriated, what happened? Then you treat it as an advance, levy interest. Okay? If the primary adjustment is not brought into India within specified time, it shall be deemed to be an advance. And interest is chargeable. When the transaction is in Indian rupee, at 1 year marginal cost of fund lending rate of SBI, MCLR rate of SBI, on that you need to add 3.25%. If it is denominated in foreign currency, take LIBOR rate plus 6-month LIBOR rate as on 30th September plus 3%. Opting for non-repatriation. If they don't want to repatriate, they have other option. On this 11.3 crores, they can pay additional income tax. How much? 20.9664% additionally they can pay. Okay. How this 20% came, sir? There is the income tax of 18%, on that surcharge 12%, and HEC 4% they can do. Okay. Then the last point here they asked this, sir, like, consequence of repatriation money by Jeet Incorporation of Canada being another company belonging to Bolo Group. The same group only, but instead of the actual associate enterprise, someone else is paying. Fine. Even if they pay also, it would be accepted as a remittance. If the amount of primary adjustment is remitted by some other concern of the same group, such remittances also to be deemed as repatriation by the foreign entity. In this case, then also it is a secondary adjustment. Then secondary adjustment is not required. So now we are going to discuss about advance pricing agreement. Okay. So by covering this advance pricing agreement, actually 6A, 6B, 7A, 7B, sometimes 8B also the transfer pricing question only. So total there are 35 marks it's going to be. If at all you could prepare on your own 80. Okay. So advance pricing agreement, and then we'll be discussing about the secondary adjustments. That part also we are covering each and every nook and corner of transfer pricing and DTISR. Okay. Pretty confident like 5-7 marks questions will come from this particular video itself. 4 not damn sure. Okay. So CBDT with the prior approval of central government. Okay. Who can enter into advance pricing agreement, sir? First of all, what is called this advance pricing agreement? Sir, you are doing a transaction, then later on department is coming like this is not arm's length price. You have determined arm's length price, but they are always saying like, so this is not a correct method, or this is not taken properly, and then they're recomputing it, and then again because of that your income again gets increased because it is determined by AO that on that you cannot avail 10A exemptions and all, interest you need to pay, penalty you need to pay. So all these havoc you want to avoid. Then the option you have is like you go and approach the CBDT asking like, so this is the transactions I'm having with my holding company or subsidiary company or with any of the associate enterprises. So you fix the arm's length price. So based on that only I'll deal, or else based on that only I'll pay the taxes and all. Okay, I don't want all this kind of torture always. So you want to get it fixed. Or if the price cannot be fixed, at least how the price has to be fixed, arm's length price has to be fixed, that manner has to be determined. So through advance pricing agreement, CBDT with the prior approval of central government enter into an advance pricing agreement to determine arm's length price or to determine manner in which such shall be determined. Either to determine arm's length price or the manner to determine the arm's length price. Okay. For this you need to pay fees. How much is the fee? Where the the transactions happening are less than or equal to 500 crores, fee is 10 lakhs. If it is like 200 crores or less, okay, with the value of international transaction is less than or equal to 100 crores, 10 lakhs is the fee. Okay, value of international transaction. Less than or equal to 100 crores, 10 lakhs. Less than or equal to 2 crores, 15 lakhs. Greater than 200 crores, 20 lakhs. Then in such case, okay, these are the fees to be paid. How much, sir? Less than or equal to 100 crores, 10 lakhs. Less than or equal to 200, greater than 100 crores, less than or equal to 200 crores, then the fees is 15 lakhs. Above 200 crores, international transactions are going to be happen. Okay, then in such cases, it would be 20 lakhs. Application file can be withdrawn anytime, but before finalization. Okay, the withdrawal form will be made in 3 CEE. Once you have withdrawn the application, you will not get the refund of the fees paid. Okay. Advance pricing agreement is valid for 5 previous years specified in advance pricing agreement. Valid for 5 previous years specified in advance pricing agreement, including the previous year in which APA has been entered. Okay, considering the year in which APA has been entered, that year is the one, and another 4 coming previous years. Next, once advance pricing agreement has been entered, it is binding on Commissioner of Income Tax, Principal of Commissioner of Income Tax, assessing officer, and even on that person who has entered the APA. Then advance pricing agreement applies once APA is applied. Then here they have said like how the arm's length price has to be computed. Our arm's length price itself is fixed. Then again, you need not to worry about 92C and 92CA. Then advance price, this APA, advance pricing application or advance pricing agreement is there. This impact either should increase your total income, taxable income, or reduce losses. Cannot be applied if it reduce income or increase losses. Next, APA is not binding when there is a change in facts. So when the facts on which you have taken the advance pricing agreement, that facts are being changed, then this agreement is no more valid. And this agreement is void ab initio when the agreement is entered with fraud or providing a false documents and all, then it is void ab initio. So APA, who will be entering CBDT with the person who is doing the international transactions with the prior approval of central government. What is the fee? Up to 100 crore, 10 lakhs. 100 to 200 crore, 15 lakhs. Greater than 200 crore, 20 lakhs. Withdraw application anytime before finalization. Form 3CE, no refund of fee. APA is valid for how long? Less than or equal to 5 years. APA is binding on Commissioner of Income Tax, Principal of Commissioner of Income Tax, and EO and SSC. Advance pricing agreement applies, then 92C and 92CA both will apply. APA cannot be applied if it reduces income or increasing losses. Advance pricing agreement is not binding when there is a change in the fact, and it is void ab initio when it is taken on fraud. Rollback provisions. Rollback provisions are nothing but giving impact or giving validity to this advance pricing agreement even for the past years. For the past years, you might have already filed returns, but for that years also, this particular APA related impact or related adjustments can be made with respect to the past years also. How long? Sir, let's say APA is taken for the previous year 24-25, assessment year 25-26. So this is the year you have entered APA. Like for future years, how many? Including this year, 4 years. Including this year, 5 years. That means 25-26, 26-27, 27-28, 29. 1, 2, 3, 4, 5. When it has to be taken like back, don't consider the year in which APA has been entered. Other than that, 4 preceding previous years. That means 23-24, 22-23, 21-22, 20-21. So these are the 4 preceding previous years for which also you can apply the APA agreement. Advance pricing agreement. Then for rollback provisions also, sir, it's not like once you enter into APA, even rollback also applicable. No. For if you want it to get applied even for rollback for the past years or the back years or past years also, then you need to apply in 3CD, fees 5 lakhs you should pay. The transactions like for which you have entered APA and the transactions which were happened or occurred in the preceding previous years shall also be the same. And for all the preceding years, return should be filed within the due date. And like you cannot choose the years for which only you want to apply rollback provisions. It is applicable for all the 4 preceding previous years. If at all, any desire, if any conditions are not satisfied, for that year maybe rollback is not applicable. But you cannot choose, like for 1 year only I'll take, for 2 years only I'll take, that you cannot choose. If at all because of failure to satisfy any conditions for that year rollback provision not apply, then that is fine. But you cannot choose and pick. And any year such income is not a subject matter of appeal. Okay, so if it is already into the appeal process, for that year you cannot again apply rollback provisions. Then the rollback provisions impact also, it should increase total income, reduce losses. Then applicable only to the person who enters. That means in case of amalgamation and demerger, to the resulting companies this is not applicable. Okay, to the resulting companies this is not applicable. Even the rollback provision, rollback agreement can also be withdrawn anytime, but without impacting the future years. For future years you can continue, but for rollback you can withdraw. But future APA you cannot withdraw, just to and you cannot continue the rollback. Okay, if you want to continue rollback, then you want to continue in the future. But if you can continue future without following the rollback, Okay, then sir, rollback you understand na? How many preceding years, sir? 4 preceding previous years. Application 3 CED, fees 5 lakhs. Transaction should be same as APA. Returns for all those years should be filed before the due date. Applicable for all the years. You cannot choose and pick. It shouldn't be a subject matter of appeal. It should increase total income, reduce losses. Applicable only to the person who has entered. Can be rollback related APA. Rollback effect can be withdrawn without impacting the future applicability of APA. But you cannot apply for rollback or for the back years without applying the APA for the future years. Okay. Now effect of APA. Once you enter into APA, what happens? Sir, by the time you enters into APA only, let's say for previous year 24-25, previous year 24-25 you entered into APA, but for this the return is filed on 30th September 25, whereas the APA has been given, APA is on 2nd November 2025. So by the time APA has given, you already filed the return of income. So then in such cases, since with the previous filed return you didn't consider APA, that's why you'll be filing a modified return. You'll be filing what? Modified return within how many months? 3 months from end of the month APA entered. Okay, within 3 months. Here 2nd November APA entered. So 2nd November November end. From there 3 months. December, January, Feb. Okay. Assessment pending. Okay, return filed, assessment also pending. Then AO shall complete the assessment as per or giving impact of what this APA. In such cases, there is an extended time limit for completing the assessment, extra 1 year. Then assessment also completed by the time they give the APA. Then the assessment has to be reassessed. It has to be reassessed and pass order. In that case also there is an extended time limit of 1 year to complete the assessment. Okay. This is about the APA, sir, and rollback provisions. There is an examination question, December 2024, we'll solve it. Trust Limited is an Indian company engaged in international transactions for the past 2 decades. It has been having international transaction with GH Incorporation of Sweden for the past 8 years. Okay, it's an Indian company, international transaction. It has international transactions of a Sweden company. On 23rd October 2024, I mean which previous year, sir? 24-25. Assessment year what? 25-26. It has entered into APA. The details relating to last 5 assessment years are as under. Okay, it has entered where, sir? Assessment year 25-26. APA entered assessment year 25-26. And these are the details of the past 5 assessment years, last 5 assessment years, 2021, 22, 21, 22, 22, 23, 23, 24, 24, 25. Data filing at ITR, arm's length price determined by SSE, arm's length price as per APA. You are required to advise TL about the following with clear reasons. Number of years for which APA will apply. Assessment years may be stated. And assessment year for which rollback will apply by giving support reasons. Sir, from assessment year 25-26, now this is first year. Like with respect to future, 5 years now, 26-27, 27-28, 28-29, and for 29-30, these 5 years you can apply advanced pricing for the future years. If you want to apply rollback, you shall not count the year in which APA has entered. The past only, okay, the preceding years only. So that means 24-25, 23, 24, 22, 23, and 21, 22. So for these 4 years, you can apply rollback. You can apply rollback. Whereas from 25, 26 to 29, 30, you can apply APA for the future years. Okay. Then rollbacks are, if you look at the conditions, rollback provisions to apply, the return should be filed before due date. Sir, if transfer pricing provisions are applicable, now what is the due date of filing return? 30th November of assessment year, 30th November. Here filed by 18th October within due date. Here filed, not filed by, sir, not filed by 30th November of assessment year. So here not filed in by the due date. So rollback provisions not applicable for this year. 23, 24 filed by the due date. 24, 25 filed by the due date. Then transaction is same as to APA, and then not subject matter of appeal, nothing has given. Then it should increase total income and reduce loss. By applying APA, the income should increase. By applying APA, the income should increase. So here 12,500 is the arm's length price taken by SSE, whereas as per APA it is how much? 12,400 only. So here APA, the income is getting reduced. So if it is reducing, the rollback provisions will not apply. Here it's not applying. Here anyhow not applies. Here as per APA, it is increasing 200. Here 300 increasing. So for these 2 years, you can apply rollback. 23, 24 and 24, 25, you can apply rollback. See, the benefit of APA can be applied for assessment year relevant to the previous year in which APA was entered, and for 4 subsequent financial years. Thus, it will apply to financial year 24, 25. Okay, and for financial year 24, 25, nothing but assessment year 25, 26. And subsequent financial years, not 25, 26. 26, 27, 27, 28, 28, 29. Assessment year, the next year, sir. The rollback provisions will apply for 4 preceding assessment years only, preceding the assessment year 25, 26. Hence, it can be applied only till 2021. Sorry, it cannot be applied for 2021. Correct only. Where the return of income is not submitted by due date, you cannot apply rollback. Where the APA has effect of reducing the total income, then you cannot apply rollback. Here, for assessment year 21-22, the arm's length price is less, as per APA is less than as per ITR. So rollback cannot be applied for that year. For 22-23, return filed belatedly, so you cannot apply rollback. Whereas for 23-24 and 24-25, it is filed within due date and no other disallowances or no other non-applicable situation. So rollback provisions are applicable. Everything from the transfer pricing except the few items, and very importantly, the concept which is needed to answer 7B. It's about thin capitalization. First, quickly, let me finish off these topics, some theory topics which are not specifically related once, because I need to bring a feeling like we have covered completely the transfer pricing end to end. That's why. Determination of arm's length price by AO. Sir, a assessing officer shall determine the arm's length when, if based on info available with the assessing officer, he is of the opinion that, okay, assessing officer is of the opinion that SSC has failed to compute arm's length price as per the most appropriate method. Sir, who has to compute the arm's length price? Actually, SSC. But assessing officer has information that SSC has failed to calculate the arm's length price. Then AO can calculate the arm's length price by using the most appropriate method. Or SSC has calculated, but the data used for arm's length price is not correct or not reliable. Okay, first one, SSC failed. Second one, he computed, but the data is not correct or reliable. Next, third one, relevant documents are not maintained, or SSC failed to furnish the documents which he is maintaining within the time period with which the AO asked. Okay, then before finalizing or before determining by AO has to give an opportunity of being heard. Opportunity of being heard to the SSC. Sir, when can AO can determine, sir? When SSC failed to determine ALP. The information or the details taken for the computation of arm's length price are correct or incorrect or not reliable. Relevant documents are not maintained and they are not submitted when they were asked. Okay, the effect of ALP if it is determined by AO. If the ALP is determined by AO, okay, through an order, then with respect to increase in income, SSC cannot claim 10AA deductions or cannot even claim Chapter 68 deductions. Okay, and even the other enterprise income shall not be recomputed. Here, let's say if the income is increased, for other enterprise actually it should be reduced, but such other adjustments with the other entity is not possible. Okay, then 92CA. 92CA is like reference of the case to the transfer pricing officer. Reference of the case to transfer pricing officer. When assessing officer, okay, with the approval of Commissioner of Income Tax or Principal Commissioner of Income Tax. Commissioner of Income Tax or Principal Commissioner of Income Tax. AO feels like or is of opinion that it is necessary or expedient to do so. So AO feels like it is necessary and it has to be done immediately. Then you should take the approval of Commissioner of Income Tax or Principal Commissioner of Income Tax, and then he'll be referring the case to the TPO, Transfer Pricing Officer. Who can be a Transfer Pricing Officer? JC, AC or DC, Joint Commissioner, Assistant Commissioner or Deputy Commissioner authorized by CBDT. Deputy, Joint or Assistant Commissioner authorized by CBDT can be a Transfer Pricing Officer. Then SSE can call, TPO can call SSE to provide the evidence and documents for computation of ALP. TPO will be asking the SSE to provide evidence and computation for determining the ALP. Then while doing the assessment, transfer pricing officer came to know about some other international transactions which have been entered. Then, even though they were not referred to him initially, but during this course, if he finds out any other transaction, he can include such transactions also and can carry out the assessment. Then, he'll be passing an order of arm's length price. Once he passes an order regarding arm's length price, that is even binding on AO. AO cannot say like, I didn't like this order and also I'll be rejecting and I'll be computing again on my own. Once TPO passes an order, that is binding on AO. Next, in case of assessment stayed and the time available, okay, so there are time limits, right? Due to this assessment, due to the stay by court or any tribunal, the time available is less than 60 days to compute the assessment by transfer pricing officer. Then the time limit shall be extended for another 60 days. Then transfer pricing officer can amend his order where the mistake is apparent on record. Where the mistake is apparent on record, the transfer pricing officer can even amend it. So, okay, so simple thing, sir. Assessing officer with the prior approval of Commissioner of Income Tax or Principal Commissioner of Income Tax. If he opinions that it is necessary or expedient to do so, he'll be referring the case to TPO. Who can act as TPO? A Joint Commissioner, Deputy Commissioner or Assistant Commissioner who is authorized by CBDT. Now, the transfer pricing officer will call the SSE to provide the necessary documents and computations regarding the arm's length price. If at all during the course of the proceedings of transfer pricing officer, if he finds out any other international transaction, then that can also be included, okay, and then he can carry out assessment even with respect to that. Fifth one, the transfer pricing officer will determine the ALP and pass an order. Such order is binding on AO as well. Then, in case of assessment, the time is got stayed at any place by the court or tribunal, and after the stay, the time available is not even 60 days, then the time limit here can be extended for another 60 days. The last one, transfer pricing officer can amend his own order where there is a mistake apparent from record. Then, Section 92D, the records to be maintained. All the necessary information and documents related to international transactions has to be maintained, where the aggregate value of international transactions is greater than rupees 1 crore. Greater than rupees 1 crore. Okay. AO or commissioner may require any person. Okay. AO or commissioner may ask any person to provide such information, records or documents which he is maintaining. Okay. Once they ask, they'll be asking it through a notice. Once the notice has been received by the SSE, he need to provide them within 10 days. However, extension can be given up to 30 days. Next, even the value of international transactions are less than 1 crore, SSE has to maintain adequate records which are needed to compute the arm's length price of an international transaction. And these records, documents has to be maintained for a minimum period of 8 years from the end of relevant assessment year. Let's say the transaction happened in previous year 25-26, assessment year 26-27. From the end of assessment year 26-27, 8 years the records has to be maintained. Okay, so what all are the necessary documents with supporting the arm's length price and all has to be maintained. It is obligatory where the value, aggregate value of international transactions is more than 1 crore. Less than 1 crores also, the minimum kind of set of documents has to be maintained. The period is like 8 years from the end of relevant assessment year. Okay. So now we are moving into the very, very important and simple topic, sir. Thin capitalization. Very small topic, sir. 1 page only. But there is always a 7 marks question from this topic only. So very, very important. You should get 7 out of 7. Okay. This sum you don't even, you can't even lose half mark also. 7 out of 7 you should get. Okay. Limitation of interest deduction or thin capitalization. Very simple concept, sir. There is a non-resident company and there is an Indian company or a permanent establishment of foreign company. Non-resident company. And there is an Indian company or permanent establishment of a foreign company. Okay. The debt is given by this non-resident. Non-resident is giving debt to this Indian company or permanent establishment of foreign company which is there in India. Permanent establishment of foreign company which is there in India. And these two are associated enterprises as well. These two are associated enterprises as well. Sir, when 94B thin capitalization is applicable, a non-resident is giving a debt or loan to an Indian company or permanent establishment of foreign company, and the both of them are associated enterprises. Both of them are associated enterprises. Point 1. Then they incurs expenditure. This Indian company borrower has to pay interest now if they have taken loan. So such interest expenditure or any similar nature is greater than 1 crore. So the interest paying is like greater than 1 crore. First, debt given. Whom? Non-resident to Indian company or PE of foreign company. Okay, and both of them are associated enterprises. Second one, the interest expense being claimed is more than 1 crore. Then such expense is deductible in computing the income under that PGBP. So usually interest expense is deductible under that PGBP. No specific disallowance there. So that's why that is allowed. Okay. Now, if all the above conditions are met, then the excess interest cannot be claimed as deduction. So what is called excess interest? Excess interest is like the total interest paid or payable exceeding 30% of borrower's EBI TDA. So you need to find out the lender's EBI TDA, earnings before interest, tax, depreciation and appropriations. You should find out this EBI TDA, and on that, in excess on that you need to calculate 30%. So the interest paid or payable in excess of 30% or the actual interest, whichever is lower. Sir, here in excess of 30%, in excess of 30% or the actual interest paid or payable during the previous year, whichever is lower. Sir, obviously in all the questions we solve, it would be like what? In excess of 30% of borrower's EBI TDA will only be lower. So in simple, we could say like excess interest means take 30% of EBI TDA. The interest above 30% of EBI TDA, whichever you are paying, let's say 500 is the interest. But the EBI TDA is like 1000. So 1000 into 30% na 300. So in excess of 300, how much interest you are paying? 200, right? Because you are actually paying 500. The 200 is the excess interest. Such excess interest will be disallowed. You cannot take it as deduction. Okay. Then 94B not applicable in certain cases when where the Indian company or permanent, where the Indian company or this permanent establishment of foreign company is there na, these are banking, involved in banking, insurance or NBFCs. These are banking, business, insurance or NBFCs. Then the interest paid on debt issued by a lender, that is PE of a foreign bank in India. So this PE is there na, this is a PE of foreign bank which is in India. So third one, finance company located in IFS. In simple, sir, if this borrower is a bank, insurance company or NBFC, or if it is a permanent establishment of foreign bank. Third one, if it is like a finance company which is located in international finance, IFSC, okay, then in such cases, this thin capitalization provisions are not applicable. Sir, this excess interest is getting disallowed now. 30 percentage of in excess of 30 percentage of EBITDA is getting disallowed. Such disallowed interest can be claimed as deduction in the coming 8 years. I mean, it can be carried forward up to 8 years in the year where the actual interest paid is less than 30 percentage of EBITDA. So to the extent of that 30% will be there, to that extent you can be setting off. Okay, so thin capitalization, sir, it is applicable when a non-resident offers a loan to an Indian company or a PE of foreign company located in India. And both these are like associated enterprises. And the interest expenditure being claimed is more than 1 crore and it is allowed as a deduction in PGPP. Then this thin capitalization provisions will come and says like excess interest is disallowed. How much is the excess interest? In excess of 30 percentage of EBITDA of the borrower, that would be disallowed. Okay. Now look at this question. Rosie Limited provides you the profit and loss account for the financial year 23-24 and financial year 24-25. Okay. They given you the gross profit. They given employee benefit expense, interest, depreciation, income tax, and appropriations. On 23rd June, Rosie Limited, an Indian company, borrowed 120 crores. How much, sir? This Rosie has borrowed from L&T Incorporation, which is from country X. So from country X, I mean a non-resident person, from a non-resident, this Indian company has borrowed 120 crores and it is repayable in 4 years. Next, this loan is guaranteed by Right Limited, a company incorporated in Y. Right Limited holds 46% in Rosie Limited. Sir, see. Rosie has taken loan. Rosie Limited is the borrower. Whereas this L&T Incorporation is there, na? This L&T Incorporation has given loan. How much loan given? The loan given is 120 crores. Okay. For this, the guarantee is given by Right. Guarantee is given by Right Limited. There's a company called Right Limited which has given guarantee. Okay. And then this Right Limited has 46% share in Rosie Limited. 46 na greater than 26. So Rosie and Right are associated enterprises. Sir, here if you see, associated enterprise didn't given the loan directly. But where a non-resident gives a loan to that associated enterprise acting as a guarantor, this also amounts to a deemed loan which is given by associate enterprise only. Here also thin capitalization is applicable. So they are asking us to calculate the income under that PGBP, assuming gross profit is calculated as per Income Tax Act, depreciation as per Income Tax Act. Okay. Sir, first year 1, 23-24 we'll see. 23-24, what is the gross profits are 2030, right? From there, if you subtract this employee benefit, because interest, depreciation, income tax, appropriations of profit, all these will come after EBIT only, right? EBITDA. So that's why only employee benefit, if you subtract 390, how much it will come to? It will come to 1640. So this 1640 itself is EBITDA. Earnings before interest, depreciation, tax. EBITDA, interest, tax, depreciation and appropriations is 1640. So now how much is the 30% here? So you need to calculate 30% of 1640. How much it is like? 30% of 640 is like 492 lakhs. So here 492 lakhs is only allowed. But actually how much is the interest paid? 562 lakhs. So 562 lakhs is the actual interest. 1640 into 30%, 490. But whereas actually here is how much? 560. So the difference is like 72 lakhs. 72 will get disallowed. 72 will get disallowed for the previous year 23-24. Come here. Gross profit 2030. Employee benefit expense 390. Then EBI TDI is like 1640. How much is the interest disallowed? First see the actual interest 562 minus interest allowed. Interest allowed, disallowed is like 30% or actual, whichever is lower. 30% of EBI TD na 30% of EBI TDI is how much? 30% of EBI TDI is like 30% of EBI TDI is how much? Like 1640 into 30%, which is like 492 lakhs. Or, sir, I think total interest paid or payable. Interest paid or payable to L&T Incorporation 560 lakhs. Out of these two, whichever is lower. Whichever is lower now, how much, sir, here? 70 lakhs. It is 70 lakhs. The 70 lakhs is the disallowed. Okay, here not 492. 70 lakhs is the disallowed. This 70 lakhs, what you can do? You can carry forward it for 8 assessment years. 8 assessment years. Then interest allowable under section 94B for assessment year 25-26. The gross profit is 1780. Whereas again here, the employee benefit expense is how much? 402. Subtract that 402. How much is the EBI TDA? The EBI TDA is how much? 1378. On 1378, how much is the interest allowed? The interest allowed is like 30% of 1378, which is how much? 389. Sorry, the 30% of 1378 comes to 413.4 lakhs. But whereas the actual interest is 389 only. If you subtract 389, you have still the balance for claiming interest deduction. How much? You're having somewhere like some 24.4 balance amount you can claim as deduction. You have the possibility to claim as deduction. So what you will do now, to the extent of this 24.4 lakhs, last year your disallowance na up to, you have disallowed na interest up to how much, sir? 70 lakhs. From that 70 lakhs, you can adjust 24.4 lakhs for the current year. That means 389 is the current year interest. Another 24.4 is the past year. So overall you can claim how much? 413.4. 413.4. Out of 70, if you subtract 24.4, the balance 45.6 can be carried forward for another 7 assessment years. Can be carried forward for another 7 assessment years. Now income from PGBP. Income from PGP what? EBI DTA for the year 25-26, 1378. Less interest. Interest, how much is allowable for the current year? 413.4. Less depreciation. If you subtract depreciation, 254. Because, sir, under the head PGBP, will be subtracting interest and depreciation. Income tax and appropriations from reserves and all will not subtract for the PGBP income. So that's why you're subtracting from EBI DT, the interest 413.4 and depreciation 254. So then the profit and gains from business or profession is 710.6. Then Sunny Limited provides you the P&L account for the financial year 23-24 and 24-25. Gross profit is 2,400. Gross profit is 2,400 and 2,200 for financial year 23-24 and 24-25. And here they given employee benefit expense. So I am subtracting here only the EBE 480. Here you should subtract. Here 510 you should subtract. Then you will be getting EBI TDA. How much it is? Like 1920. Here if you subtract, it is like 1690. Then you should do what? 30% of EBI TDA. 30% of EBI TDA. What is the 30% of EBI TDA, sir? The 30% is here is like 570, like 6 lakhs. Whereas here the 30% is like 507 lakhs. What is the actual interest? Actual interest is how much? Actual interest is like 480. Sorry, 750. Actual is like how much? 750. Here it is like 350. Sir, here 576 minus 750 minus 30% only allowed. Now if you subtract 576, you'll be getting the disallowed. Disallowed. How much, sir? 750 minus 576. If you do, you'll get 174 lakhs as a disallowed. 174 lakhs as disallowed, which can be carried forward for how many years? 8 assessment years. But whereas in the second case, the actual interest is only 350, whereas 30% na 507. That means 157 surplus is there. Nothing is disallowed. Nothing is disallowed, not applicable. 157 still balance is there. So what you can do, this disallowed in the previous year can adjust here. 174 if you adjust out of this 157 lakhs, how much you are having, sir? Another 17 lakhs balance is there, which can be carried forwarded for another 7 assessment years. The 17 lakhs can be carried forwarded for another 7 assessment years. Then income under that PGBP for the financial year 24-25. Take this 2200, take this EBI TDA 1690. From there, subtract the interest allowed for this year. How much, sir? 507. 1690 minus 507 minus depreciation 640. Okay, then you'll be getting PGBP as like 543. PGBP as how much? 543. So the two which we have discussed now are like from the workbook. These are like the new kind of models which were there in the workbook. But if you look at the past exam papers and mock test papers, there are like some standard, very dead easy questions. Okay, even if the new model they asked also, it's easy only, nothing is there. Okay, you just need to practice like one question out of those two, it's fine. Okay, I have given two, but one is enough. And then again, out of these two, so total 3 questions and 1 page theory will give you 7 marks. See how important thin capitalization is. Midun Private Limited is a subsidiary of Robert LLC of USA. Okay. 1st June, Midun Private Limited borrowed 2,500 lakhs for which interest is payable at 6% per annum. Sir, when the loan is taken? 1st June. At what rate? 6%. There is no other borrowing. Midun is a subsidiary of Robert. So all these are what? These two are what? Associate enterprises taken loan. 2,500 lakhs. That means 2,500 lakhs now. How many crores, sir? 25 crores. Right? So 2,500 into interest we need to calculate 6%. 6%. Sir, if you do 6% now, it will come 150 lakhs. But remember, it is taken on 1st June. So you should take it for how many months? 10 months only. Into 10 divided by 12 if you do, you will get the interest as 125 lakhs. Nothing but 1.25 crores. Since the interest is more than 1 crore, this particular thin capitalization provisions 94B are applicable. Then they are given net profit 95 lakhs, which is after deducting depreciation, provision for income tax, amortization of preliminary expenditure, and even interest. So how do we calculate EBI TDA? Sir, EBI TDA earnings before interest, tax, depreciation, amortizations, and other appropriations. So you should add back all these things. Okay. So 95, you should add the 50 lakh depreciation. You should add the provision for income tax 20 lakhs, amortization of expenditure 10 lakhs, and interest on loan borrowed 125 lakhs. You should add back all this. Okay, then you will be getting the EBI TDA. You will be getting what? EBI TDA. See, so they are given EBI TDA here directly, sir. Directly. How it has came? 95 plus interest 125 plus depreciation 50 plus provision for income tax 20 plus amortization of preliminary expenditure 10. Let me check, cross check for you once. 95 plus 125 plus 50 plus 20 plus 10. So it is how much? 300. So the interest is restricted or allowed up to how much? 30% of EBI TDA or actual interest. 30% of actual EBI TDA, 30% of EBI TDA is 90 crores. Okay. So excess of 90 crores. Excess of 90 crores is how much? Excess of 90 crores is like 35 lakhs or the actual interest 125. Whichever is lower is the excess interest. So which is lower? This 35 lakhs is called as the excess interest. So this excess interest is disallowed. If at all in any of the coming years the interest which is to be availed is within 30%, then you can adjust this one in the 8 assessment years. Then on 1st April 2023, Deere Limited, an Indian company, borrowed 120 crore from Shine Incorporation, a company incorporated in country Z, for interest at 8% per annum. The said loan is repayable in a period of 8 years. The loan was guaranteed by Tiger Incorporation of country Z, who has 33% shareholding in Deere Limited. Sir, here Tiger Incorporation and Deere Limited are associated enterprises. Why? Because here the shareholding is how much? The shareholding is how much? 33%. But who are associated enterprises? Deere Limited, Indian company, and Tiger Incorporation of country Z. But the loan is given by Shine Incorporation. So the one who is lending is not associated enterprises. Okay. The associated enterprise is giving what? It is giving guarantee for the loan given by another non-resident to the Indian borrower. So this is considered as deemed to be associated enterprise only. So for this also 94B provisions are applicable. You could see, sir, Dear Limited, an Indian company, as borrower incurs interest. Okay, where debt is issued by a lender who is not associated, but an associated enterprise has guaranteed such lending, being explicit or implicit guarantee, or by making deposit matching with the amount of funds given by the lender. Such debt shall be deemed to have been issued by the associate enterprise, and therefore limitation of interest deduction will be applying. Okay. So how much is the interest applicable, sir, here? 120 crore into 8%, and the loan is given on 1st April only. So how many crores? 9.6 crores. The interest is here, sir, like 120 into 8% is now 9.6 crores, which is more than 1 crore. So that also satisfied. Associated enterprises. So all the conditions are satisfied. 9.6 crores. What the actual interest? Net profit here is how much, sir? 5 crores. You should add what? Interest. 9 crores. Sir, why they have taken 9 crores? It is 9.6 now. Sir, if you do 120 into 8%, actually, you will get 9.6 crores. Okay. But in the question, they have given interest on the above loan as 9%, which is actually wrong. But since they given in the 9 crores, the answer they given as 9 crores. So we are taking only the 9 crores only. We are taking only the 9 crores only. Okay. So net profit, add back this 9 crores. Provision for income tax 3 crores. For 5 crores, add 9, 3, and provision for income tax 3, depreciation 5, amortization 2. If you add how much? 14, 17, 20, 25, 27 crores will be the, that is what, right? 5 plus 9 plus 3. Okay, I have written an extra 3 here. So it would be how much? 24 crores will be the EBI TDA. The 24 crores will be the EBI TDA. Okay. 5 crores plus 9 crores plus provision for income tax 3 plus depreciation 3 plus amortization 2. It would be how much? So depreciation, sorry, written as 3. Depreciation is how much? 5. 7, 10, then 19, 24 crores is the EBI TDA. EBI TDA. On this 30% is allowed. On this 30% now how much? 7.2. Whereas the actual interest given in the question is 9 crores. Okay, 9 crores. So it is like how much interest liable for disallowance is like how much? 1.8 crores. But if you calculate on this 120 crore into 8%, then it will come to 120 crore into 8%, it will come to 9.6 crores. So maybe either the date, it's an examination question only, nothing to be done. Okay, and the suggested answer given also like that only given. So actually I think like it could be done in both the ways. You can take either 9.6 crores or even 9 crores also. Both the options are possible. But write down the assumption. Write down the assumption in such cases. Then Netra Private Limited is a resident Indian company having registered office in Hyderabad. It borrowed a sum of 25 crores from Z Limited incorporated in UK, which is holding company, associated enterprises, and the sum is like 25 crores. 25 crores into 10.5% interest rate. Now it is how much? 2.625 crores, which is more than 1 crore. So thin capitalization provisions are applicable. The net profit is like 347.5. It's like after debiting interest. So add interest 2.625 and then, sorry, it's like crores. Now 2.625 is crores. Here they are given in lakhs. It is like 262.5 is the interest. 262.5 is the interest. Then depreciation is like 80. Income tax is like 70 if you add, and then amortization expenses is like 20. If you add all this, then you will be getting the EBITDA. Okay. So profit 347, interest 262.5, and then depreciation, provision for income tax, amortization expenses. Then you'll be getting what? EBITDA. On this EBITDA, you'll be getting the lower of interest paid 262.5 or in excess of 30%. What is the 30% here, sir? The 30% of 780 is 234. The 30% of 780, because the total here is like what? 780 into 30% you should do. That would be 234. In excess of 234, how much is there? 28.5. Out of these two, lower. So lower na 28.5. So this is disallowed. Okay, the interest allowable is like 234, 28.5 is disallowed, which can be availed as deduction in the coming 8 assessment years. The last question, sir. X Limited, an Indian company, has borrowed 50 crores from Y Limited at an interest rate of 8% per annum. X Limited submits the following particulars: net profit after interest, income tax, depreciation and dividend 5 crores. Income tax 1.5 crores. Sir, see here. What is the interest here? 50 crores into 8% per annum. Na? 50 crores into 8%, it is like 4 crores. So you see here, this 5 crores net profit is after interest. So add interest 4 crore, add income tax 1.5, depreciation 1 and dividend 0.5. So it comes to total 12 crores. It comes to total 12 crores as the EBITDA. EBITDA. Compute taxable profits of X Limited if book value of assets is 98 crores. Sir, here we need to check what? Whether they are associated enterprises or not. If at all the book value of assets is 98 crores, 50 crores has been given by their holding company. Na? So then see, by an American company given 50 crores out of 98. So 50 divided by 98, if you do, it will come to 51.02. So the total borrowings are more than, the borrowings are more than 51% of the total borrowings of the other enterprise. So associated. Whereas if you take 99, then 50 divided by 99 crores, if you do, it would be less than 50%. So when the book value of assets are 98 crores, then associated enterprises. If book value of assets are 99 crores, then they are not associated enterprises. Understand? Okay, if they are associated enterprises, EBITDA is how much? 12 crores. Now 12 crores into 30%, na? 3.6 crores. Whereas the actual interest paid is how much? 4 crores. So how much is disallowed? 40 lakhs is the disallowed interest. 40 lakhs is the disallowed interest. Okay, then the taxable income is like now from the EBITD 12 crores, subtract 3 crores 60 lakhs interest, and then the 1 crore, the depreciation. You will be calculating the 7 crore 40 lakhs as the PGBP income. 7 crore 40 lakhs as the PGBP income. No disallowances in case the book value of assets is 99 crores because they are unrelated. When they are not unrelated, then there is no thin capitalization. Okay. With this, we have completed this particular transfer pricing DTAA exclusively, sir. So I have given assurance like you can do question number 6 and 7, but 8B also actually you can do because we have covered all the relevant points which are needed.